you've seen this benefit from a shift to attention in software. How's that different from the action that we're seeing with the businesses around Salesforce and Workday, and then the DevOps players as well?
Sure. So what I would tell you is that COVID is clearly accelerating long-term technology trends. We see every company, no matter who they are, what their background, and how legacy they are, they need to be digital by default. They need to be able to innovate quickly. They need to be able to move quickly to seize new opportunities or respond to new threats. And that's why we're seeing a lot of customers engage with us to really help them transform their business. And that's why I think you've seen us deliver really strong results this past quarter. And we also increased the rate and pace by which we added new customers, which I think is quite noteworthy, especially in a challenging economic backdrop.
Now, the enterprise spending has been an issue for different companies to different degrees. Pop up for Zuora and for PagerDuty. We just spoke to Jennifer Tejada about that. To what degree is that a factor in your business, and what's outweighing it as far as the trends that are tilting in your direction?
Well, we're going after a big opportunity. If you think about it, data is everything to an application. If you think about a retail application, an e-commerce application, a gaming application, what is an application without data? So, we play a very important role in the application stack. I think what we've also done is really married a great product with great go-to-market execution. To us, that's the hallmark of building a great company. So we've become very sophisticated in terms of how we go to market. We have a high-end field sales force. We have an inside sales team. We have a self-serve channel to monetize a long tail. And we also have a partner organization that enables us to do business with customers and expand our reach more quickly. And so all of those channels are working in virtuous cycle, which is why I think we're delivering strong results, and we have so far. I don't want to declare victory, but we're really pleased with the results we're seeing so far.
Dave, it's Julia here. You significantly increased your revenue outlook for 2021. We hear so much from companies right now with the lack of certainty. What is giving you the insight to be able to increase your outlook, and what do you think will be driving that growth?
Well, we have over 20,000 customers in almost every vertical industry and geography using us for almost every conceivable use case. So we're feeling quite confident that, one, MongoDB has become basically an acknowledged leader in helping people innovate quickly. Two, where we see a big opportunity in front of us. We're just scratching the surface. And so we feel that we're just getting started, and we're investing more in hiring new salespeople around the world, and also investing heavily in our product. And three, when we see the results we see, it just gives us confidence that our message, our product, and our value proposition is resonating even in a difficult economic environment. We've had customers in the automotive industry, we've had customers in the airline industry, we've had customers in the hospitality industry use us to transform their business. I'll give you two quick examples. Woolworths in Australia and New Zealand is the largest retailer. They decided that they want to reduce human contact with their customers, with their 11 million customers. So they built an application to send digital receipts by ingesting point-of-sale data into Atlas and sending digital receipts to all their 11 million customers. 7-Eleven, a very traditional convenience store, I remember it from my early days going there, decided that they had to be digital by default. So they built a bunch of mobile applications to engage with their customers in a contactless way, and also to do better inventory management across their 8,500 stores.
Dev, who do you think Atlas is taking the most share from?
I would say Atlas is really taking share from all the on-prem providers. We definitely see people building new apps in the cloud, and we also see people re-platforming existing applications that were running on-premise on legacy technology and moving it to MongoDB and Atlas. And so Atlas, just grew 66% year over year. It's growing incredibly quickly. And in just a span of a few years, it's a $250 million run rate business for us.
Indeed. Dev Ittycheria, the CEO of MongoDB, on a rough day for the markets after, upside surprise to MongoDB's earnings. That stock still selling off. Dev, good to have you.
Thank you, John. Good to see you. Take care.
And speaking of, guys, the Dow now down less than 2%. That's less than 550 points. Carl, as you mentioned, it was down 750. The S&P down about 2.5%, but also well off the lows. The excitement, as far as movements in stocks percentage-wise, not letting up.
It's true, John.
And we see the
you
VIX
look at the
up
few Dow
10%.
Sorry, Julia. I was just going to say, looking at some of the Dow components that are green, you're looking at some consumer names, defensives like Verizon, but also a couple financials, JP Morgan and Amex among the 4 Dow names that are green. Deutsche did upgrade JP Morgan this morning, Julia, to a buy on the notion that it's hard to argue that banks continue to underperform as much as they have from here on out. So again, it all points to that same discussion into which everything is funneling, and that is whether or not we're seeing a true rotation or this is just one of those outlier days.
That's right. And Carl, as you mentioned, the volatility up, VIX up 10% today. And then, of course, we have that big jobs report tomorrow. So it'll be interesting to see what the next big moments will be for this market. Meantime, our next guest runs one of the nation's largest television and film studios. It's gearing up to release a new movie next week as theaters continue the process of reopening. Joining us now is the chairman and CEO of Sony Pictures Entertainment, Tony Vinciquerra. Tony, thanks so much for joining us today. I know you were on this show a couple months ago when all theaters were closed, and now you have a film opening up on September 11th. What is your expectation for the box office for your film, a relatively small romantic comedy, and as well as for some of the other bigger films that are opening this weekend, like Disney's Mulan?
Hi, Julia. Crazy morning for you guys, huh? It's the movie is Lonely Hearts Club. It is executive produced by Selena Gomez, opens next week. It is a fun movie, so we're hoping it does well. We don't really have a specific expectation as to what we'll do, but this weekend is a kind of a watershed moment. Your colleagues were talking about the cruise industry getting some testing this weekend as well. As you know, Tenet opened last week around the world, did very, very well, much better than anticipated. It opens this weekend in the U.S. We're hoping it will do well. Our research indicates really clearly that it's people's expectation about going back to theaters is pretty much the way a bell curve generally looks. A portion of the audience is desperate to get back to movies. The bigger portion, the middle portion, is thinking about wanting to make sure that the protocols are in place, that the safety is good, and then there's a bunch of people that want to see proof that on the other side of the bell curve that want to see proof that things are safe. So we're thinking it's going to be better than people are predicting. Around the world, it has been better, so we're cautiously optimistic.
So, Tony, the last time we spoke, you said you were committed to the theatrical experience, but I have to ask, why not also do direct-to-consumer video on demand? We saw CNBC's sister company, Universal, commit to doing that. They're going to shorten the window between theatrical and at-home releases. Why not do the same?
Well, your sister company has a platform to do that on through Comcast. We don't. Warner Brothers has a platform to do that as well, DirecTV. We are committed to the theatrical world. We think that it will come back, that it'll be fine. We have sold a couple of movies to streamers. The big advantage to consumers is going to be when theaters are open and people feel safe to go. They're going to be seeing a blockbuster movie virtually every week for the next 18 months or so. So it's going to be a very, very good experience once the majority of people feel really safe to go back. And we think that will happen relatively quickly, assuming that we don't see some spreading happening with the virus.
But there will be some audience members who never want to go back, especially older audiences. Isn't there a big opportunity to be had in doing either simultaneous release to the home video market or shortening that window? And how do you feel like Sony should be trying to take advantage of that?
Well, the windows will become more flexible, we think, and we'll find ways to take advantage of that. We have had some instances where we shortened windows. We've had instances where we've lengthened windows. It depends on the movie, the time of year, the audience reaction to the film. So look, it's a very fluid moment. All bets are off at the moment. And as we get back into the traditional methods of distribution, I think you will see things return back to the way things were with this additional platform of streaming services and also shortened windows on video on demand. We were very successful through the year so far with our video on demand offerings through electronic sell-through and through rental. And you know, it's been a very, very strong business for us, and we're expecting that the theatrical business will come back in a strong way, and we'll have some flexibility on windows, and we'll see where it all goes.
Hey, Tony, you know, we always talk about the pandemic accelerating trends that were already in place. E-commerce is one that everybody always points to, but I wonder, can we say the same thing about studios' reliance on big-budget blockbuster tentpoles at the expense of independent movies, or is that just too glib at this point?
Well, look, anybody that tries to predict what's going to happen through the rest of this pandemic and after it's gone away is not basing anything on it, because we've never seen anything like this. The research shows us that audiences want to go back to theaters, that there has been acceleration in the use of streaming. You know, the bell curve is a predictor of just about everything that happens in life, and what we're seeing is that people want to go back to theaters in an aggressive way, a big group. As I said, the middle of the curve says, you know, let's see how the safety protocols look. And then, as you say, some people won't go back until it is absolutely proven, or may never go back. But there will be a tremendous number of blockbuster movies out there to draw people and consumers into the theaters. But look, it's very fluid, and we're going to have to watch and see how this all develops.
Well, Tony, we really appreciate you taking the time to talk to us today, and we hope you'll come back later on this fall once many more theaters are open to give us a sense of how things are moving. Thanks so much,
Well,
Tony.
again, this weekend will be a very important indicator. So thank you, Julia, and we'll hope to see you soon.
That was great, Julia. A really fascinating look, and we'll be hopefully coming in on Tuesday morning after the long holiday weekend, talk about how Tenet did and how the studio machines are ramping up again. As for breadth, guys, John, I always love this. You can always count on a day like this where on the NASDAQ 100, you can count the number of green names on one hand. In this case, it's two. Two of the NASDAQ 100 are green, and that is going to be Moderna and Walgreens Boots Alliance. It's just that kind of day.
It is, Carl, and I see Viacom is a little bit in the green, and you know who's having a really good day? Beyond Meat. I'm sure there's a pun in there somewhere, but with seconds to go until noon, I can't find it.
Obviously, a big part of the session still ahead, and we'll see what tomorrow's jobs number brings, obviously. Julia, thanks as always. We'll see you tomorrow. Let's get to Tyler in the half.
And I promise over the next hour, John, that I'm going to find that pun and that wordplay on Beyond Meat and why it is winning today. Welcome, everybody, to the Halftime Report. In for Scott Wapner, I'm Tyler Matheson. Big sell-off on the street this hour. What a change from earlier this week as September got off to a good start. Not today. NASDAQ and the big tech growth names, they are in the front of the big drop. So should you buy on this dip, or are we headed lower? Is this the beginning of the September swoon? We will debate that with our investment committee. Josh Brown, Steve Weiss, Jenny Harrington, CEO and portfolio manager at Gilman Hill Asset Management, Rob Sechin with UBS Private Wealth Management and one of Forbes's top 100 financial advisors. And oh, by the way, has a tremendous Instagram account. Jason Snipe is here as well, principal of Odyssey Capital Advisors. Let's get a check-in on the markets right now. Stocks are still deep in the red. The NASDAQ, the biggest loser by far today, on pace now for its worst day since June 11th. The S&P also on pace for its worst day since June. Big tech names like Apple, Microsoft, Facebook, there you see the indexes, and some of the names, Amazon, Alphabet, they are the ones that are dragging the markets lower. By look at Apple, down nearly 6%, Microsoft 5%, Facebook 5%, Amazon almost 5%, and Alphabet 4%. What's going up? Only the bond, the 10-year note there at 0.62%. Let's kick it around a little bit. Mr. Weiss, why don't you go first? Is this the beginning of something bad, or maybe not?
I don't think it is. You know, when I was on the show last week, I said, hey, all of us on the show today are greedy. And greed has a way of just biting you in the ass at some point, and then you have to decide, okay, is it a flesh wound or is it drawing real blood? I think this is more of a flesh wound. I think it's taking some of the weak-handed traders that are coming out buying stocks like Zoom at the top that are now selling them. We saw it start to unwind yesterday with Apple for all those that went in and stayed with the split trade looking at Tesla. Then when Tesla gave up some of that, they started to sell Apple. And then that led to others as well. We're saying, okay, Amazon's going to be the next one to split, and maybe Zoom's going to split. So money piled in. So now you're just seeing just the natural course of markets. It's not a big deal. It's not one single event. And I think that that we're going to be okay. I don't know if it's going to last today or go through the next few days, but the important thing is that there's no valuation support in my mind for the market. It's a momentum market, so the bet has to be that the momentum hasn't stopped. It's just taking a pause, and that's my bet. So I'm not putting more money in, nor am I selling today.
Rob, Steve says he's sort of standing pat right now. He sees a trickle of reasons why the market is selling off. What are you seeing and what are you doing?
Well, I think Steve's right. There are reasons that the market is selling off. We've seen these tech names perform tremendously well. It looks like they've reached some unsustainable prices. Whether that ends today or tomorrow, I don't think anybody knows when that happens. But the risk-reward trade-off between growth and value has certainly been pushed to a great divergence level. And so we have used the latest moves in markets in tech to kind of take money out of momentum, move money into some of the cyclical laggers. We're not making meaningful moves. This is at the margin, we're making moves. So that's some of the actions that we're taking, rebalancing, removing some out of beta, raising a little cash. And it's just an acknowledgement that some of these dichotomies, some of these dispersions, I mean, growth has outperformed value by 43%. That's one of the largest in history. It's a huge dichotomy, and I think it's just a matter of prudence to kind of tap the brakes. I use this analogy, and Jenny has another creative child's analogy. The Fed came and pushed us on our bicycle, and we got a lot of momentum, and we're going down the hill, and I think it's just time to touch your feet to the floor and make sure you're balanced. How do you get that balance? By a little rebalancing, a little repositioning, but not a complete abandonment of the strategies that you've had in place.
Jenny, the party's been going on all summer long, really since March, and maybe the punch bowl is a little dry. Do you think it will get refilled, or is the punch bowl getting taken away for a longer period?
You know, I think that we need to think about the broadening of the market. So I don't even think it's the punch bowl empty or full, unless you're talking about just the top part of the market that's really led and dragged us to these new highs. So when I think about the punch bowl for the broader market, for all 500 companies in the S&P 500, it's there. It's still available. We can drink from it. I think that what we're seeing right now is probably the end of the insanity of the party, and that's okay. Maybe the party goes into a more moderate phase, and there are other people who get to enjoy the dance floor now. It's an interesting thing because everyone knows my portfolio is more value-leaning, more dividend-oriented, and that right now is performing relatively well. If you look at the value indices today, if you look at the equal-weighted S&P 500 funds, they're performing relatively well to the broader market. So I don't think it's over. I just think those who partied the hardest, it might be time for them to go take a nap.
I'm going to save the last word for Josh, but Jason, what do you think? It does appear that maybe today we started September in fine form, and today a really really surprising pullback. I can't see a headline that's driving this. Can you?
Yeah, so I agree with most of the panelists' comments. You know, I look at this summer, which is historically great, particularly last month, which is, best August in decades. I think it's a little bit of rebalancing. I think it's a little bit of profit taking. I know September is historically a slow month. There won't be a lot of news coming. So, and also preparing for the elections. I think, there's a bit of uncertainty, but, we always talk about here in the office, there's also something to sale discipline, which I think is important. And when things are running a little too hot, maybe it's looking at rebalancing and sticking to putting your dollars in other positions.
Josh, put it all into context for us. What are you thinking?
I broadly agree with what everyone had to say. And I think, last week I was on the show and I had mentioned taking 20% off the table and things like Apple and NVIDIA. And it felt terrible at the time, which in hindsight probably should have served as a stronger gut check for me in general than it did. But, today it feels better. And I do think that the punch bowl maybe had been overflowing. And I noticed yesterday, somebody pointed out there was a 3 times Tesla ETF that somebody had the audacity to put on the public markets. Things like that, you can't really trade based on them, but I think you want to keep them in the back of your mind as just like a realization of the way people are behaving. So now you have people that started day trading 6 months ago who are, leading people into things like stock split trades, et cetera. So just keeping those things in the back of your mind that's the backdrop. But I would point out, JP Morgan's up on the day. I'm long Verizon, Store Capital, plenty of stocks that are green or flat. Jenny pointed out the equal weight. The RSP ETF is down less than 100 basis points, while the XLK is down 400 basis points, 4%. So I think if you have a diversified portfolio, this is another reminder of why you have it to begin with. And if you were one of these people that went 100% all in on the parabolic stocks, the DocuSigns, the Zooms, congratulations, you played yourself.
Yeah, all right, Josh, well said. Because on a day like this, you can never have too many voices. Let's welcome in 2 more, Mike Santoli and Dom Chu of CNBC. Mike, what are you seeing here? Why today? Why now? You first.
It's not clear to me that there's a headline or anything else that dictates today was the day. Although, the NASDAQ 100 was up 14% in 3 weeks. Through yesterday, so we're down 4% of that. You're still not cutting into muscle. This is all about, there was a bit of a buying crescendo that you saw building up over the matter of days and weeks. There's some talk that on Wednesdays you have weekly options expiring. There was a lot of frenzied activity in the options markets we've been talking about most of the day, where it's just tremendous demand for short-term upside bets on stocks. That's been creating a little bit of erratic vibrations within the market in terms of hedging and things like that. And some of it, I think, just the fever broke today, to mix many metaphors. So that's, to me, what's going on. It's relatively normal in a high momentum extended market. And if you look at the uptrend since the lows in the NASDAQ Composite or 100, it just kind of got to the upper end, very extended toward the upper end of the trend. And we've had 3 or 4 pullbacks down to the bottom rail of that trend. And that would be like a 6 or 7% pullback from the high. So, that could be all this is. Not to say that something that was bigger wouldn't start in the same way as we're seeing today.
Dom, did you have any inkling that this was coming?
So yes and no, right? Yes, because you have these statistically rare events when companies like the DocuSigns or the Zooms or the Teslas shoot up in a way that is just, in fact, unsustainable. From a statistical sense, there's no way they can keep going that high because they'll be the entire world GDP by the time they're done. What's curious about this particular move and why perhaps the bulls out there say this is not the beginning of some broader correction is that you aren't seeing exactly stresses in all parts of the market right now. One thing I want to point to is something that Rob Sechin kind of addressed, and that's the cyclical laggards. If you look at the trading action today, what you are seeing is an outsized decline in communication services and also in technology. Where you are seeing, by the way, a green speck in terms of sectors today is in financials, believe it or not. We've been kind of downplaying financials for the longest time, and energy, you're seeing some life there as well. So those cyclical laggards are playing out. The other place that you're not seeing a lot of downside movement being priced in is in the credit markets right now. You aren't seeing a lot of stress in investment grade credit. You aren't seeing a lot of stress in junk or high yield credit either. It kind of lends you to this idea that it's strictly the momentum stock side of things that is really driving the downside. You're not seeing a wholesale risk off move. That kind of thing happens, you would see energy markets fall, you'd see oil prices tank, everything goes along with it. But instead, you're seeing a more modest movement out of certain sectors and perhaps just into others, Ty.
We're going to talk a little bit. Thank you.
Dom, just to add to that kind of is an indication of the benign rotation that we would all hope for. There's 2 types of rotation we could see. A massive, ugly double dip that will impact all sectors, markets, and really be ugly for investors. And then there's kind of the catch-up trade, which we all hope happens, which indicates breadth in the market and indicates a much more healthier path to an economic recovery.
You know, Josh, Dom mentioned some of the financials. You mentioned JP Morgan. We're going to talk a little bit about a couple of upgrades in the financial sector a little bit later. How does the performance of those stocks today, you touched on it a moment ago, how does it fit into the broader tableau of what's going on?
I think 3 of the best performing stocks in the S&P today are cruise lines. So I don't believe that these counter trend rallies in the left behind sectors are meaningful. I don't think that they're long. I wish I were wrong about this, because I think that would be symbolic of an economy that's recovering faster, but I just don't believe in it. The only way, by the way, we had an episode like this middle of May through the middle of June, and I think this is the worst day for the S&P since June 11th. So we had a version of this already, and it went on for almost 4 full weeks, where the value, quote-unquote, catch-up rally, whatever, so those stocks ripped, and techs got killed and served as a source of funds. And then just as quickly as it started, it went away, and everyone went back into the Teslas of the world. And I don't have any evidence to suggest the same thing won't happen again this time. I don't know how long this version goes on, but I think a lot of these value catch-up plays or whatever are still guilty until proven innocent. And I already told you guys what I would say would be the signifier that that's changed and that I'm wrong about that. Just tell me where oil and where curve steepening is going. So if you have a sustained steepening in the curve, which we thought might have started last week, gone. And then if you have a sustained move higher in oil, again, no evidence of that at all, then I would say, okay, this value catch-up trade thing has legs. But every time so far it's been a fake out. No reason for me to think it's not a fake out again. So I would say, if you're in these value stocks and they're green today, yeah, okay, smile, enjoy it for 5 minutes. But I wouldn't like base your whole life on it.
Jenny, you want to jump in?
Hey, Tyler.
A risk worth taking.
I would love to jump in.
Jenny would love to jump in. Let's let her go, and then I'll come to you and Rob. Steve.
So I don't think it's a fake out, and this references back to a point that Rob made earlier, which is that there's currently a 43% return divide between growth and value. That's totally unsustainable. When we talk about what the catalysts are for why we've had this pullback today, I think it's emotional exhaustion with what's gone on over the past 10 weeks or so. I think I could even say last 3 weeks. I think people have gotten emotionally exhausted watching Tesla just spike and skyrocket. The same with Apple. So I think there's emotional exhaustion on seeing those just go up and up. I don't think Josh is right that the growth value divide is not going to be a permanent narrowing of that divide. And bringing back, if we lump in the financials again, it's just an interesting thing to look at the reality that underpins all these moves. The reality is that the financials
Jenny, are
sector,
interest rates and oil prices going up or down?
I don't know that it really matters. I think as long as they're steady and predictable.
It's the
but
only
hang on,
thing
Josh,
that
let me
matters
just
for
make one
those
more
stocks.
What'd you say, Josh?
I don't think so. What we know is that, hold on, let me just say one thing, and then you can get back on it, Josh, on this. But earnings right now for the financials are 15.5% of the index, of the S&P's total earnings. Meanwhile, they make up 10%. FANG, 6 stocks, 13% of total earnings, and they make up 20%. Things are just out of whack, and people are exhausted with that. I don't think that you need to have interest rates go up significantly for many financials to do well. I don't think that you need oil prices to be above 60 for many energy and oil companies to do well, and you really should separate energy and oil. So I think that there could be an improvement in the bottom half just from stability in those
Josh, I'll go to
sectors,
you, then Steve, and then Rob, if I might. Josh, a quick response, and then Steve and Rob.
The value trade is de facto a banks and energy trade, period, end of story. So if oil's not going up, energy's not going to work for a consistent period of time. And if interest rates aren't going to rise, the companies that comprise the XLF are not going to, forget about lead the market, they won't even keep pace with it. In the meantime, we talk about the outsized market capitalizations of FANG stocks. Well, these companies are growing 20% plus a year on the top line and have 30% profit margins plus. And it happens year after year after year. So show me a reason why that reverses, and then I'll say we're going to get this sustained value renaissance, blah, blah, blah. It's not happening right now. It may happen today, like daily, It's not happening on a monthly, quarterly, annual basis. I hope it does. I'm just pointing out the truth.
All right, Steve, jump in, and then Rob, and then we'll say goodbye to Dom and Mike and bring in yet another voice to talk this one out. Go ahead, Steve.
Okay, so referencing Josh's reference to June 11th, which was the last time the NASDAQ experienced this, and subsequent weeks. Well, the market traded up since June 11th at the peak yesterday, 20%, NASDAQ. Even today, it's still up 15%. So if you fade these moves, then you're losing the upside. I agree with Josh completely. You've got bonds doing well today, which means that banks shouldn't be doing so well today. And yes, the divergence of 43% is at a record level, maybe unsustainable, but we've never had a pandemic before. We've never had free money everywhere before. So there are lots of good reasons for these stocks to underperform, and I quibble with the term value. Value cannot be a euphemism for saying companies that aren't growing, because there's no value there. So yes, so we all have biases. Jenny has a dividend and a low PE bias. I have no bias. I can go into value. I can go into growth. I can go anywhere I want. I choose to go into companies that are growing, that will continue to grow, and can grow regardless of economic condition. And in fact, where demand is increasing because of the very conditions that we're in now with the pandemic. So yeah, so I never get exhausted seeing good things happen. So I don't buy the exhaustion claim. I'd get more exhausted watching stocks lose money than going higher. So, but going back to all this, what's most important is your discipline. So if your discipline is to be 20% cash or 10% cash, you got to continue to sell as you breach those cash levels and get back to where you are. Otherwise, today's will be uber painful. So,
Rob, tie it off before we
cents.
bring in Jonathan Krinsky.
Let's realize that I've been skiing on this same ski for a long time, this growth trade. My leg's getting a little tired, and I'm going to try to put some weight on the other ski to have a little more balance in the portfolio. I got to tell you, at some point, you have to sow the seeds of optionality to a vaccine and an economic recovery. And I'm not saying to completely abandon everything that's working, because we all know it can work a lot longer than we thought it could. And by the way, there's tax implications to doing that. But by taking some off the table at what I believe to be are unsustainable valuations, despite the durability of growth, despite the fact that people pay up for growth in low interest rate environments, I also think markets are forward discounting mechanisms. And when we get clarity on the election, we get clarity on the virus, you're going to be glad you bought some of these value sectors. Josh said that value is all energy and all financials. He's right, it's 25% that. So if you get a rotation into those sectors, they're going to benefit regardless of the fundamentals, regardless. You don't need the fundamentals to be there, you just need the rotation to happen. And so I agree with everybody, but I think you can ski on both skis.
Rob, I'm glad you brought up the vaccine. I think the vaccine story took a hit over the last couple of days. The reason I say that is the date for a vaccine coming to market has been politicized. So people that were on the fence as to whether they're going to take the vaccine or not take the vaccine now have come off that fence and said, I'm not going to take it. What I'd like to do is everybody say when they would take the vaccine. For me, it's at least a year or two when it comes to market. What about you, Rob, Josh, Jenny? When would you take it?
I'm going to go wherever I can to get it immediately. I'm ready to go. I'm ready to move on.
I'm in full agreement with Rob on everything today.
All right, let's do this. Let's bring in another voice here, Jonathan Krinsky. He's the Chief Market Technician at Baycrest Partners. And Jonathan, welcome. Good to have you join into this discussion. What are the technical indicators telling you about the market, what it's doing today, where it's come, where it may go?
Yeah, Tyler, so there's been a lot of good discussion there. I agree with some of it, disagree with some of it. But I think what's lost in the whole NASDAQ market is there's a lot of things that we are seeing today that we haven't seen since 1999, 2000. And kind of the bull case for some of the areas of tech here is that, well, it got a lot crazier in 99, 2000. Now, if we look at something like the NASDAQ 100, it's about 35% above its 200-day moving average. It got to 60% at the peak in 2000. So you could say, sure, that's could certainly get a lot crazier. But the other piece of the puzzle, and I think it's lost, when you think about March of 2000, everyone thinks there was some major top in the market. And it was, but that's because, very similarly, technology was such a big part of the market and a dominating force. But here's what's lost. The day that the NASDAQ peaked in March 10th, 2000, from that point through the end of the year, the NASDAQ lost about 50% of its value. Over that same stretch, 4 sectors in the S&P 500 gained 40% by the end of the year. So there's a very similar setup in that a lot of these areas of the market, and we're not going to use value per se, but a lot of the areas of the market that have not participated, we were seeing a similar thing in 2000. It wasn't like everything was rallying. So I think part of the discussion is certainly accurate that I think you do want to be rotating a bit into some of the areas that haven't performed. It doesn't mean it has to be value, but it does mean that we've come a long way in the NASDAQ. And the other thing I'll just leave it with, the market is not independent of itself on any given day. In other words, yes, we're seeing that the NASDAQ is down the most since, I think, June 11th. The NASDAQ is up 17% since June 11th. So there's a lot of unwind that's still left to go, and we think today is probably certainly the start of that.
I'm thinking back to March of 2000, and to the extent I remember it, there were a lot of companies then that were going up and up and up. But they were kind of phantom companies, weren't they, Jonathan? I mean, they were companies that had never made a dime's worth of money. And today we're looking at a NASDAQ with companies that are really blue chip money creators.
Right. So every period is different, and certainly the fundamental argument is much more valid now. We also have, the Fed with extremely low interest rates. So certainly that's all the case. But on the other side, the concentration within the NASDAQ is actually more extreme today. And I've talked about this before. The top 6 stocks in the NDX now represent 50% of the index. At the peak in 2000, they only represented about 34%. So you're seeing what can happen when the biggest stock in the market, Apple, lost 8% in 30 minutes yesterday, and that's going to have a dramatic impact given the weighting on the indices. But I'll also say, again, just to put things in perspective, we're down about 4.5% on the NASDAQ. We're still 7% above its 50-day moving average. If we were to exclude the early part of this year, that's about as extreme as we've seen in the last decade, even after today's decline. So, yes. There are things that are not as extreme as they were in 99, 2000. There are things that are more extreme, but I think it's just important to recognize that we've seen this playbook before, where if you're saying tech is overstretched, that it doesn't mean the entire market has to come down as well.
All right, Jonathan, thank you very much. We're going to pause there and get a news alert from Julia Boorstin on Pinterest, and then we'll continue our conversation. Julia.
Tyler, Pinterest is making changes to its ad policies ahead of the election, saying it will no longer show ads to users when they search for election-related terms like candidate names or polling places. Now, the company, which banned political advertising back in 2018, announcing a series of updates today to direct its users towards reliable resources and to prevent the ability for ads to be next to political content, saying they will show fewer recommendations about election-related content like election memes or slogans. And the company is saying that if any users, including public figures, publish content that violates its policies or shares misinformation or hate speech, it will take action. This, of course, comes the same day that Facebook announced it will not allow new political advertising to run the week leading up to the U.S. election to prevent last-minute misinformation, but it will allow political ads submitted before that to continue to run. Facebook also saying it will remove posts claiming people will get COVID if they vote, and will label misinformation about the election and voting. So interesting to see Facebook and Pinterest shares both lower today. Of course, in the sell-off, Pinterest down about 6%. Tyler?
So Facebook will allow the old misinformation to be republished. They just won't allow any new misinformation? Is that...
Basically, they believe that if something is published far ahead of time, there will be time for the media, for other people to sort of do their own research and realize that something is false. If something is in the last week, they believe there won't be enough time for something to be adequately policed or corrected.
Right.
So Yeah, so of course there are questions, Tyler, with so much mail-in voting, advanced voting, what that impact will be there, but they're really focusing on that last week before Election Day.
Julia, thanks very much. Julia Borston. Up next, the bright spots in today's sell-off, plus bank stocks falling 30% this year, and one firm says now is the time to jump in. We've been talking a little bit about financials. We'll talk about two of the big banks to buy. The names and the debate is next in our call of the day. Halftime, we'll be right back in 2 minutes.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building innovative trading and investment solutions. Move into the future and move your account to Interactive Brokers.
The way we access information and communicate has evolved. This evolution has resulted in the integration of telecommunication, media, and internet companies. The Communication Services Sector SPDR ETF offers access to the entire communication services sector while reducing single stock risk. The Communication Services Sector SPDR, the next chapter in investing. Before investing, consider the fund's investment objectives, risk, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully.
College may look very different by the time your child is ready to attend, and that may impact the way that you save and you pay for it. A new survey has found that 15% are not going to save this year, and 9% plan to decrease their contributions. Keep in mind that 529 plans can also be used for qualified education expenses besides college costs. If you do take a non-qualified distribution from a 529 plan, you will have to pay income tax and a 10% penalty.
Hey, did you?
Yep, done.
And the?
Of course.
And?
Oh, yeah.
All in 1
hour.
Behind the world's most productive people is the world's most comfortable chair, the incredible X Chair, featuring patented dynamic variable lumbar support. X Chair's adjustable seat depth keeps users small to tall, comfortable and supported. Available in breathable mesh, HDR foam, or top grain leather. Customize comfortable positions for your neck and arms. And X Chair's patented SiFloat Infinite Recline provides the perfect recline for users of almost any size. This is not your grandfather's office chair. X Chair supports workers everywhere who find themselves now working from home. Call or click to get $100 off the amazing X Chair featuring dynamic variable lumbar support. Plus, for a limited time, you can also get free same-day shipping. This deal is good for any X Chair you choose. Create the world's most comfortable home office with X Chair. Call or click to order today and receive a 30-day risk-free trial and $100 off.
Alrighty, let's get some news headlines with Sue Herrera. Hi, Sue.
Hello, Ty. Hello, everybody. Here's what's happening at this hour. Hyundai and Kia recalling nearly 600,000 vehicles to repair brake lines that might leak and cause engine fires. The recall affects certain Kia Sorentos and Optimas and Hyundai Santa Fe's from 2013 all the way through 2015. The Brooklyn Nets announcing their new head coach is Hall of Famer Steve Nash. This despite Nash having no coaching experience. But the Nets say Nash's strengths as a leader and a mentor will gain the respect of players. It took a couple of tries, but SpaceX launched its next batch of Starlink satellites. 8 minutes after liftoff, the rocket's first stage booster landed safely on SpaceX's recovery drone ship. And a U.S. court has ruled that the NSA surveillance program uncovered by whistleblower Edward Snowden was illegal. The court also ruled that the U.S. intelligence leaders who publicly defended it had lied. You are up to date. That's the news update, Ty. I'll send it back to you.
That is going to be a big story.
It's a big story, yep.
Sue, thank you very much. All right, let's hear from Rahel Solomon now. She's got a few bright spots amid today's big sell-off. Hi, Rahel.
Hi, Tyler. Yes, so Josh did mention this at the top of the show, but cruise lines are holding on to their gains, though at one point, Carnival was up more than 10%, so that company is set to resume some Italian cruises this weekend. You can see Norwegian's also up almost 7%, Royal's almost up 6%. So that's also helping some other travel and leisure stocks, some of which are negative now, but holding up much better than other parts of the market. Hyatt's up about 3%, Hilton's up 0.6%, Las Vegas Sands about 0.4%. MGM, however, down almost 0.5%. Hotel operators, like I said, Hilton and Hyatt. Now, interestingly, some of the retailers are in the green. PVH, Under Armour, and VF Corp, even Kohl's and Macy's in the green. Macy's is up double digits, 11.3%, PVH 5%, Kohl's is up 2.5%. We should, however, say that all of these names, especially Kohl's, are down on the year between 30 and nearly 60%. And in consumer services, H&R Block is a big outperformer. Last I checked, it was up about 2.5%, about 2.6%. And Tyler, the banks are also outperforming. Look at the KBE. The best performers in that group right now are the regionals like First Bancorp, First Midwest, TCF, and Fulton Financial. First Bancorp up about 3.4%, Fulton up about 3%. So those are hopefully some brighter spots amid the broader sell-off.
All right. Thank you very much, Rahel Solomon. Meanwhile, chip stocks are getting whacked today. Josh Lipton is tracking some of those names. Hi, Josh.
So, Tyler, the SMH is in the red today. The ETF that tracks the chips now on pace for its worst day here since June. Some of the hardest hit in today's trade, names you all talk a lot about there: NVIDIA, AMD, Skyworks, and Qorvo. I caught up with Bernstein's Stacy Rasgon. Now, he thinks at least some of this could be due to Ciena, a company that builds optical components. Talked about weak demand due to COVID, guided below the street. Worst day since 2001 for that name. Keep in mind, though, it has been a remarkable run for the semis. Even with this pressure now, the SMH still up about 80% since its March lows. Stacy saying there are concerns, though, for the back half that chip investors do need to think about. There's evidence, he says, that demand might have been pulled forward as customers look to secure products when they could. Tyler, back to you.
All right, Josh, thanks very much. Let's knock this sector around just a bit, beginning with you, Jason. You're an owner of NVIDIA and Qualcomm. NVIDIA has been obviously one of the hottest stocks of the year.
Yeah, so I think you know, this is a little bit of indicative of some of the movement in China, you know, and some of the investment in the semi business and really jumping in there. So, you know, it's part of the pullback story on, you know, tech period, but, you know, competition also is part of that pullback. So, you know, and guess what? A lot of these names have done very well this year, you know, so I don't think people are hurting with that trade, but we'll see what happens as the months continue to come.
Jenny, you've got several names in this space as well. Applied Materials, Qualcomm, Taiwan, Teradyne.
Right. So we don't own the really high flyers or the huge PE stocks in that space, so we feel really good about what we're holding. There was an interesting point made about demand being pulled forward, and I think there are broader repercussions on that. So I don't think with our stocks we've seen, and I don't think there was likely to have been a lot of demand pulled forward, but I think that as we get into third, fourth quarter reports, and then into next year, first and second quarter, I wouldn't be surprised if we hear that theme emerging, not just in the chip makers, but much more broadly, maybe even at companies like Apple, where we do see the demand was pulled forward and holes are left in the future. So I appreciate bringing that up.
Steve, you are long quite a few names in this area.
I am. And here's what I'd say. Number one, it has been a concern of mine to see demand pull forward, not only from COVID and the work at home play, but also Huawei, where you can't do business with them after December 15th. Before the show today, I was on the phone with a very large chip company. Business is great. And 5G, while it's pulled forward, you also have a much greater awareness by companies, and they're getting into it. This is supposed to be an inflection point, the third inflection point of 5G in the last 3 years. But guess what? This one is taking. So that's going to offset, in my view. There may be some softness because of the pull forward, but Apple, you know, you pulled forward laptops. You didn't pull forward the 5G phone, which they've told their suppliers, get ready to make 75 million of these. In their best years, it's been 50 million of new phones. So that's going to continue to explode. So yeah, everything got a little ahead of itself. I think Jason's right. It's just endemic of the weakness today, but it's nothing I'd give up on. I'm not selling them. I did sell some Qorvo to get some of my exposure back, but because Skyworks has done so well. It's up from $80 on the low, where we significantly added to our position. So yeah, there's pullback, no kidding. But I think the future is tremendously bright for these companies.
Josh, final thought on the chips. You own NVIDIA, and I think it was you who on Tuesday were talking about, as Steve just mentioned, the growth of 5G, and it's not just in phones, it's in buildings and businesses, and its infiltration through the economy is going to power an awful lot of chip purchasing.
Well, the story on NVIDIA is not really 5G because they're not in mobile. There are rumors that they're going to do a deal and buy ARM Holdings. But until then, this story is about the cloud, it's about data centers, and it's about gaming. And in the case of gaming, you have, for the first time in a long time, a new Xbox and a new PlayStation, both debuting for Christmas this year. So it's a super cycle, and we see all the graphical processing units being rolled out now, and everyone's really excited about that stuff. So even if you didn't have all the other stuff like AI and autonomous driving, et cetera, I think NVIDIA and AMD would still be working this year.
I must have confused the two there because you did talk about that.
No, Tyler, I made...
Go ahead, Steve.
Tyler, I made those comments yesterday.
It was you who made the comments
yesterday.
The week blends together here, guys.
Mobile,
sorry, there's so many things to talk about. Anyhow, thanks, guys. So we're going to take a quick...
It's a fast-moving show, too, Tyler.
It's fast. It's fast. It's a fast-moving show.
But, look, I think mobile actually is the smallest part of 5G. 5G is more about... I bought a company yesterday, ticker is VUZI, not yesterday, a few days ago. They make glasses that are going to communicate through 5G, the incredible clarity in AI for an EMT in an ambulance using that glass to look at a patient, and it goes immediately to the doctor, and the doctor's instructing the EMT how to save this patient's life. They just use those glasses for a full knee replacement. Brain surgery in China over their more advanced 5G network with the patient 1,800 miles away from the doctor. Mobility is the least of it. It's the total addressable market that's exploding that's going to drive the 5G stocks.
All right, fantastic. Let's take a quick break. Traders are making some moves in this market, and we'll tell you what their new trades are next.
It's amazing to see him in the wild like this.
For those who were born to ride, there's Progressive.
PNC knows business keeps moving, and whether we connect over the phone, online, or face-to-face, we're here to help, utilizing our resources as one of the nation's largest banks and a local approach with a focus on customized insights, so you're ready for today.
Millions of people are saying yes to Allegra, including the experts. It's the #1 allergist-recommended brand for non-drowsy relief. Allegra works 2 times faster than Claritin, and while Zyrtec may cause drowsiness, Allegra won't. Say yes to Allegra.
We're thrilled to be one of the first tech companies in the United States to go public since the pandemic. ZoomInfo is here today for one reason. Not giving up is embedded in our DNA. We used our platform and 20 years of go-to-market expertise to drive value when our customers needed it the most. We are resilient, this country is resilient, and we will all move forward together.
Business Beyond the Pandemic, a CNBC Spotlight event, September 23rd. Key insight for finance executives, weathering the storm, positioning for growth. Register now at cnbcevents.com/workspotlight. Sponsored by Workday.
The Dow back down more than 600 points at this hour. Our investment pros have made some moves in their portfolios. Josh, here's one I think I've got right, and that is CrowdStrike.
Tyler, I love you. You can do no wrong in my eyes. You know that. CrowdStrike for a long time has been my favorite stock that I didn't own. And I always hated myself for having missed it, because I've been following the CEO, George Kurtz, and the story since before they came public. I pulled the trigger this morning, given the weakness that we had. I said, all right, this might not be the best possible price, but it's a better price than yesterday. I'm actually rooting for it to get lower. I'm going to add to it if it does. CrowdStrike is a phenomenal player in software security. If this entire digital transformation of our economy is going to continue, which of course it will, it cannot happen without strong security, end-to-end security. And I think the threat graph that CrowdStrike has, which makes the network better at its job of detecting threats the bigger it gets, these are classic network effect situations. And this company got Zoom as a client, and they've had several huge client wins they told us about in the conference call last night. So I think the business is on fire. This could be 10x the size of this company over the next decade. So I'm in it. It's not a trade. It's a long-term investment, and I will be buying more on continued weakness.
And I will not let you hate yourself, least of all over a stock you didn't buy. Josh, thanks.
You can't help that.
Yeah, I know the feeling. Jason, you recently bought Costco, Peloton. I did a workout this morning, and Masco. Tell us why.
Yes, sir. So Costco, man, phenomenal company. You know, margins are generally slim in the grocery business, but this was a dollar play early about a month ago, and we've kind of seen it run up. I mean, the numbers from yesterday were great. I mean, the revenues up in August for 13%. You know, e-commerce sales up 102%. Their Kirkland white label brand is doing very well. So we see continued upside there. Peloton, man, I wish I had one of those bikes, but interactive fitness is the deal. I think they'll play well into the winter months. People will eventually get back to the gyms, but I just think they have great branding and they'll continue to do well. And last one here is an industrial play that we made. No surprise, you know, their businesses, they're big suppliers of, you know, Home Depot and Lowe's, you know, so they've run well and they've cut down on some debt in the last quarter, trading at 22 times earnings. So I think they're a solid play as well.
All right, thank you very much, Jason. All right, let's tell you about a big call on the big banks. We'll debate it. We'll tell you which stocks are involved. There's a hint of what some of them are, and we'll talk about that next on Halftime.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Where the nation is on the move. Main Street's new view of the market.
It is an IPO palooza.
Where COVID hotspots are improving on the path forward. Stay connected, stay informed. Watch or listen live on the CNBC app.
Look, if you're spending countless hours with spreadsheets trying to organize your finances, you're missing out. Stop wasting time
and let Truebill do the work for you. It's the easiest way to save time and money.
Download today and take control of your finances.
We are KiwiCo, and we deliver hands-on STEM projects designed to inspire young innovators. Kids of all ages can explore science, engineering, art, and more. Get 30% off. Visit trykiwico.com. Must be 18 or older to log on.
My hair loss was a reminder of my age.
Like, is this happening to me now?
When I started first seeing results, I got excited.
I love my new hair.
It makes me feel a lot more confident.
The things I love about Roman are the simplicity, the confidentiality, and the fact that it works.
I'm a performing artist, so a healthy diet is one of the most important things. I also feel the same way about my dog. You got her Farmer's Dog sent in the mail. It's all fresh. I want my dog to have a healthy and long life. Farmer's Dog helps that out.
See the benefits of fresh food at betterforthem.com.
All right, bank stocks have been selling off this year, and Deutsche Bank says now is the time to get in, upgrading both J.P. Morgan and Bank of America to buy. It is our call of the day. It has been something of a subtext of our conversation all hour long here. Josh, you own J.P. Morgan.
Yeah, I'm in it as a total return play. I almost look at it like a bond. It's got a very high yield, a decent buyback. Not a ton of earnings volatility. They seem to be very well insulated from the types of credit risks that historically have hurt bank stocks. But I feel like it's Groundhog's Day. Every 90 days, some analyst comes out and says, "Okay, now is the time to own the banks." They could do well from here. I don't see them being market-leading stocks, maybe ever again for the rest of my life. I think they've been turned into utilities by regulations, and it's okay with me. As a total return play, I think I do better in J.P. Morgan equity or even preferred than I do in cash.
All right, Rob, your thoughts on the banks, and if I understand them correctly, obviously longer for lower interest rates doesn't help them, but you see help in the form of that cyclical rotation play that you've been talking about.
That's just to Josh's point. They make up a huge percentage of the Russell 1000 index. It's about 18% of the Russell 1000 value index. So in fact, if you get some of that rotation, they're going to be beneficiaries. I would agree with a lot of the headwinds that are still in place, not the least of which are technical. And a lot of my Twitter friends follow those technicals. And I would tell you that you don't need performance to see a rotation in the names. That's the point I made earlier in the show.
Yeah, exactly. Jenny, the big banks are not your taste. Some of the more mid-size and regional ones are. Why?
Right. I think with the mid-size and regional, you can control more and have more heavy mortgage exposure, but I think the banks in general are a really nice place to be, and Josh referenced it with better than a bond. You've got these banks trading at like 9 times earnings, 3% dividend yields, minting cash. So to me, I look at those as very favorable versus Tesla, DocuSign, Peloton that all have no earnings. And to your point earlier, Tyler, the zombie companies of 99, to me, I kind of think those are where they have no earnings. We can make arguments and everyone will beat me up over that, but I'd rather own a bank and know that I'm getting cash flow and know what's ahead of me than things where I'm just hoping on a story.
All righty, more trades ahead. Thanks, Jenny. More trades ahead. We will be back in 2.
We are Empower Retirement, and we are giving over 9.7 million people the guidance they need to help them pursue the future they imagine, making it easier for them to take action so they can focus on today while saving for tomorrow.
What if you could have the perspective to see more? At Morgan Stanley, a global collective of thought leaders offers investors a broader view. We see companies protecting the bottom line by putting people first. We see a bright future, still hungry for the ingenuity of those ready for the next challenge. Today, we're translating decades of experience into strategies for the road ahead. We are Morgan Stanley.
Wherever you start, SNHU is where you can finish.
Here we go.
And it's it.
Yay!
Southern New Hampshire University.
Like it's a hope.
Look at that! Master's degree! I did it! I did this for my children. I am very proud of myself.
Finish your degree at snhu.edu.
Now, more than ever, you need a mobile bank account that helps you earn and save more. That is unlimited by Green Dot, and it comes with the richest debit card in America. With an incredible 2% interest on your savings, that's 20 times higher than the national average, up to a $10,000 balance. And when you shop online, you earn unlimited 2% cash back. 2% interest on your savings plus 2% cash back is huge. Open an account at greendot.com. Green Dot, banking and saving made simple.
All right, everybody, welcome back to the Halftime Report. Time for the futures outlook. The 10-year yield sliding lower today despite a better than expected weekly jobless claims number, of course, ahead of tomorrow's big jobs number. For more behind the move, here's Jeff Kilberg of KKM Financial. What do you see here? How are you trading it, Jeff?
Well, Tyler, great to see you, my friend. But I am going to be a seller of the 10-year Treasury notes. Look at the December contract, Ty. The reason I want to be a seller here is I believe it's going to be range bound. So I'll be a seller right here, right now, at 139.25. Looking for a 1-point drop or 32 ticks if you used to use the pit jargon, down to 138.25. But I am going to have a stop, Ty. I'm going to have a stop at 140.09. So I'm risking $500 to make $1,000. But it's really a 1-2 punch. Why I think you should be a seller of Treasuries here. Look at today. We saw the profit taken in all the COVID-19 portfolios. Tech certainly had some selling pressure. There was no panic in the Treasury market. There's no F on the board like there used to be in the pits of Chicago. Secondly, it's range bound. I think it's tethered to 70 basis points. So that's why I want to be a seller here of Treasuries, is I think you'll see the yields go back up and the Treasury futures prices in the December contract go back down, pal.
Simply put, well explained. Jeff Kilberg, thanks. Final trades straight ahead on the Halftime Report. We'll be right back.
Futures Outlook is sponsored by CME Group and Interactive Brokers.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. A single integrated account gives you access to the world. Navigate evolving markets with confidence using Interactive Brokers' cutting-edge technology and powerful analytics platform. Interactive Brokers, now offering CME Group Micro E-mini futures contracts with small size, puts you in command. Start investing today at interactivebrokers.com.
Our retirement plan with Voya gives us confidence.
They help us with achievable steps along the way, so we can spend a bit today knowing we're prepared for tomorrow.
Wow, Dad. Do you think you overdid it, maybe?
I don't think so. What do you think, Peanut?
Nope.
Honey, you think we overdid it?
Overdid what?
See? We don't think so, son.
Technically, grandparents can't overdo it.
That's impossible.
Well planned, well invested, well protected.
Voya, be confident to and through retirement.
Right now, you have to think about the pandemic in the context of every story and every stock. Over 25% of the S&P 500 is tech. Tech has been carrying the market. Tech was made for this moment. The stock market has already factored in so much good news. Now it's time to see if it lives up to the hype. We talk to the most influential investors at the most important time. This is a financial crisis, an economic crisis, and a health crisis, all wrapped into one. At CNBC, we deliver the market insight you really can't get anywhere else.
Good morning, everybody. How you doing?
Here's a hint about how to make working from home less stressful and more comfortable. Make the switch to X-Chair. No matter where you put the amazing X-Chair, it instantly becomes the most comfortable place in any space. Infinite side-float recline and dynamic variable lumbar support make the X-Chair a customer favorite at home and work. Don't forget, the X-Chair lets you customize for the same measure of amazing comfort no matter what your size. And every model is in stock, ready to ship the next day, so you can join the thousands of others who have discovered the joy of working in comfort. Once someone sits in an X-Chair and feels the amazing DVL support, it's almost impossible to get them out of it. But don't worry, you don't have to share, because there's an X-Chair for everyone. And you can get $100 off any model on our website. Your new normal? Incredibly comfortable. Call or click to order today and receive a 30-day risk-free trial and $100 off.
Geico's been helping people save money for over 75 years. They've really stood the test of time, much like these majestic Rocky Mountains, which must be named after the rock.
That would be Rocky the Flying Squirrel, Mr. Gecko, sir. Obviously.
Come on, Bullwinkle. They're named after...
First President George Rockington.
That doesn't even make any sense, Mr. Winkle.
Geico, over 75 years of savings and service.
The Martins here
just realized they outgrew their home, so they used Rocket Mortgage to finance their next one. Need to know if your next home fits your budget and your family? Rocket can.
I'll keep working my way back to you, babe, with a burning love inside. Yeah, I'm working my way back to you, babe, and I happy
Service Now, the smarter way to workflow.
HelloFresh recipes are so easy. You can get dinner on the table in about 30 minutes.
Yay, I love it.
Now we're actually able to have some quality time on a weeknight, which is awesome.
Go to HelloFresh.com and use code TV80 for $80 off, including free shipping.
Well, on this big sell-off with the Dow now down 700 points, the so-called work-from-home stocks are getting hit hard today. DocuSign among them reports earnings after the bell today. Jason, you own that one, and you also recently bought Peloton, which is selling off. I lump that in with the kind of work-from-home, work-out-from-home phenomenon. What do you think of DocuSign first? And obviously you like Peloton.
Yep, I have a difficult day on those trades today. But what I will say, as far as DocuSign goes, I think they're a generational change business. Everyone wants to agree easier. I think it's some profit taking ahead of the bell. I do think they'll report well, but I think it's going along this theme of, the last few days, with tech selling off. So I think that's where I am on those positions.
All right. Josh, you own Zoom.
Yeah. I agree with Jason, and we have to stop calling these work-from-home stocks. They're work-from-anywhere stocks, and work-from-anywhere is forever. I run a wealth management firm with 1,100 clients, 32 employees. Before the COVID pandemic, more than 50% of my employees were remote, and we were using Zoom. Before the pandemic, 70% of new accounts that were coming to me were from outside of New York State, and we were using DocuSign. So we need to stop with that nomenclature. It's incorrect. The work-from-anywhere stocks can work far beyond the time we have a vaccine.
Yeah, it is the present of our work, I think. These technologies have really made possible and have been catapulted by the pandemic. All right, last minute, time for final trades. Once again, drunk with power, I get to decide who goes first. Mr. Weiss, you've been quiet for a few moments. Go ahead.
You're using your discretion wisely, too, Tyler, coming to me first. I have no final trade today. And the reason for that is that we've got a big employment number coming tomorrow. It's going to overshadow, good or bad, any stock that you put on right now to trade.
So Weiss has nothing for us. That's for the first time in his life, he's got nothing.
That's why you use your discretion wisely.
Jenny, we got to pick up some speed. Go ahead. What's your final?
Oh.
No problem. Lamar Advertising, wherever you drive, you're going to see their billboards. They should benefit from people driving more. They may also benefit from the political season getting heated. It's got a 3% dividend yield and trades at 12 times earnings. This market is not going to shake this one out.
Rob, quick like a bunny.
XLI, industrial sector, ETF, benefiting from that rotational trade. 3 positive months of ISM and the best since January of 19.
Jason?
Cryoport, life sciences, transport, and logistics leader, just secured a huge investment from Blackstone last week. I think there's upside there.
Josh, quick thought.
CrowdStrike.
CrowdStrike. There you go. That does it for halftime, folks. Great being with you all this week. And that does it for today. The Exchange with Kelly begins right now.
Tyler, thanks, and I'll see you again shortly. Welcome to The Exchange, everybody. It's been 3 months since the markets have seen the kind of action that we're seeing today. Dow's down 788 points, so we're near session lows right now. The day started relatively quiet. In fact, the Dow was up about 100 points in earlier trading. But as the morning went on, the selling accelerated, and the tech darlings in particular that have led this massive rally to the upside are now leading this sharp move lower. There's the NASDAQ down almost 5% right now. In one day, the NASDAQ is down almost 600 points after just poking above 12,000 yesterday. We're going to look at why this sudden change in confidence. Let's start with Dom Chu, though, for a look at exactly where we stand right now. Dom?
All right, so Kelly, let's take a look at the at least markets as we stand, because we are right near the lows of the session so far. You mentioned the Dow's low so far today, about 808 points. The S&P at its lows, we're down 127, so down 125. We're hovering right there. And, of course, the NASDAQ composite, really the underperformer today. It's down about 5%. If you take a look at the NASDAQ overall, this is a year-to-date basis. You've got to go all the way back to the pandemic lows, a huge move higher. This right-hand side of the chart and that little down move there represents a 5% drop from the record highs that we saw just yesterday. So to put it all in context. Now, with the broader markets, you're seeing weakness fairly across the board, but some outperformance in what's happening with energy prices. Relatively flat right now for that sector. Utilities holding up as well. Meanwhile, the technology sector, consumer discretionary and communication services, the real laggards there. And as for the stocks that have been really leading to the upside and now leading to the downside, look at these names: Zoom Video, Apple, and DocuSign. Every one of those has made a record high, sometimes in a parabolic upside move just this past week. They've now led to the downside here. And remember, DocuSign out with earnings reports later on this afternoon ahead of a big jobs report tomorrow. A lot of things working right now. We'll see if this market at least tries to stabilize heading towards the closing bell, Kel. I'll send things back over to you.
All right, Dom, we'll see you again in a moment. But first, let's get over to Rick Santelli for a check on the bond market right now, with yields moving lower and that all-important yield curve flattening a bit. We don't like that. He's watching all the action in Chicago for us. Hi, Rick.
Absolutely, you're correct on all scores. What's going on? I talked to my sources. Big data, big number tomorrow. Rebalancing with tail hedging and obviously some of the stay-at-home stocks. But remember, at these levels, every sell-off is contagious. Look at an intraday of 10s. Briefly was trading right around 60 basis points, which is 10 basis points above open the chart up to early August. Our all-time low yield close from the 4th of August, basically at 50 basis points, half of 1%. As for the yield curve, Kelly nailed it. Yes, they're flattening, 10s minus 2s under 50. And let's take a wide curve trade, 30s to 5s. It's gone from 123 down to 110 in basically 3 sessions. And finally, it doesn't end there. And keep in mind, the dollar is virtually unchanged after a small bounce from 28-month lows several sessions ago. But commodity prices are getting hit pretty much across the board. Let's look at corn, copper, and gold on an intraday chart. You can see what I'm talking about. Kelly, back to you.
Rick, stick around for just a moment, if you would. We have some breaking news from the Fed. Chicago Fed President Charles Evans speaking right now. Steve Leisman has those details. Steve?
Kelly, thanks. Chicago Fed President Charles Evans saying that a new Fed action could be coming pretty soon. He expects, quote, outcome-based guidance where the Fed pegs changes in policy, specifically to hitting certain economic targets, as well as new quantitative easing. He says that could soon be beneficial. Very explicitly saying it could happen soon. Who knows if he means September specifically, but perhaps he does. He goes on to say the lack of fiscal action or fiscal aid represents a, quote, very significant downside risk to the economy, and it puts vulnerable households and businesses at risk. He is forecasting a strong third quarter rebound, but ultimately sees the full year ending 5% below the pre-crisis level. Some other details on his economic outlook. He says the return to the pre-crisis level doesn't happen until later in 2022. Unemployment will be around 9% by the year end. The unemployment rate will hit 5 to 5.5% by end 2021. So it takes a while until we get there. Finally, inflation he expects to be under 2% for some time. One other comment he talks a lot about is the human and economic toll, he says, both on kids and on parents and on the broader economy, is very large from not opening schools. Kelly?
And yet, Steve, not much of a response in the market. 858 points. We were down a moment ago, down about 830 right now. So very close to session lows. Rick, I'll ask you about that. This attitude by Charles Evans, you think already priced into a market?
I think the Fed doing anything and everything it can. It's never going to look at this as a half-full glass. It can't. It has too much stimulus and too much at stake. From the Fed's perspective, it's a binary decision on its part, and I think that they're erring on the side of too much. You know, there's a lot of political issues here as to the next stimulus program, and I don't disregard what Steve's thinking. There are people that are hurting. But But it's my geranium quote. You know, the geraniums that need water a mile away, and the Fed's fire hose is a very crude way to deliver some of that needed liquidity.
That one I hadn't heard yet, Rick. Let me bring Steve back in for some additional context here, Steve. How significant is it for someone like Charles Evans to say new action could be coming pretty soon, a new quantitative easing he's talking about, and his concern about the lack of action on the congressional front isn't new, but this sort of more specifics about the Fed's next steps seems to be.
So just a little preface here. I read about 10 or 15 of these speeches a week and talk to a bunch of these guys and women. So it explains a lot of my psychological problems, but more so, I can't remember the other person who just was another one who seemed to suggest that coming in September, the Fed may be announcing additional quantitative easing. I bring that up, Kelly, because it's significant that Evans is not alone. There seems to be additional signals. Maybe it was Brainerd, the Federal Reserve governor, earlier this week, who signaled more stuff is coming in September. I think the mark that may be being built into the market, and the issue being there's not just a few geraniums being hurt. There's a lot of bushes and trees in substantial parts of the landscape that seem to lack water. Kelly, this morning, we learned that there are 29 million Americans receiving some form of jobless benefits. Yes, the initial claims improved, and that number is from the only number we can get, which is from August 15th, the latest data. There's a lot of hurting Americans, and it's more than just geraniums, and they're closer than just 100 yards away.
All right, well, we will leave the analogy there for right now. Steve and Rick, thank you both very much for the latest Fed headlines and the latest moves in these markets. Now, to put today's sell-off into context, take a look at the market action since the bottom in late March. The Dow and the S&P are both up more than 50% since then, and the tech-powered NASDAQ has skyrocketed more than 70% in the same period. That movie playing out in reverse today, with the NASDAQ leading the decline. For more, I'm joined by Neil Hennessy, the Chief Investment Officer at Hennessy Funds, and Samir Samana, Senior Global Market Strategist at Wells Fargo Investment Institute. Welcome to you both. Neil, is the worm turning here?
No, I don't think so. I mean, look, I know it's a big number, 900 points, maybe 1,000 points, but, you know, the market was at 29,000. It's risen very quickly. The S&P 500, if you look at it, has really been controlled by 4 to 6 stocks. As of the beginning of the week, the NASDAQ was up 31%. But if you took out Apple, Amazon, Google, Microsoft, Tesla, Facebook, next thing you know, instead of being up 31%, the NASDAQ would have been up 10%. And so you start to look at where is the money moving to. We've talked in the past, Kelly, that it's going to move out of this high-tech, high-growth arena into more stable, long-term companies that have been around and will be around for a long, long time.
And I know some of your favorites right now are Whirlpool, Toll Brothers, Crown Holdings, and you can see they're kind of the bend towards housing and the spending that we'll circle back to. Samir, let me bring you in with some thoughts on the sell-off. And, you know, it's interesting because in a way you could say, look, if the stay-at-home names, so to speak, are underperforming, if the reopening trade is outperforming, you know, that all sounds great, but then you have bond yield slumping, you have the yield curve flattening. So how would you kind of tie this all up?
Sure. So we would maybe take a little bit of the other side of this to us. This is more of an interruption as opposed to a change in trend. So, you know, this probably was long overdue, right? When you start to see stocks rally into stock splits, right, which basically shouldn't be anything other than an accounting phenomenon. That always worries us a little bit. So, you know, did note that maybe things were getting a little frothy, but we like technology. It's our most favorite sector. We like consumer discretionary. We like healthcare. We like communications. We think a lot of these trends are here to stay, and those low bond yields only make those cash flows that a lot of these companies are bringing in hand over fist a lot more valuable. And I don't think it surprises us one bit that the Fed stands ready to do more. And if anything, that's what the market's been incorporating over the last few weeks, is exactly what multiple to play. And it kind of keeps coming back with probably a little bit higher than we expected because the Fed's going to be there longer than we expected.
Neil, how would you respond to that?
I'm in agreement. I mean, it's just a blip in here. The long-term picture, habits are changing, Kelly. There's a lot that's happening. I know that the small caps have really run, but you know that's a whole different ballgame from the standpoint. If you look at the Russell 2000, You're looking at the top 4 companies. 3 were gambling companies: Penn National, Caesar, Churchill Downs, and the 4th largest in that is Novavax, I think it is, which is a pharmaceutical company working on a vaccine. But they've gone crazy. The real market, and I think where the money should be going, is into the mid-cap market, like our, the Hennessy Mid-Cap 30, where we have truly mid-cap stocks that can actually withstand an economic tsunami, but big enough to buy a small cap, micro cap, but also large enough to be accretive to a large cap. And that's where I think people should be putting their money.
It's interesting because you're now the 3rd person in the last couple of weeks who said to look at the mid-cap part of the market. So clearly people are kind of landing in the same place on that. Samir, I'll turn back to you. And for many, many people who are asking themselves right now, should I be bailing out of tech for the foreseeable future? I mean, you stated earlier that you think the previous trends are going to resume, but is the momentum going to be so powerful to the downside that it overwhelms the fundamentals?
Sure. So, what we would encourage is that investors do not get carried away with the momentum, right? So they really should be thinking on an intermediate basis, right? So at least 12 to 18 months. And if they're thinking, on an intermediate term basis, then a lot of these issues will kind of, solve themselves. You mentioned that, these are really retracements of very sharp moves. So again, we've seen, periods like this before. We saw one in June. It took about a week or 2 to kind of resolve itself, and then we kind of got back to doing what we were doing. So from that standpoint, this is not the time to bail out of tech. If anything, people should have that shopping list, and if they aren't favoring technology, it could be a really interesting opportunity over the coming weeks because, again, the elections, maybe even COVID cases, they may lead to some volatility. But again, if you think 12, 15 months out, it's hard for us to see an equity world that's not a little bit better than it is today.
All right, we'll leave it there. But Neil, before we go, I do want to ask you, what would you say to somebody who has owned Tesla for the last couple $100 and is trying to figure out what to do next?
I mean, well, they did the 5-for-1 split, which was good, and then with the drop in the price now, Kelly, it's selling a little under 900 times earnings. I'm not an economist, I'm not an analyst, but 900 times earnings? Make up your own mind on that one.
Understood. Tesla's down another 7.5% today, almost 20% this week. We'll leave it there. Thank you both, Neil Hennessy and Samir Samana, for sharing your thoughts about this market. Still ahead, we're going to have a lot more on the sell-off as the tech winners get hammered today and the market darlings like Tesla. Facebook is on pace for its worst day since June. This after the company announced a ban on new political ads for the week before the election. And the cloud companies, which have been market darlings, also falling hard. Among the worst cloud era, sinking 11% despite an earnings beat. PagerDuty is plunging 28% after disappointing results. We'll dig into it next.
A new laxative that's both gentle and fast.
New great tasting Dalcolac soft chews works naturally with the water in your body in as little as 30 minutes. Puts you comfortably in control. New Dalcolac soft chews.
Online dating? I know people meet that way, but where would I even begin?
Open laptop, go to OurTime.com, look for free. It's easy to take a look on Our Time, the fastest growing dating site for people over 50.
Knights go K5, you are clear for landing.
Roger. Roger that. Knightscope K5, reporting for duty.
To learn more and schedule a demo, please visit us at www.knightscope.com.
The nation's jobs picture. Did the resurgence of the virus catch up with the resurgent job market? Or did business reopenings put more Americans back to work? August numbers tomorrow on Squawk Box. And now watch Squawk Box anytime on demand.
In today's climate, you need to evaluate all financial options. Consider a balanced transfer card. By utilizing a 0% APR, you'll pay down debt faster and keep your credit score intact. Explore your best options. CNBC Select, the stories you need for the smartest way to handle your credit.
we deliver high-quality meat to your door. What happens next is up to you.
This is cellulose acetate, a plant-based material that's not only extremely durable, but also quite flexible, making it ideal for Warby Parker glasses, which, by the way, start at $95, including prescription lenses. Try 5 pairs for free at warbyparker.com. Oh yeah, about those prescription lenses. Warby Parker glasses come standard with custom-cut polycarbonate lenses that have been treated with scratch-resistant and anti-reflective coatings. Nice. Try 5 pairs for free at warbyparker.com.
Welcome back from social media to the cloud companies. Tech is getting clobbered on all fronts today. Let's start with Facebook. Shares are dropping after the company announced it will not allow new political ads a week ahead of the election. Shares off a little less than 5% this afternoon. The cloud companies, which have been recent investor favorites, are getting hammered. The cloud ETF is down 6%. PagerDuty for one, Cloudera both taking it on the chin. PagerDuty dropping 28% after disappointing earnings and guidance. No different for the chips today either. There's some of the worst names in the S&P 500. The SMH, their ETF, dropping about 5.5%. NVIDIA, a recent high flyer, down about 9% today. Joining me now to discuss all of this, our own Julia Borston and John Ford. And John, I mean, we've seen a little bit of this the last couple days, but it's really accelerating now.
Yeah, on the cloud, I think some of what happened is investors weren't discriminating between different segments of cloud, which you and I have talked about before. I mean, when Salesforce had strong results and then Workday, names like PagerDuty got bid up, but PagerDuty is in the DevOps space, which is different from software as a service, maybe more connected to enterprise spending patterns. And, you know, PagerDuty talked about that on earnings. Yes, it dropped. It's still up for the year. And frankly, I think people might be overdoing it on the downside to some extent. It's similar to how they overdid it on the upside.
Elaborate on that for 1 second. So is it possible that what they said about enterprise or, you know, corporate spending patterns has spooked the whole market?
Well, I think we already knew that the enterprise was having trouble, but they also said that the trends improved throughout the quarter, and they talked about the continuing need for their services, the way that they are targeting kind of larger, medium, and larger sized companies, the plans they have to increase their selling capacity going forward. I don't know that investors are necessarily listening to the granularity of that message versus freaking out that they're not Salesforce.
Right, exactly. Salesforce, of course, being probably the best outperformer lately, including or especially in the Dow. Julia, same kind of question. I mean, if there's, you could say these are some catalysts on the software names for their sell-off and the social media names. I mean, am I supposed to believe this has anything to do with Facebook's announcement about political ads this morning?
I really think it does not have to do with Facebook's announcement about political ads. Facebook has just said that it's not going to allow any new political advertising in the last week before Election Day. So we'll see the candidates still be able to run political ads that they had started before that week starts. And this really, Kelly, is just a tiny piece of their overall pie. Political advertising is very small, especially if you're just talking about 1 week of political advertising. Facebook generated $17 billion in revenue last quarter. So really just a drop in the bucket. I think what we're really seeing here, Kelly, is that Facebook and these other social media stocks, which are trading down today, you know, Facebook and Twitter both down about 4.5%, Snap off 1.5%, Pinterest off about 7%. These stocks have gone way up in recent months on a confidence that revenue, ad revenue is going to be shifting over from TV and other formats into digital, confidence on how these companies are going to really benefit from e-commerce. And I think the stocks have just had a huge run.
Yeah, and John, that's why we can talk about the fundamentals of what PagerDuty and Facebook and Pinterest, which is also making some moves on the political ad front, said today. But we also just know that when stocks start to go up really quickly, you've got to watch out. I mean, it can't continue forever. There's one fundamental factor that's not at play here today, which is interesting to me, and it's higher interest rates. You know, a lot of times when rates start to move up, people say, watch out for the high valuation names, watch out for momentum. But even that is not the catalyst today because rates are down, so we're still in search of one.
Yeah, I think when stocks go down, we start soul searching. We don't nearly do it as much when stocks are going up. So I'm not sure how much we want to put on one day. I just do want to say this about the Facebook thing. I don't think they're going to make any less money with this moratorium on new ads for the last week. I expect that 8 days before the election, a lot of these organizations' campaigns are just going to put extra ads into the system and then maybe not start paying into them until a couple of days before the election. It doesn't say you have to put the full spend behind those ads as soon as you put them in, but hopefully Facebook and others will be able to vet those ads over that period of time and make sure that nothing egregious happens right before people are voting in person.
It's a little odd to me because it's almost admitting responsibility or fault, and so if that's going to be true for a week before the election, then why shouldn't it be true more broadly? But Julie, if you want, quick last word on this.
Well, yeah, just Kelly, it's interesting because, you know, Mark Zuckerberg is committed to free speech, but there's also this line between not only preventing manipulation and potential voter fraud, but also really trying to prevent hate speech on the platform. This is just one of many issues that Facebook and Mark Zuckerberg are dealing with right now. You know, they had to deal with Australia trying to create a law mandating how they pay for news content. They have the antitrust investigation, and then, of course, they have these risks around hate speech and incendiary content on the platform. So this is just one of many things that Mark Zuckerberg is thinking about ahead of the election.
Anything, John, that you'd throw into the discussion as we look at the chip names, which, as I mentioned before, is really in the bottom of the S&P 500 today?
I think fundamentally the question is how quickly are markets and economies opening up and how much are enterprises spending? And there are some positive signals along those lines, but it's coming from a depressed base.
Yeah, and then you have cruise stocks, you have airlines, hotels. I mean, they're outperforming today. So it doesn't make sense to me that it's either part of the reopening or closing trade. It just feels like tech is up 70% since March and maybe taking a breather. Guys, thanks. We'll leave it there for now. John Fort and Julia Borston all over this big sell-off for us. Still ahead, we'll look at shares of Tesla, which are down 17% in 3 days now, adding another, or I should say the 7%, or nearly 8% portion of that coming today. The company offering new stock to raise capital, its largest shareholder trimming its position. Is all that getting investors worried? We'll dive more into that. As we head to break, take a look at some of the names that are bucking the trend today. Moderna up 1%. They're obviously a big COVID vaccine candidate. Macy's up 10%, the best performer in the S&P right now. Other retail names not doing terribly. Beyond Meat up 1% as well. We're back in 2.
This is what it's like wearing regular shoes. No all-around support. And this is what it's like in Skechers' new Arch Fit footwear. It's all the comfort and support you need.
Refill, snacks, hot towel.
It's good to have support. Try Skechers Arch Fit, podiatrist-certified arch support.
Silver American Eagles have become some of the most desirable coins for investors looking to acquire precious metals. Investors who acquire this coin do so for the value and diversification that silver brings to an investment portfolio. And now, with help from Monex, you can begin investing in Silver American Eagles. Monex has account representatives standing by who will answer your question about investing in Silver American Eagles and any other silver coin available from Monex. Call Monex now or visit our website where you will see all of our silver products available for investors like you along with live up-to-the-minute prices. Call right now and discover how simple it can be to have your pure, high-quality Silver American Eagles delivered to you or stored for you in an independent third-party vault. Call, learn, and invest with Monex, one of America's trusted names in precious metals for more than 50 years.
Mr. Wonderful here. It's hard for everyday people to get access to startup investments. But with Start Engine, you can choose between hundreds of startups to build your portfolio. It's your turn to become a shark. Visit startengine.com today.
My reputation was trashed online. I felt completely helpless. My entire career and business were in jeopardy. I called Reputation Defender.
Take control of your online reputation. Get your free reputation report card at reputationdefender.com. Find out your online reputation today and let the experts help you repair it.
They were able to restore my good name.
Visit reputationdefender.com or call 1-877-866-8555.
Welcome back. Stocks are still deep in the red this afternoon with the major averages on pace for their worst day since June. Let's head to Dom Chu for a look at where we stand right now. Dom?
All right, so we bounced ever so slightly off the lows of the session so far. Still, though, we have all three major indices in negative territory. The Dow right now down about 777 points. The S&P off by 121, and the NASDAQ really pacing the declines, down nearly 5%. About 563 points to the downside there. With regard to the picture shaping up for what industries or sectors are specifically in focus right now, the outperformance has been, believe it or not, in energy, which is kind of strange to say on a down day like this, but financials also outperforming as well as our utilities. Meanwhile, no surprise, technology, consumer discretionary, and communication services are the real laggards there. Many of those mega cap technology or internet names as part of that picture. Speaking of that technology picture, semiconductors, that industry hit a record high just yesterday. Now, we've pulled back NVIDIA, one of the big reasons they're down 9%. Cloud computing-based companies like ServiceNow off 6% as well. And Salesforce, after that huge earnings beat, that particular stock down 6% as we look at enterprise software. And one more theme to keep an eye on, Kelly. As we look at the movements between more momentum-oriented stocks versus those that are considered more low volatility, look at that outperformance. On a year-to-date basis, the momentum stocks up about 18.5%. Meanwhile, low volatility stocks down about 1%. You can see here at the very end a converging a little bit of that trend. We'll see if that momentum trade continues. It'll be a key to watch, Kel. Back over to you.
Yeah, that's probably the chart of the year. Dom, thank you very much. Let's get to Sue Herrera now for our CNBC News update. Sue?
Thank you so much, Kelly. Here's what's happening at this hour, everyone. Tyson is planning to open medical clinics at some of its food plants early next year to improve the health of its workers and protect them from the virus. The meatpacking industry has been especially vulnerable to COVID infections. Authorities in Madrid shutting down a coronavirus testing center for teachers after that facility was overwhelmed and unable to maintain social distancing. Spain is screening all of its teachers for the virus as its academic year kicks off next week. TikTok has launched a marketing program to attract more advertisers with tools to measure the success of their campaigns. This comes as Oracle and a joint effort between Microsoft and Walmart bid for TikTok's U.S. operations. And 1 million students in Wuhan returning to their classrooms today as schools reopened there for the first time in 7 months. Local officials reporting no local infections since May, despite COVID-19 originating in that city. You are up to date. That's the news update, Cal. I'll send it back to you.
All right, Sue, thank you very much. While the major averages sink today, cruise lines are a relative bright spot. Carnival announced certain boats will be back on the high seas as early as this weekend. We'll have those details next with the NASDAQ down 4.5%. There's Carnival up more than 6%. We're back in 2.
Do you have a life insurance policy you no longer need? Now you can sell your policy, even a term policy, for an immediate cash payment. Call Coventry Direct to learn more.
We thought we had planned carefully for our retirement.
But we quickly realized we needed a way to supplement our income.
Our friends sold their policy to help pay their medical bills. And that got me thinking. Maybe selling our policy could help with our retirement.
I was skeptical, so I did some research and called Coventry Direct. They explained life insurance is a valuable asset that can be sold.
We learned we could sell all of our policy or keep part of it with no future payments. Who knew? We sold our policy. Now we can relax and enjoy our retirement as we had planned.
If you have $100,000 or more of life insurance, you may qualify to sell your policy. Don't cancel or let your policy lapse without finding out what it's worth. Visit CoventryDirect.com to find out if your policy qualifies or call 1-800-514-7800. Coventry Direct, redefining insurance.
Hey, did you?
Yep, done.
And the?
Of course.
And?
Oh, yeah.
All in one
hour.
Behind the world's most productive people is the world's most comfortable chair, the incredible X Chair, featuring patented dynamic variable lumbar support. X Chair's adjustable seat depth keeps users small to tall, comfortable and supported. Available in breathable mesh, HDR foam, or top grain leather. Customize comfortable positions for your neck and arms. And X Chair's patented SiFloat Infinite Recline provides the perfect recline for users of almost any size. This is not your grandfather's office chair. X-Chair supports workers everywhere who find themselves now working from home. Call or click to get $100 off the amazing X-Chair featuring dynamic variable lumbar support. Plus, for a limited time, you can also get free same-day shipping. This deal is good for any X-Chair you choose. Create the world's most comfortable home office with X-Chair. Call or click to order today and receive a 30-day risk-free trial and $100 off.
Players all fighting to become champion, but only one can win the ultimate prize. History will be made here at the Tour Championship, Sunday on NBC.
Welcome back. Let's drill down on today's sell-off, figure out what's behind the Dow's 754-point drop right now, with the NASDAQ by far the worst performer. Mike Santoli is here with some analysis on the market's rapid reversal. Phil LeBeau is going to look at Tesla's big drop over the past 3 sessions for us. Seema Modi looking at the COVID-sensitive hotel and cruise names with several bright spots today. Kate Rogers looking at the reversal in food stocks. So, Mike, let's start with you. Is there anything to attribute this reversal to?
Well, Kelly, more than anything else is the strength of the market and this sort of acceleration to the upside we had in recent days. So we did have a stampede of buyers in the stocks that were already the strongest, so the high momentum stocks. And that stampede seemed to corner itself after a little while, after pushing those stocks, which had really been driving the NASDAQ for a while, too much. I don't think there's anything in particular. There were some cracks this week when Apple couldn't build on those gains after the stock split. Tesla's share issuance definitely was an opportunity for people to take some profits there. And that seemed to spill into general risk appetites. There's some other stuff going on in the options market, which basically just shows over-aggressive short-term upside bets that are now being unwound. For perspective, the NASDAQ 100 was up 14% in 3 weeks going into yesterday, giving back 4% of it.
Yeah, and we rattled off some of those stats yesterday. We were more than 20% above the 200-day moving average. The relative strength index was over 70. I mean, you don't need a PhD to figure out, yeah, it's looking a little overextended. So Mike, what do we look for as a kind of soft landing versus hard landing data point? Well,
if the NASDAQ is to have a relatively routine pullback of the sort that it's had 3 or 4 times since the spring, it would be another 3 or 4% to the downside, and then you would look for the market to get a little bit of support there. We obviously get a jobs report tomorrow, so I do think looking for clues that the market is responding to the macro situation as opposed to just, you know, kind of its own internal rhythms, which it's doing right now, might be something. To that end, there's a big rally in Treasury, so obviously yields down a lot, but the corporate debt market is not unsettled at all, really, by what's going on in equity. So that's a net positive that suggests maybe it is just kind of a positioning and sentiment kind of gut check for equity.
Plus, Mike, you only have 2 out of 3 things to make a story right now. So if it's you know, the macro is slowing, COVID is getting worse, well, I'm sorry, but the cruise, hotel, and airlines are outperforming today. You know, if
the action's not consistent with an idea that it's an economic scare today. The banks are up.
Exactly. So, you know, I would imagine even if people are nervous about the jobs report, if they're, you know, worried about what's going to happen next with the Fed, then that explained to me why the reopening trade has legs.
That's exactly right. So it's really not a consistent narrative, at least running through here. Best explanation is taking some off the top. Even the S&P 500, by the way, we're back to levels of like 8 days ago now.
Right. That's fair. It's gotten quite momentum driven lately. Mike, thank you. Let's turn to Phil, talk about Tesla, which, Phil, this is emblematic. This is the market darling. Stock's trading at 900 times forward earnings, like we were just talking to Neil Hennessy about. Look, Tesla's the one place where you could say there has been a catalyst the past couple of days, the stock split, and then this share offer.
Right. You could look at that as a catalyst, but in terms of the sell-off over the last 3 days, there's nothing that you can point to and say, aha, that is exactly the reason. I think it hit $501 a share sometime intraday on Tuesday, if I'm not mistaken. And since then, look, it's pulled back all the way back to $410 a share. But keep in mind, this is a stock, if you go back to the beginning of this year, it's up approximately 400%, something like that. So it has this resistance, and Mike has talked about this a little bit today, that there seems to be this resistance between 405 and 410. At least we saw it yesterday, seeing it again today. And in terms of its market cap, Tesla is now below $400 billion, but at 385, 86 billion, wherever they're at right now, still have plenty of market cap relative to what they're looking to do. And by the way, I've had a few people suggest, well, this sell-off is because they raised $5 billion through another share offering. I don't know if you can attribute this to that. I mean, the stock didn't really move initially when that was announced. It really has picked up momentum with the rest of the market.
Yes, and it would be odd if Tesla's share offering was the reason why cloud stocks were, you know, falling big and the chip names were selling off as well. They have Battery Day coming up. I mean, anything else on the horizon here that could change the story?
You've got three major data points. You got Battery Day, September 22nd. Then between October 1st and 3rd, you'll get the Q3 deliveries. And then at the end of October, early November, that's when you get the third quarter financials. Those are the three really big data points that are out there.
Well, at this pace, it's going to be a long time to wait. We'll see how the action continues from here. Phil, thank you, sir. Phil LeBeau. Let's turn to the leisure industry now. You'd think on a big down day like today, the cruise stocks would be deep in the red, but no, they are afloat. In fact, Carnival and Norwegian are the S&P 500's best performers. Seema Modi is here with more on what explains this. Seema?
Kelly, it's not often you see cruise lines outperform on a down day. Carnival, though, setting sail this weekend. 2 cruises out of Italy. For now, only Italian citizens are being allowed on those ships. COVID diagnostic tests will be provided for all guests. For Carnival, the Italian market is such a small piece of the pie, but the hope, at least for the market, is that if all goes well and the ships remain COVID-free, then these protocols that they're using on board will serve as a model for U.S. cruises. But from my reporting, the discussions between the cruise lines and the CDC still haven't made any meaningful progress this summer, so unclear whether Americans, you and I, will get to sail this fall. For now, you're seeing a lot of that hope, though, being priced into shares of the cruise lines.
And I could even paint a coherent market picture that said, well, the cruise lines are bucking the trend because they have had industry-specific news, but the hotel names, the airlines, for one, I mean, even there you're seeing small gains today, which tells you this is not kind of a, COVID is spreading, we're shutting things down again story. What is going on with the hotel stocks?
So the hotels, as you say, not down as much as the broader market, but year-to-date chart will tell you the real story. A lot of that negativity has already been priced into these stocks, and now there's further warning signs, which is delinquencies are on the rise. 2 weeks ago, Kelly, you and I were discussing a short list of New York hotels that had missed their debt payments, so 30 to 60 days out, and at the top of that list was the Hilton Times Square. Last night, the owner saying that they are closing. They're shutting their doors there, 200 jobs going with it, and now the focus turns to some of the other hotels that are delinquent. The Standard and the Meatpacking, the Mark and the Upper East Side. In total, 34% of New York hotels are delinquent, and that number actually rises in other urban markets like Chicago and Houston, which is also getting hit by the weakness it's seeing in the energy sector. So now the focus turns to not just the hotel brands, which use that franchise model. They collect that fee every time that hotel brings in more revenue, but also the real estate investment trusts that own the underlying asset.
Great point. And Seema, you mentioned some pretty iconic New York City names there, especially the Standard. But I guess what we can say from today's action is that the news, while troubling, is to some extent reflected in the share prices already today.
Yeah, I mean, you look at where these stocks are trading in comparison to a year ago. It's been a really tough story for the hospitality industry. A lot of it's already priced in, and plus, they continue to knock on the doors of Congress saying we want a relief fund for the commercial-backed securities, and they still haven't gotten that level of approval from Congress yet, which is still a big concern.
That's a great point, and maybe investors hope that something could be coming down the pike. We'll see. Seema, thank you very much for now. Appreciate it. Seema Modi walking us through what's happening in the all-important leisure sector. Let's check in on the restaurant stocks, though. Different story today. McDonald's, Chipotle, Papa John's, some of the best performers this year, all taking a breather today as the industry as a whole is facing a labor shortage, as noted by the Beige Book yesterday. Kate, let's start with the stocks. What's driving this action?
Hey, Kelly, well, you just mentioned that a lot of the stocks that have really outperformed year to date and during the pandemic in particular are taking a breather today. Wingstop down around 5.5%. Chipotle, Papa John's down around 4%. Domino's down 3%. McDonald's and Starbucks performing a bit better, but both down between 1% and 2% each. As you mentioned, not related to this sell-off, but more broadly within the restaurant industry, there is a labor shortage starting to develop. The National Restaurant Association actually said that 40% of restaurant operators that responded to a recent survey of the group's members said that they added employees to payroll in July and August, but that 77% said that they had difficulties either bringing back their employees or finding new employees. So that's definitely an interesting trend, because you have to remember 8 million workers were either completely fired or furloughed from March through May, according to the National Restaurant Association. So there's been a ton of job losses here. And now you're seeing some trouble trying to bring workers back on.
Is that because of safety concerns? Because I would imagine in a soft labor market that, people would say, look, I don't want to take the risk, but if I have to, I have to.
I think there are definitely a few things at play here. One, obviously safety concerns, and that's why you're seeing a lot of the big publicly traded names come out and say, hey, this is what we're doing to make it safe, not only for you as a customer, but also for workers to come in here. There was also enhanced unemployment benefits. The NFIB said that about a third of its members said that that extra $600 a week did make it more difficult to bring workers back on. That's not restaurant specific, but it is small business specific. And one other thing to remember, if a restaurant's operating at 25 or 50% capacity, is it worth it for you as a server to go in there and work? Will you make as much money in tips? You know, there are many, many different things tied to the pandemic, I think, that are kind of factoring into some of these labor decisions and potentially making it more difficult for workers to be brought back on.
Yeah, and if they have other options, maybe they can look elsewhere. Like you said, if it's not going to be worth it economically on top of everything else. I've seen the signs up all over town looking for people to hire. It is an interesting feature in this. Kate Rogers, thank you, ma'am. We appreciate it, giving us the restaurant lowdown. Well, the NASDAQ is on pace for its worst day since June 11th, and tech is the worst performing sector today. Dow's down 815 points right now. Is the tech trade finally starting to crack, or does the downturn create some big name buying opportunities? That debate is next.
Jeff and Susan are looking for some protection as they head into retirement. With a Shield level annuity from Bright House Financial, their portfolio can benefit from growth potential with a level of protection from market volatility. So they can focus on their future, even when the market is uncertain. Talk to your financial professional about Shield level annuities. Bright House Financial, build for what's ahead.
You've changed, for good. You're better at haircuts. Now, you grocery shop online.
Leave it on the steps. Thanks.
You mastered hot yoga. Kinda. And when it really mattered, you trusted ADT. Because staying home or venturing out, no one has more ways to help keep what matters most safe than ADT.
Oh, Mommy misses you.
Introducing Schwab Stock Slices. For as little as $5, now anyone can own companies in the S&P 500, even if their shares cost more. At $5 a slice, you could own 10 companies for $50 instead of paying thousands. All commission-free online. Schwab Stock Slices, an easy way to start investing or to give the gift of stock ownership. Schwab, own your tomorrow.
Welcome back. We are tracking this market sell-off with the Dow down 829 points. It's just a few points off the session lows. We've been sitting here for the last couple of hours now. That's nearly a 3% loss for the blue chips. By the way, it'd be worse if Apple hadn't done its stock split. Here are the sectors: technology down 5.6%, everyone else down 2 to 3%. Energy an outperformer, if you want to call it that. But don't forget, we are up massively since the March lows, despite all of the headwinds we've had on the economy and with the spread of the coronavirus. Is this today, what we've seen this week, is it all the start of a larger correction? Our next guests say there's more to go. I'm joined by Jim Urio. He's managing director at TJM Institutional Services, and Karen Firestone is chair and CEO at Aureus Asset Management. Both are CNBC contributors. It's great to have you guys here. So, Jim, I'll start with you. You think there's more to go in terms of this sell-off?
Not much to go. I don't think this is the big one. And I cite the fact that we're going into it yesterday. Remember that VIX levels were at 26, 27, highly elevated for, when juxtaposed against the fact that we were on all-time highs. To me, what that means is that people weren't too complacent going into this. Everybody knows it was frothy. Everybody knows it was elevated. So to me, that means it's not the big one. Something else that it isn't is the big reopening rotation where people are getting out of the 5 tech names and into the Russell. I know we've seen some buoyancy in cruise and hotels, but I don't think it's that either. I think this is just kind of market whack-a-mole. Those names, those particular 5 tech names have just gone too far too fast, and now they're getting corrected.
And it's interesting what you say, Jim, because I would have thought if this was the big reopening rotation, maybe we'd see interest rates going up on this idea that, you know, at least longer term interest rates of, hey, the economy is looking better, things, you know, prospects are brightening, but we're not seeing that. So then if it's not the big one of either one of those, then what is it?
To me, it's an 8 to 12% correction in the NASDAQ. I'm short the 11,000 puts. That's where I'm planning on getting long. And I think, to me, this is perfectly healthy market function to shake people out when they temporarily forget about risk. Now, what I was saying before about the VIX, you know, if VIX was at 12 or 13 going into this, I'd be worried that people were way too out of touch with risks.
Sure.
And now I think this is a reasonable move.
All right. So, Carrie, I'll turn to you. You've got a lot of great thoughts on some individual names in particular here. But would you echo what Jim thinks overall, or are you more concerned about how much of a correction we could be seeing here?
Well, I think if you consider that the NASDAQ, just let's talk about technology and NASDAQ names. It's up 18% in the last 6 weeks. There's been that feeding frenzy that's occurred about names such as Zoom, Tesla, even Salesforce, great company, but up 26% last week on the day that they reported earnings. That's extreme. So you have more companies that are 70% or more above their 200-day moving average. This is an opportunity for people to sell stock that they've made a lot of money in very quickly. I think this move today has much less to do with the economy reopening than it has to do with the price level and the extreme extension of some of these names that have been just rocket ships recently.
I like how you put that. It's an opportunity to sell stocks. You know, we talk a lot about opportunities to buy stocks, but you say this is an opportunity to sell, which implies you can still get good prices. It's only been a couple-day affair. Let's talk about some areas, Carrie, where you do think you can buy. There are some names that you think still offer some compelling value, and they include Facebook, which to me was surprising, but several others as well.
Yeah, well, it's interesting. I mean, Facebook is up nicely this year. It's up close to 50%, but there's a lot of opportunity. They've really taken advantage of, you know, bringing people together, but expanding their network. People have adopted more Facebook applications than they might have otherwise. Pre-pandemic, we think it has more to go. Interest rates being low is good for them, and advertisers will start to come back. So we like Facebook. We like Charter Communications. It's U.S.-based, not a content producer. People are using more wireless. 5G is a plus for them. We like Blackstone. I mean, there's an opportunity with low interest rates. They're the biggest of the private equity companies. We think that has a major upside, 50% upside from this level here.
Yeah, and I even see American Tower and Remax in here. So a lot of names that kind of come up on the screen. Jim, I'll give you the last thought here. Where would you be recommending people kind of move into?
First of all, Carrie said that the movement in those tech names was extreme, but I think it's important to remember that the fundamental story is still relatively extreme as well. We just heard Jay Powell on Thursday saying he's going to get inflation come hell or high water. The things that I'm looking at are, you know, I'm in gold and silver. I'm going to probably be looking at miners, maybe something that pays a dividend from those names as well, too. But I think that this is a pullback in all the things that have been the, you know, the David Tepper trade, the buy everything trade. And I'm still a proponent of that. I just think these are the times where, you know, it gets a little tough.
Yeah, well, appreciate you both joining me today to describe the correction and what to do amidst it. Jim Yorio and Carrie Firestone. We've got some breaking news out of the White House now. Let's get to Kayla Tausche with those details. Kayla.
Kelly, the White House Press Secretary Kayleigh McEnany just wrapped a briefing a few moments ago, and there were some headlines on policy-related topics that I wanted to bring to you. First, on the topic of funding for another stimulus package and funding to keep the government open past September 30th, the press secretary reiterated that the White House does not support shutting down the government and expressed confidence that they would be able to secure funding for both a stimulus package and to keep the government open. We will see how that plays out when Congress returns over the next few weeks. On the subject of
Peter Navarro, whose federal contracts are under investigation by a congressional panel for potentially charging the government more than certain ventilators were available at retail prices. McEnany said that the White House is proud of the work that Navarro has been doing and that his contracts have allowed the federal stockpile to grow to levels it hasn't seen in decades. On the FDA, she said there is no pressure by the administration for the FDA to approve a coronavirus vaccine before the election, despite some reporting out there to the contrary. And finally, on the election, and some comments from President Trump yesterday in North Carolina, where he seemed to advocate that people should be voting in that state both by mail and in person at the polls. She tried to clarify that what he meant was if someone was not clear that their vote had been tabulated, then they should consider voting in person. But that still raises a lot of questions about the legality of that. Kelly?
All right, Kayla, thank you very much. Several headlines from the White House this afternoon. Our Kayla Tausche. Coming up, Apple is one of the biggest drags on the Dow today, and that's even after the split. It could have been a lot worse if it happened last week. The company's selling off nearly 7% right now. That's its worst day since March. Is there more pain ahead, and why now? We'll talk about that next.
Blunders, they're how we learn. But investment blunders are a costly lesson that can hurt your retirement. Decisions like trying to time the market, placing big bets on a single stock, or letting politics and elections influence your investments. Fisher Investments has gathered the 13 worst blunders and how to avoid them in this eye-opening free guide.
Why take a chance? Let Fisher Investments send you our free guide, 13 retirement investment blunders to avoid, like running short of money in retirement, or working with a money manager who's not a fiduciary. Call now, 1-800-208-4466.
Fisher Investments has helped thousands avoid costly blunders and achieve a comfortable retirement. If you have $500,000 or more to invest, call now.
Call Fisher Investments now for your free guide, 1-800-208-4466.
Don't just retire. Retire well.
Redefining the future of business, a CNBC Summit, October 6th. Insight and ideas from the most influential voices disrupting the next decade of work. Register now at cnbcevents.com/work.
My reputation was trashed online. I felt completely helpless. My entire career and business were in jeopardy. I called Reputation Defender.
Take control of your online reputation. Get your free reputation report card at reputationdefender.com. Find out your online reputation today and let the experts help you repair it.
They were able to restore my good name.
Visit reputationdefender.com or call 1-877-866-8555.
This isn't dry food or wet food. It's not burnt brown pellets. The farmer's dog makes it simple to feed your dog real food. It's real meat and veggies. Freshly made, developed with vets, delivered right to your door. That's why dog lovers are choosing the farmer's dog. A smarter, healthier pet food. Delivered. Visit tryfarmersdog.com and get 50% off your first box of food.
Welcome back. The tech sector getting crushed in today's sell-off with the Dow off more than 800 points. Tech is on pace for its worst day since June, and Apple is one of the big reasons why. It's down more than 6%. It's on pace for its worst day since March 16th, so why now? Let's bring in Tom Forte. He's senior research analyst at D.A. Davidson. Tim Higgins is Wall Street Journal tech reporter and a CNBC contributor. It's great to have you both here. Tom, I'm just going to start with you as the analyst covering the stock. Do days like today or weeks like this week just make you scratch your head?
Well, I definitely think, and thank you, Kelly, for having me on, that you're seeing a pullback in tech broadly on favorable headlines related to COVID. For Apple specifically, I think you clearly had some momentum investors buying the stock into the split, selling the stock on completion of the split. But from a fundamental standpoint, I don't think anything's changed for Apple. As Logitech pointed out, you still have 1 billion consumers working remotely, 1 billion learning remotely. And when you couple that with the expected launch of a 5G smartphone this fall and what should be a multi-year upgrade cycle, I still think shares of Apple are really well positioned for the next 12-month period, despite today's pullback.
Let me ask you a follow-up to that, Tom. Not that you're a macro guy, but why aren't interest rates going up today? You know, if we're all talking about favorable news on COVID, why aren't we? I mean, my bigger point for Apple investors is, should they now be concerned that the progression of the economy into a reopening phase means that this stock is going to perform poorly?
And the answer, I would argue, is no, to the extent that I don't see how a reopened economy dampens the consumer preference for 5G, faster smartphones. I would say those would be beneficial both if we are sheltering in place and working if there is a vaccine tomorrow. So again, I don't think fundamentally these COVID headlines are wonderful. Progress on COVID is excellent, but I don't think it dampens the fundamental story for Apple.
Okay, Tim, I'll bring you in with the very same question. And it's interesting because we now know that Apple will probably have a banner year next year because some iPhone demand was crimped this year by the pandemic. It's likely to come back. They're going to push the iPhone 12 launch into a little bit of next year. So, you know, is the problem that that's just priced in? I mean, how much was Apple up this year before the sell-off? 70%?
Well, exactly. Going into any so-called super cycle, that's what we're on the cusp of getting into. When the new phone arrives, there's always huge excitement in the market about what that potential is, and usually we see a little bit of a fall off once that new phone gets introduced. But geez, in the last few weeks ahead of the stock split, wow, things were going up dramatically, and we had talked in the past about what were the fundamentals to justify that. And now maybe this week it's just some people taking a little bit of profit.
Yeah. So I guess the question now is, where does it land, Tim? And similarly, you know, if we were to say what is the direct impact of the pandemic on Apple, what would you say that effect is?
Well, I'd say at this point, it would seem to be Apple and some of the other tech giants have been the winners of the pandemic, right? In a world where uncertainty reigns, these are some of the key companies that people think are going to have a future and are a place to put your money at a time when there's a great uncertainty of what's a good spot for your money, right? And so that's what we've seen in the last few months. Today is just more of that volatility.
Yeah.
Right?
Fair enough. Final question for you, Tom, is I looked to your note, perhaps it's not totally updated, but you had about a $120 price target post-split. We're at $122 on Apple today. So even if you're constructive on their fortunes over the next year, is that already priced in?
I would argue that there is still upside to where the shares are trading today on the 5G. You asked the pandemic's influence on Apple. It's been a transition to e-commerce sales versus in-store physical sales at the Apple Store, and it's been consumers buying a lot of tablets and laptops in addition to smartphones. So on the 5G upgrade cycle, I still think there's upside from today.
All right. Gentlemen, thank you both today talking Apple. We appreciate it. Tom Forte of D.A. Davidson and Tim Higgins of the Wall Street Journal. That does it for the exchange today. We'll have a whole lot more on today's sell-off coming up on Power Lunch. Dow's down 804 points. Not much movement this hour off of the lows. NASDAQ's down 573 points, nearly 5%. I'll join Tyler Matheson with much more after this quick break.
It came suddenly, a financial storm no one knew was coming. That's why the wise investor turns to one of the most secure investments on Wall Street, or any street, Assured Guaranty, the proven leader in municipal bond insurance.
If you've tried college but never finished, SNHU lets you transfer up to 90 credits toward your bachelor's degree.
It doesn't matter how old you are, you can do it. You can finish.
Finish your degree at snhu.edu.
Knightsco K5, you are cleared for landing.
Roger. Roger that. Knightscope K5, reporting for duty.
To learn more and schedule a demo, please visit us at www.knightscope.com.
It's easy to get lost in the economic uncertainty, the volatility, the ambiguity. This moment calls for more, and Northern Trust delivers more. With specialized expertise, proven strategies rooted in data and analytics, and insights born from over 130 years of successfully navigating economic turbulence, giving you new clarity, inspiring confidence, and helping you uncover new paths forward. Northern Trust Wealth Management.
When the world gets complicated, a lot goes through your mind. How long will this last? Am I prepared for this? Are we prepared for this? With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. With access to tax-smart investment strategies designed to help you keep more of what you've earned. So you'll know you're doing what you can for your family and your future. That's the clarity you get with Fidelity Wealth Management.
We put everything we had into this.
Do not miss the chance to get in.
We had an opportunity. We took it.
My family is going to come in here and tackle you. Do this deal.
Shark Tank, tonight starting 7 Eastern, CNBC. Get yours.
Good afternoon, everyone. At 2 p.m. in the East, we start with a major sell-off on Wall Street. Welcome to Power Lunch. I'm Tyler Matheson. Stocks near the lows of the session. You see them there, down 800 points. They were down about 850 earlier, more than 3% earlier today, now 2.76. The NASDAQ off a whopping 5% or so after hitting a record high yesterday, crossing the 12,000 milestone, as you see right now, down just about 5% or nearly 600 points. Check out the big tech. It's the first time we've seen technology getting crushed the way it is today in a long time. Apple down about 6%, 6 2/3. Its worst day since March. Facebook, Alphabet, Amazon, they are all down about 5%, even more as you see there on Facebook. Stocks that are holding up the best are names like Baker Hughes, Occidental Petroleum, and Hess leading the way. I look over to the heat map, Kelly, and I see energy leading the way.
Yes, we're just a stone's throw away here. Tyler, welcome to Power Lunch, everybody. And just like Tyler said, tech is lagging the broader market right now. You can look across the sector board behind me. See in the leadership position, energy's down only 1/4%. Financials only down 1.3%. But then take a look over here at what's been going on in technology, which is the worst performer, down 5.6% today. Even as the NASDAQ hit a record high yesterday, it's not just the big cap tech stocks that are selling off. The momentum names have been struggling for a lot of this week already. Take a look at Zoom, down about 16% in the past 2 days. That's after a huge run. Of course, the stock is up nearly 500% this year, but this is definitely amounting to a pretty big pause. Same story with Tesla. The stock has been on fire. Now it's down 18% in the past 3 sessions. And finally, DocuSign, a high-flying cloud stock. I just used it to fill out some forms yesterday. It's down about 10%, about 8% today, 10% in 2 days, and it reports earnings after the bell. We'll have more on that in a moment. But first, let's get to Bob Bassani for more on this market sell-off today. Bob?
You're right, Kelly. This is largely momentum-driven, not external news events around the economy or around vaccines or things like that. In fact, the news has been positive there. Let me show you the Momentum ETF. These are the largest holdings in the Momentum ETF. These are the stocks moving the most in short-term periods, all down more than the rest of the overall market. If you look at tech thematic ETFs, look at stuff that has really heavy volume, over 200% normal volume in some of these tech ETFs. Robots, for example, or look at the triple Qs. Look at the tech spiders, the semis. These all have volumes north of 200% in the middle of the day of their average volume. That's a sign people are moving a lot of money in and out. Same thing with some of these tech thematic ETFs we've been talking about. Robotics ETF, the solar ETF, the gaming ETF, the cloud computing ETF, all have much higher than normal volume, 200% or more on a daily basis. And remember, we're still in the middle of the day. Then flip it around. Look at stuff that actually has not so heavy volume compared to what everything else is doing. And it's utilities and energy and materials. These don't have too much of an extraordinary volume today, indicating nobody's moving a lot of money, even though some of them are down, not a lot of money being moved in and out. Finally, just to show you the momentum here, the S&P 500 is 16% above its 200-day moving average. And this is one of the things that my friends talk about, Craig Johnson over at Piper, all the time. This is very, very rare occurrence. Almost never gets close to 20%. The last time was 2018. In the middle of January, we had a correction back then. The bottom line is you can't get too fast. You can't move too far too fast. The market just naturally has some mean reversion, and you can see it there at that 200-day moving average. That's a very, very big gap. So where do we stop? Is it a one-day event or does it go on for a couple of more days? It's not clear right now. Guys, back to you.
All right, something we probably cannot know, but we'll discuss right now. Thanks, Bob. All the major indexes on track now for their worst day since June, plummeting from record highs that they hit just yesterday. For more, let's bring in Bryn Talkington, managing partner at Requisite Capital Management, and Lorene Gilbert, CEO of Wealthwise Financial. Welcome to you both. Bryn, is this the beginning of the end of this market rally or the end of the beginning?
Well, a tongue twister to start it off. No, I definitely think this is just a healthy pullback. I mean, we talk about the FANG stocks all the time, but if you actually look at the NASDAQ 100, the top 3 performing stocks are Tesla, which was up 400 and almost 50% year to date, Zoom up 230%, and NVIDIA up about 150% prior to today. And so I think this is just a reminder that gravity not only exists in nature, but it also exists in the stock market. And the NASDAQ needs to have a good 10 to 15+% retracement. And I think some of these high flyers like the Teslas and Zoom will have more. But once again, I think that rotation will go right back into these growth names because once again, this is where you're going to find growth. So I think it's just the price of admission for owning equities, and everyone needs to just buckle up and ride it out.
Lorene, I guess we all find ourselves a little bit surprised that today is the day we see this first cascade in stock prices, but earlier in the week we started to see some erosion in some of those momentum names.
I think there's some discipline going on again in the markets and some sell-off, which is profit taking. If you look at earlier in the month, some of the insiders were selling some of their own stocks that had gone up significantly. And so I think some investors are doing the same, taking some profits. And it could signal the beginning of a rotation into other areas of the market. And we're encouraging investors to diversify and look at some of those other areas that have not run up as much as that large cap momentum trade has run up. Areas like your mid caps, your small caps.
Mid caps and small caps. So you do not say specifically value, which has been one of the big debates here over recent days, whether value is ready to come back. But you're also interested in financials and industrials, Lorene.
Definitely. I think, even today we're seeing some of those leading the way. JP Morgan, American Express, looking at that. But I'd also say that with industrials, when we do finally get an infrastructure package, that will bode well for industrials. And that may not happen before the election, but probably after the election. When it comes to value names, though, it is an area to look at. When you look at the disparity between, let's say, large cap growth and small cap value, huge disparity in returns year to date. And for those investors looking for opportunities and felt like these other areas had run up, they could see some value in those small and mid cap value names.
In the long run, Bryn, I think the market tends to look at profits, and companies that have growing profits, growing revenues are the place generally to be. And is there any reason to believe that that place is not going to be in technology, in semiconductors, in telecommunications and communication services?
Well, sure, you're going to get growth there. I think everyone knows that is where the growth, that is where the innovation is coming. That being said, what price will the market pay for those sales and those earnings and that growth? And that's always the million-dollar question. So right now, today, we have a risk-off sentiment shift. But when I take a step back and I look at all the industries out there, I think I'd be more prone to rent value some of the financials or rent energy and then own long-term growth. Because I do think when I go back and say, yeah, the financials are cheap, but what is going to cause multiple expansion when Powell has said time and time again, they're not going to even start thinking about rates for years from now. And so I think you need higher sustained rates to get a lot of the value names, and I just don't see that long term. So I would just, once again, maybe rent those names, but long term, we want to stay in growth where we do think there can be some good multiple expansion.
Yeah, I do. It's a good point, Brenda. If we should look at today's trading action and the fact that rates aren't participating and maybe take that as a sign of what's to come. Lorene, just before we go, I was going to ask if you are concerned about the speed of this sell-off. I mean, the fact that we're down, we're seeing about a 5% correction in the NASDAQ in just one session here.
Well, we've had an unprecedented year with the speed in the markets in March, and then the speed up in the market. So in a sense, we got ahead of ourselves. And today is a breather, an opportunity for investors to cool off a little bit and take a breather to say, where do we go from here? Back to this concept of where do we go? Looking at in the small and the mid-cap names, even in technology, because as those innovative companies on the large cap growth momentum are looking to take the cash that they've acquired through their stock prices increasing, what are they going to do with that money? They're probably going to acquire other companies. And there can be an accretive benefit if you're invested in those smaller and mid-cap tech names that also could be bought by the larger companies.
Okay. Maureen Gilbert, Bryn Talkington, thank you both today sharing thoughts about this sell-off, which has picked up some pace in the morning. As you mentioned, markets are pretty weak across the board, and tech is leading the way. Take a look at the chip stocks. NVIDIA, AMD, Broadcom, which reports after the bell today, all selling off deeply. Some of the worst names in the S&P 500 right now. Josh Lipton is here for more for us. Josh?
So, Kelly, the semis have been soaring, but not today. Check out the SMH. That's the ETF that tracks the sector, the chips. It's now on pace for its worst day since June here. Some of the hardest hit in today's trade, high flyers that you mentioned that have a lot of fans like NVIDIA and AMD, as well as names, by the way, like Skyworks and Qorvo. I did catch up with Bernstein's Stacy Rasgon. He thinks at least some of this could be due to Ciena, a company that builds optical components. Talked about weak demand due to COVID, guided below the street. Worst day since 2001 now for that name. Even with this pressure today, though, the SMH is still up about 80% since its March lows. The sector we know benefiting from that work from home trend, specifically strong PC and data center demand. So what about the cores ahead, though? Well, Stacy says there is evidence that demand might have been pulled forward as customers look to secure products when they could. Back to you all.
Josh, I also want to ask you about Apple, given it's now having its worst day since March. Any thoughts there?
Yeah, so pull up that chart too, Kelly. You're right. Apple is under pressure. It is having its worst day, at least right now, on track since March. But like the semis, again, got to remember the context here. That stock has been on just a remarkable run. Even now with this sell-off, it's still up about 130% over the past 12 months, more than 60% this year. I did catch up with Gene Munster of Loop Ventures today. I wanted Gene's take. He says the fundamental question is still the same here. The central question is, what does 5G iPhone demand look like? He thinks initial demand could actually be weaker than some investors expect, but believes Apple does stand to ultimately benefit strongly from that 5G shift. Back to you.
All right, thank you very much, Josh. Josh Lipton reporting for us. And coming up, we will have more on the major sell-off as the stocks are wiping out. Stocks are wiping out the week's gains so far. All three averages are now lower on the week, on track to snap a 5-week win streak. Plus, Tesla in turmoil. That stock down 18% in the past 3 days. A top analyst who says the stock is heading even lower will join us after this quick break. Much more Power Lunch right after this.
It's a familiar story. Allergies ruining your sleep and next day too. Taking Zysol at night relieves allergies while you sleep, so you wake refreshed. Plus, it works faster than Claritin and on first dose provides the same relief as Zyrtec at nearly half the size. Be wise all. Take Zysol at night.
At Southern New Hampshire University, we're committed to making college more affordable. That's why we're keeping our tuition the same through the year 2021.
I knew SNHU was the place for me when I saw how affordable it was.
Find your degree at snhu.edu.
When the world gets complicated, a lot goes through your mind. With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. That's the clarity you get with Fidelity Wealth Management.
Our retirement plan with Voya gives us confidence.
So we can spend a bit today knowing we're prepared for tomorrow.
Wow. Do you think you overdid it, maybe?
Overdid what?
Well planned, well invested, well protected.
Voya. Be confident to and through retirement.
I want people to feel like they just learned something. I want them to feel like they understand something about their lives better than they did an hour earlier. We will sort through what's true and what isn't, and we'll give it to you straight, in context and with perspective. We will not waste your time, and we'll earn your trust.
The facts, the truth, the news with Shepard Smith premieres September 30th.
And I want them to feel like that was an hour well spent.
CNBC.
My reputation was trashed online.
I felt completely helpless. My entire career and business were in jeopardy. I called Reputation Defender.
Take control of your online reputation. Get your free reputation report card at reputationdefender.com. Find out your online reputation today and let the experts help you repair it.
They were able to restore my good name.
Visit reputationdefender.com or call 1-877-866-8555.
This is a crate from KiwiCo. Each crate has an awesome science, art, or engineering project inside. Parents can order online and it ships right to your door. Learning has never been so fun or convenient. Get 30% off. Visit trykiwico.com.
He never really liked his food. He wouldn't eat till like 10 o'clock at night. You know, the typical giant bag, dried little balls. That kind of led me to farmer's dog. Now he knows when I open the refrigerator, it's coming. It's already portioned out. He's eating whole foods. It's amazing.
Visit betterforthem.com.
The incredible run of Tesla is running out of gas, though that may not be the right metaphor there. The stock did open above $500 a share on Tuesday after it split and is down 17% since then. Let's bring in Phil LeBeau for more. Phil.
You know, Tyler, there's no specific reason for this sell-off. Generally speaking, when you look at Tesla, it's down with the rest of the market. There hasn't been a catalyst where on Tuesday somebody rang the bell and said, okay, let's start selling this stock off. If you still look at this over the last month, I mean, go back to August 11th. That's that V, if you'll call it there, the bottom there. It's up 40% since then. Meanwhile, the EV stocks, those who are either a SPAC like Nikola, which came into market, or you've got NIO, Workhorse, the Chinese automaker XPeng, they're all down along with Tesla today, anywhere between 3 and 7%. And yet we still had another SPAC that was announced today. This one is QuantumScape. What is QuantumScape? It is based in San Jose, California, a 10-year-old company. The SPAC is valued at $3.3 billion. They're developing long-range EV batteries, and they've got some big-time investors, including Bill Gates, Volkswagen, SAIC out of China. Their goal is to have long-range batteries that are going in Volkswagen models by 2025. Let's see how it does. It is supposed to start trading, Tyler, in the fourth quarter.
All right, Phil, thank you very much. Phil LeBeau reporting. Kelly.
So after a monster run, our shares of Tesla about to come back to earth. On the CNBC Newsline for more now is Craig Irwin. He's senior research analyst at Roth Capital. He's got a neutral rating on the stock and a price target of 150. So Craig, that's well below where we are now. Sounds like you might want to have a sell on it. Why a neutral?
So the neutral rating is because we expect Elon Musk to have announcements that continue to surprise investors to the upside. What we've identified for people is the entry into the Indian market, which will be just as material as the China market for them. And then the mini car, which I think could be even more important. You know, obviously a great opportunity to sell that both in Europe and then in India and China. The Model 3 has had proportionately much larger uptake. You can imagine being a fantastic vehicle for those markets, and more coming. So, you know, there's good potential for him to make his numbers and continue to see decent growth. So not a great name to be short.
But here you kind of discuss the price target is kind of sums up the whole story for Tesla right now, which is there are a lot of really positive fundamental factors at play, and yet you think the stock price is too high. I mean, how do you come down to the valuation that you're at?
So what I've been saying for a while is we have something like 400 EVs that are going to be on the road by 2025, and people have been treating Tesla like it operates in a vacuum. So they've done impeccably, but they don't have any magic sauce. They don't have any battery technology that other people do not have, and you will see real competition. So yes, there have been a lot of duds out of Detroit and the European automotive OEMs, but right now you're seeing a lot of SPACs come to market, a lot of companies like Fisker Automotive, for example, has got a history of designing beautiful cars. Mm-hmm. People are putting $1 billion in his hands to get out there and get it done right, and several others. And, you know, I would say the catalyst in the sector from a trading standpoint has really been the negative catalyst has been sort of the betting odds and the betting books for an R versus a D in the White House. People were putting on trades for one outcome over the other, and they started coming off this week when the betting odds changed for different betting houses. So, you know, really there's a couple things here as far as the NASDAQ volume and then the negative momentum in the sector around people hoping for more generous subsidies going forward.
Let me make sure I'm understanding, Craig. The stock currently trades at 410. Your price target is what exactly?
It is 150.
So,
it is 150.
So that would be
our estimate.
You're saying that two-thirds of the value of this company is going to go bluey by when?
So you have a company that's not going to produce 500,000 vehicles this year. They're going to produce. They said they're going to have a hard time producing 500,000 vehicles. That has very recently been valued similarly to the sum of the entire automotive sector, something like 40 million vehicles. That makes no sense. This is a company that will have real competition, both on the technology side, as far as autonomous driving, and as far as the different vehicle platforms and options that are being presented to consumers. They're already losing market share in Europe in EVs. And, you know, people have just been too aggressively positive. It's been a momentum trade. And, you know, I think it's not really a great place for someone to be long, but it has proven to be very tricky to be short.
Craig, I want to go back to something that you said about the competition that's coming for Tesla, which is why you have a lower stock price with 400 electric vehicles on the road by 2025. You said they have no better battery tech than anybody else. Is that true? Yeah. Because it seems to me like the rest of the market is trying to catch up with a lot of what's happening in their gigafactories, and that they're working hard to try to come up with batteries that maybe use less cobalt, which is really expensive. They're working on the million-mile batteries, so to speak. We have a big battery day coming up when we might get some of these announcements. There's the former employee who's now working on a battery initiative to maybe recycle some of these metals so that they can keep their hands on supply going forward. You know, are they not one of the leaders in battery tech?
So they do invest very heavily. There's no question about that. But the core of their technology actually came from Panasonic. Panasonic is hands down the world's best in electrochemistry. There are many good companies out there. If many institutional investors that I've had conversations with have gone back and checked with Panasonic and Samsung SDI and LG Chem and BYD to cross-verify what I've said over the last couple of years on Tesla. And, you know, I encourage people to do that. The reality is they don't have anything that nobody else has. That is a very, very important thing to say. You know, Maxwell Technologies that they bought, that battery electrode stuff, is a dud. The stuff from Miltech out of Maryland is actually much more interesting. That's what Daimler and 3 Asian OEMs are actually adopting for potential technology solution for different electrode production, different economics on electrode production. Tesla may have a big factory, but they're not the only one. And it's not like semiconductors where the size of your factory determines your cost. In batteries, your materials cost determines your cost. So, you know, it really comes down to how much juice are you getting in the can and what's your cost of materials. They have no fundamental advantage on materials cost. And, you know, they are doing a great job on producing what they need, and they make great cars, and I will say that. But there is no fundamental advantage that Tesla has on batteries over any global producer in batteries right now.
Well, they will have their case in about 19 days' time to say why they are superior. I'm sure we'll hear a lot from them. Craig, thanks so much for now. We appreciate it. Craig Irwin of Roth Capital on Tesla. Ty?
Well, Kelly, we got our eyes on this big market sell-off. The Dow off about 840 points. The S&P off 3.6%. Here's a look at what's leading us lower right now. It's big tech stocks. First time we've been saying that in a long time. Apple, Salesforce, Microsoft, they are all down roughly 6%, in a couple of cases for Home Depot and Amgen, 4% or so. Big move lower. Plus, work from home darling DocuSign getting crushed in today's session as it gears up for earnings after the bell. We have the details on that, more on the sell-off, and more on the markets after this.
When the world gets complicated, a lot goes through your mind. With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. That's the clarity you get with Fidelity Wealth Management.
Hiring is challenging, especially for key roles. Finding the right people is a very difficult task. ZipRecruiter finds us the best people for the job. They sent my jobs to the top job sites and found people with the right skills and experience. We've hired everyone from accountants to project managers to field scientists. With ZipRecruiter, we get hiring results.
ZipRecruiter, rated the #1 hiring site. Try it for free at ziprecruiter.com/index.
Millions of people are saying yes to Allegra, including the experts. It's the #1 allergist-recommended brand for non-drowsy relief. Allegra works 2 times faster than Claritin, and while Zyrtec may cause drowsiness, Allegra won't. Say yes to Allegra.
Why spend all your money on just one part at the typical auto parts store? When at rockauto.com, you can get all the parts you need with money left over to buy lunch. Go to rockauto.com.
All the parts your car will ever need, Rock Auto.
When the world gets complicated, a lot goes through your mind. With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. That's the clarity you get with Fidelity Wealth Management.
The nation's black workforce, striving for success and equality. Ideas to bridge the gap. Expert insight from corporate leaders and entrepreneurs. Charting the path forward. Race and opportunity in America. Tuesday, 7 Eastern, CNBC.
Welcome back. Dow's at new session lows today as we're about 90 minutes away from the closing bell. We're down nearly 900 points. No particular catalyst in the last couple of minutes for the sell-off. I know Art Cashin and many others have been watching to see if we're going to fall through a trap door, so to speak, with the trading action today, which could open up the way for deeper sell-off. But we'll continue to keep an eye on it. The Dow down a little bit more than 3% right now. If Apple hadn't split, remember, we could be down easily more than 1,000 points. It's one of the worst performers in the Dow and the S&P today. The NASDAQ, though, is still the worst performer in terms of percentage. There's the heat map, all 500 names in the S&P, and as you can see, just a fraction of them, less than 10%, are even green today. Some of the names that have been in the green, in fact, are geared more towards the reopening trade. A few of the cruise ship names, some of the airlines were briefly positive earlier, but none of the names that are more in the stay-at-home category. For more on that, let's bring in Deirdre Bosa. Deirdre?
Hey, Kelly, that's right. Now, there's a few groups of that work from home or momentum stocks that are sinking today. And do keep in mind as I go through them that it's very ugly today, but they have run up huge this year. So for now, at least, today's pullback is a drop in the bucket. First, take a look at e-commerce shares. These are the names that have benefited as consumers shop online. You see Etsy, Wayfair has been one of the biggest winners this year, up more than 200%. Shopify, Amazon.com, of course, and eBay. They have certainly participated in that momentum rally. Also, take a look at recent IPOs that have at least benefited, at least in their early time as public companies, from this momentum trade. Zoom Info, Lemonade, Big Commerce, Rocket companies, they are all selling off today. Take a look at Big Commerce, down more than 15%. Again, they are still trading well above their IPO prices. Also, take a look at the software trend. Of course, these are the darlings of the work from home trade. Zoom Video. Some are saying that Zoom Video may have ruined it for the rest of these names because its earnings earlier this week, those results were so above expectations. How in the world can some of these other software names live up to them? So they're selling off today. Remember, though, Zoom Video was up 40% in one session earlier this week. So just giving back a little bit here. You could also put Peloton in that trend if you think of it as fitness as a software. So Kelly and Tyler, these names certainly getting hit today, but to put it in perspective, they are still well up on the year. So the question is, does this continue? Do they continue to fall off, or is this sort of a much-needed breather given their run-ups?
Yeah, and Deirdre, the complicating factor is that they all do have a lot of great fundamental stories, but you just wonder how much of that demand was already pulled forward and already priced in.
Absolutely. Great fundamentals, particularly if you think that remote learning or remote work these habits are here to stay. However, you've heard a lot of chatter about these valuations just getting extremely frothy. We were looking at them earlier on in the week. I mean, Zoom Video, about twice its other software cloud peers, so they are getting very frothy. Will they justify this kind of return a few years from now? The revenue outlooks, we will certainly find out tonight with DocuSign. It's been another one, you guys mentioned it, of these big winners, and expectations are high because of that run-up when it reports later tonight, so it certainly has some big shoes to fill, and as you can see, DocuSign ahead of those earnings, down 8%.
Yeah, I find it so satisfying to use when I click the little initial here and sign here. I love it. Deirdre, thank you. Unfortunately, a tough session for them today. We'll see what their earnings say. Speaking of which, let's get over to Seema Modi for Trading Nation. Seema?
Kelly, let's continue the discussion. Deirdre Bosa highlighting one of the hottest work-from-home plays, and that is DocuSign. Still up big this year, and now at a market cap of $45 billion, which makes it larger than 350 companies on the S&P. Earnings are out after the bell. Let's discuss on how to trade the name with the Trading Nation team. Craig Johnson of Piper Sandler, and by phone Boris Schlossberg of BK Asset Management. And Boris, I got to say, not a great sign to see DocuSign down 8% ahead of its report card after the bell.
Yeah, I bet they're wishing they released on Monday when Zoom did, because I do think DocuSign is actually going to beat their numbers. I mean, they are truly one of the champs of the work-from-home environment. And as you said, everybody has used their process. I'm going through a closing process now, so I'm first-hand testimony to their software. Companies, clients include Comcast, Small Business Administration, which, of course, all the PPP work was done on that platform. So I think there's every possibility they're going to beat. The question is by how much and where are the expectations? And, of course, it's ridiculous, absolutely insane valuation at 50 times sales. So it's just a question of whether the market is going to feel kind enough to take it up, even if they do beat very, very hard. If they just come in line, that really sets us up for a much bigger decline on the short term. However, what I think makes DocuSign kind of interesting from a long-term perspective is that this is a trend that will stay with us past COVID. COVID just simply accelerated the idea that digital signing contracts is the future. It's a very boring but a very necessary space. They're dominating that space. So I really like it long term, even though there's just absolutely no doubt that it could be very, very turbulent over the near term. And it's really not for the faint-hearted as far as trade ideas go now.
Yeah, a lot of growth drivers. We saw that in Zoom's report earlier this week. But Craig, technically speaking, when you size up the chart, any reasons to be cautious here when looking at DocuSign?
Seema, I would state it as, innocent until proven guilty. When you look at this chart, you can see that the long-term uptrend is still very much intact. All we've got is sort of a correction back to an area of support, back to the uptrend support line, back to, the rising 50-day moving average. And so what I would say is the growth investors are, even though the stock's expensive, are probably going to be buying the stock on these pullbacks to that uptrend support line. If that breaks, now you're going to see names like, breaking that longer-term uptrend would be more concerning from a technical perspective. But right now, that hasn't happened. So you still continue to play this along until you get a trend break, Seema.
Got it. Report out tonight. Certainly will be an interesting one to watch. Craig and Boris, thank you. For more Trading Nation, head to our website. Follow us on Twitter for real-time analysis. Kelly and Tyler, back to you.
Seema, thank you very much. And still ahead on Power Lunch, we track the sell-off as it deepens. You can see the NASDAQ 100 laggards ranked by the biggest decliner, Zoom Video, down 9% today. All the tech and momentum names are pretty much sinking. We'll get the technical take on this next.
And now, the latest from tradingnation.cnbc.com and a word from our sponsor.
During bull markets, many traders find themselves attracted to small cap stocks because they have a tendency to have a higher beta, meaning they generally move up faster than the broader market. But don't overdo it on the small caps because they're also more vulnerable to pullbacks. I'm Joanna Payne, and Schwab is the better place for traders.
Bounced a trade idea off my firm. Same old lines. I mean, show me some technical indicators, proprietary research, something.
That's why I like Schwab. They help look out for your blind spots.
Come on, Johnny, you got this, buddy.
Speaking of blind spots.
It's time to trade up. Schwab helps you see the full picture with powerful intel and trading specialists who get it. Plus, get commission-free online stock, ETF, and options trades. Schwab, the better place for traders.
How far does $1 million go in retirement? Like so much in life, it depends. Is your portfolio in stocks, bonds, cash, gold? Have you planned for greater healthcare costs as you age? Where do you live? Cost of living makes a difference, as do market conditions. Bull or bear? Lots to think about. Fisher Investments can help.
Call now for your free Fisher Guide, the 15-minute retirement plan, and find out how long your portfolio will last, how much income you can take each year, how cost of living may impact your retirement, and more. Call Fisher Investments for your free guide, 1-800-330-0011.
For over 40 years, Fisher has helped investors achieve a comfortable retirement. If your portfolio is over $500,000 and you want to make your retirement last, call now.
Call now for your free retirement guide. Call 1-800-330-0011.
Don't just retire. Retire well.
The nation's jobs picture. Did the resurgence of the virus catch up with the resurgent job market? Or did business reopenings put more Americans back to work? August numbers tomorrow on Squawk Box. And now watch Squawk Box anytime on demand.
My reputation was trashed online. I felt completely helpless. My entire career and business were in jeopardy. I called Reputation Defender.
Take control of your online reputation. Get your free reputation report card at reputationdefender.com. Find out your online reputation today and let the experts help you repair it.
They were able to restore my good name.
Visit reputationdefender.com or call 1-877-866-8555.
I love Made In. I love that there's extreme craftsmanship.
You would think a pan is a pan until Made In came along, and I went, wow, these things are something better.
I mean, I think like once you have used Made In and you make the switch and you have the opportunity to see the difference, it would change everything.
Those are the pans that we use at Alinea. We're going to have the best pans in the world at one of the best restaurants in the world.
Welcome back, everybody. I'm Sue Herrera. Here's your CNBC News update at this hour. In Milwaukee, Joe and Jill Biden meeting privately with members of the Blake family about the shooting of Jacob Blake. The Bidens are now on their way to a community meeting in Kenosha, Wisconsin. In Germany, police suspect a mother killed 5 of her children before trying to kill herself by jumping in front of a train. The children were between the ages of 1 and 8 years old. A 6th child, aged 11, survived and is with relatives. France reporting a second straight day of more than 7,000 new coronavirus cases. Hospitalizations and the number of people in intensive care also rose. And in Kenya, pink flamingos, there they are, have returned to this lake 8 years after rising water levels drove them away. The colorful birds were the main tourist attraction for a national park, which now hopes to see a return of tourism and, of course, the employment that it supported. Little something nice to end the news update, Ty. I'll send it back to you.
Absolutely. Thank you, Sue. An ugly day on Wall Street, folks. No other way to put it. Stocks just off the lows of the day. As you see there, the Dow Industrial's off 745 points. Just minutes ago, more than 850 points down. The S&P 500 off 3.25%. NASDAQ, the big loser today. Haven't seen that in a while, down more than 4%. Stocks are selling off, and bond yields are falling as well. Rick Santelli is tracking the action at the CME. Hi, Rick.
Hi, Tyler. You know, we had some important data today, and even though ISM Services wasn't bad for the month of August, if you look at the July services surplus, it was the smallest in 8 years at $17.4 billion. It is a July number. Traders are talking about it. If you look at an intraday of 10s, it seems as though yields have stabilized. We get down to 60 basis points, 10 basis points away from the all-time low yield close at 50. Well, it's moved up a bit to 62. Add in the Dow, and you can see that the Dow hasn't turned. Maybe we're getting an early word from the Treasury complex that maybe the lows are in on equities for the day. The dollar index can't be the culprit for the drop in commodity prices, though. Here's a 3-day chart. It's virtually unchanged today, but 3 days ago it was at 28-month lows. It has stabilized, but if you open the chart up to April of 2018, virtually one of the small bounces for such a big move. Tyler, back to you.
All right, thank you very much, Rick Santelli. Oil market closing for the day, and Rahel Solomon has all the details at the commodity desk. Hi, Rahel.
Hi, Tyler. Long time no see. So, yes, oil is finishing slightly lower today, though definitely off its worst levels of the session, where it hit the lowest point since early August. You can see WTI now down fractionally, or about 0.25%. Brent crude down less than 1%. So traders are still keeping an eye on the Gulf of Mexico, where offshore production remains down by around 16% in the wake of Hurricane Laura. And you don't say this every day, but perhaps hard to believe, energy is actually the best performing sector today. It's still down slightly, but still outperforming the rest of the market by quite a bit, with a few big oil components up 2% or more, including Baker Hughes, Schlumberger, and National Oilwell Varco. Kelly, I'll send it back to you.
Rahel, thank you very much. We are in the midst of a big tech-led sell-off that has accelerated throughout the day. The NASDAQ getting hit the hardest. It was just yesterday that it crossed above 12,000 for the first time ever. And even with today's losses, it's still up more than 20% since June 1st. Here for more, Todd Gordon is Ascent Wealth Partners joining us, along with our own Mike Santoli, to walk through some of these big moves that we're seeing today. And guys, let's just start with the NASDAQ. Todd, I'll turn to you first for some kind of analysis of the charts. A lot of people pointing out how overbought the entire average had gotten. What do you see playing out now?
Yeah, Kelly, it's certainly been an amazing ride up. I'm trying not to read too much into this pullback, though. I'm trying not to watch. We don't think it's anything to be overly concerned with. And Michael, you might find this interesting. To get some context, let's compare to 2000 tech bubble. And I'm hesitant to do that for several reasons. But if we're expect a similar reaction, I'd like to look at an indicator that measures volatility. So month-over-month range in the NASDAQ. And currently, if we look at the last 20 months, high to low range, we're getting about 9% high to low. If you look back to the 2000 NASDAQ, granted it was a different NASDAQ, it was about 15% high to low before we eventually rolled over there in March. So there was a lot more investor motion driving those prices compared to today. So valuations aside, I would say we're not overly euphoric here. We're still a ways away from being overbought in terms of range expansion within the bull market. And the last thing I would say, if I can go to the S&P quickly, we're seeing an expanding volatility correction. We're getting higher highs, lower lows. That correction began back in January 2018. Technically, we're not out of consolidation in the S&P. That would be a monthly close above 3,600, and then you would technically say that the uptrend is back in place. So remaining cautiously optimistic.
Mike, I mean, are there kind of analogies to what we're going through? The one that kind of comes to mind is January 2018.
Yeah, there are certain attributes of this instance and that one that do seem to rhyme. I mean, just essentially the aggressive overbought condition, as you mentioned. I mean, and the real high momentum and persistence of the rally that led to the highs. And some investor sentiment measures are also linking up with that period. Although I would actually have to say that there's a little more of a vein of caution currently among longer-term investors than there was back in 2018. Because if you remember, 2018 was very much everybody embraced this very happy bull story about the economic expansion, about the fact that we just had passed a tax cut and it was going to be 20% earnings growth. And this is different. This is actually the market saying, racing ahead of people's perceptions of how strong it ought to be. So I do think that maybe some of the field position characteristics are similar now versus then, but not sure it has to be a similar outcome, although that was basically just a very, very quick vertical correction and then a long sideways period in 2018 for a while.
So let's talk specifically, Todd, about Apple, which is one of the worst performers today, although I should say one of the most important bad performers percentage-wise. Obviously, there's companies doing a lot worse, but few matter more than Apple. What is this action telling you?
Yeah, I mean, there's obviously big moves in Apple going into and after the split. I mean, we are long Apple in all three of our strategies here at Ascent. We remain bullish. To talk fundamentals at 125, I don't want to know what it is now, but that's roughly 32 times forward earnings. It may seem expensive, and here's some more history, which I think is interesting. The last time from a valuation point of view was this expensive, 2007, ahead of their first iPhone launch, and then they had like over almost 45% revenue growth over the next 5 years. So we could be going into this new cycle with the new 5G iPhone 12. Earnings per share is expected to grow 20% next year. So on the chart, if I could do that quickly, we've been well contained in a parallel channel since the March lows. We did meet resistance following the split, so support is viewed back down at about the $115 zone. From our point of view, I would say that support is still intact well above 115.
All right, so nothing there that kind of overly worries you. I have Disney here in my notes as well. I mean, we haven't been talking as much about that one, Todd, but why are you focused on it?
Yeah, so I mean, Disney is we've been out of Disney back in March. We just re-added Disney to our portfolio. It's been in consolidation, unlike the S&P, as we're just talking, as Michael just mentioned, since 2018. Disney's been in consolidation since 2015. So a move about 160 would technically consider us free from consolidation. From a fundamental point of view, streaming, the Streaming Plus has a big library of content to fall back on. I think they're releasing Mulan tomorrow. My kids would know. And this is, the movie distribution model. This is the future. It's the Netflix model. And to talk COVID, if COVID's around longer than we expect, content streaming is going to be a great backup for Disney, and it could work to close that gap that Netflix is opened over Disney. So, but if COVID recedes, the parks can open back up, redeem some of that lost revenue. Last year, I think it was like 37% of Disney's revenues in the park. So either way, I think they'll be okay.
It's remarkable to hear you say that it's been in consolidation since 2015. So, Mike, is Mulan going to be big in your household, or your girls are too old for that?
Yes, Mulan will absolutely. I'm probably going to see it this weekend for sure. Not sure if that's going to be stock positive or already subscribers, but yeah, I can pretty much guarantee as I go through the charts over the weekend, that'll be playing.
I would think, Mike, you're probably more in the contrarian indicator camp, wouldn't you?
In terms of what I do,
yeah,
consumer-wise, yeah, no doubt about it. No, I'm way outside the desired demo.
Thank you both for joining us today. Very much appreciate it. Michael Santoli and Todd Gordon on these markets. Coming up, we're going to check on some of the biggest decliners on this down day in percentage terms, too. Plus, 29 of the Dow 30 components are lower right now. Those new names, Salesforce and Amgen, they're contributing to the declines. We'll take a closer look at the biotech sector next on Power Lunch.
The Bond Report is brought to you by PIMCO, a global leader in active fixed income.
From tap-to-pay technology to mobile point of sale, make purchasing easier for your customers with Adyen. And discover a seamless way to let customers pay with touch-free payments. Adyen. Business, not boundaries.
Jade is about to buy her first home. And with a verified approval from Rocket Mortgage, she has the strength to compete with cash offers. When you need an edge in the bidding war, Rocket can.
It's Nutrisystem for Men, with a month of food and shakes delivered to your door. Stay home, stay safe.
Nutrisystem comes right to my door. I don't have to think about it. This is breakfast, this is snack, this is lunch, this is dinner.
Nutrisystem for Men has got you covered to stock up the pantry and help you stay healthy. Act now and save 50% off a month of food and 50% off a month of shakes.
Go online or call 888-478-FIT3 to save 50% on a month of food and shakes.
As business moves forward, we're all changing the way things get done. Like how we redefine collaboration, how we come up with new ways to serve our customers and deliver our products.
This one is cheddar. It's delicious. Oh, you look so healthy.
But no matter how things change, one thing never will. You can rely on the people and the network of AT&T to help keep your business connected.
Now, more than ever, you need a mobile bank account that helps you earn and save more. That is Unlimited by Green Dot, with an incredible 2% interest on your savings and unlimited 2% cash back when you shop online. Open an account at greendot.com.
Give customers access to precisely what they want when they need it the most. With Adyen, the payments platform that delivers convenience for all. Adyen. Business, not boundaries.
With the thrilling start to the Stanley Cup playoffs, 8 remain in their quest to lift the cup. There's nothing like playoff hockey. Stanley Cup playoffs second round on NBC and NBCSN.
Yeah. One of the biggest drags on the Dow today is Amgen on only its 4th day as part of the index. Biotech as a whole sinking, and Meg Terrell joins us now on the phone with more. Hi, Meg.
Hey, Tyler. Kind of an inauspicious beginning for Amgen, replacing Pfizer there in the Dow. Biotech
is down, though not as much as tech. You are seeing it have the worst day since early June. And among stocks that are the lowest in the healthcare sector in the S&P, you see biotech names like Vertex, Regeneron, Biogen, and of course, Amgen. You know, talking to Jefferies healthcare strategist Jared Holtz, he's just pointing out that the growth names really getting hit harder. One interesting trend you're seeing in the healthcare sector in the S&P also is kind of a drag among names that are in the diagnostic space and the lab tool space, like Biorad Laboratories, PerkinElmer, Thermo Fisher, and Illumina. Among the bigger pharma names, you are seeing weakness as well, though not quite as bad. And Pfizer, one in particular, making some news today. That CEO is saying that they expect to get data by the end of October for their vaccine for COVID-19. But Dr. Fauci, in an interview on CNN this morning, saying that looks pretty optimistic. Here's what he said.
If someone comes out and says, you know, I'm going to shoot for the possibility that I'll get it by October, you can't argue strongly against that. That's unlikely, not impossible. I think most of the people feel it's going to be November, December.
So an October surprise would be an optimistic surprise for vaccine data for Pfizer. Guys?
All right, thank you very much, Meg. Kelly?
Let's take a look at the Dow, which is down more than 800 points right now, just short of 3%. The losses are worse on a percentage basis for the NASDAQ. It's shedding nearly 5% today. Up next, we're going to look ahead to tomorrow's jobs report. Whether that's a catalyst for some of the selling that we're seeing now, could be seeing to come. Stay with us.
Tomorrow is just waiting to be created, to be reinvented and redefined. And it's those who dare to push the world forward, discover and reshape markets, and embrace the possibilities of data that will reimagine our potential and transform society as we know it. With new ideas and new technology, get there with NASDAQ.
Hi, Mr. Wonderful here. I believe that startup investing is key to building wealth, but it's hard for everyday people to find access to these deals. Well, I've got good news. On Start Engine, you can discover hundreds of startups raising capital and begin building your portfolio today. For as little as $100, you can own a piece of the next great business. It's your turn to become a shark. Join me at startengine.com.
In today's climate, you need to evaluate all financial options. Consider a balanced transfer card. By utilizing a 0% APR, you'll pay down debt faster and keep your credit score intact. Explore your best options. CNBC Select, the stories you need for the smartest way to handle your credit.
This is a keepsake frame. This is actually a photo from my wedding. I'm Adam Weiss, founder and CEO of Keepsake. If you're anything like me, you've probably got 7,000 photos on your phone. And sometimes the moments that really matter most end up getting lost. That's why I made Keepsake, the mobile app that makes it easy to have your photos printed, framed, and shipped to your doorstep. So if you've got a special photo on your phone, install the free Keepsake app. We would love a chance to frame it for you.
What can you expect from ButcherBox? 100% grass-fed beef, organic free-range chicken, heritage breed pork, and so much more. From farmers who believe in raising animals with care, with no antibiotics or added hormones, ever. All with free shipping right to your door. Together, we can make a difference, one meal at a time. Visit butcherbox.com to learn more.
Today's weekly jobless claims number came in better than expected, but the number comes with a caveat, reflecting a seasonal change in methodology used by the Labor Department, so the number actually ticked up from last week. And according to the latest LinkedIn data, overall hiring pulled back slightly month over month, but it did not stop real estate and transportation from seeing big hiring gains, both industries benefiting from low interest rates and summer travel. Joining us for more on the report is LinkedIn's chief economist, Karen Kimbrough. Karen, nice to have you with us. As we look at the hiring numbers during the summer, month to month, they look pretty spectacular, I would say. But how do they compare with hiring numbers or overall employment a year ago, for example?
Sure. So basically what we're seeing is that the recovery is underway, but the gains are moderating. We're still underwater relative to where we would have been in terms of hiring pace a year ago. And that's true if you look city by city or if you look industry by industry. across the board, we are still not in positive territory where we're growing faster in terms of hiring than a year ago. And I think one of the most interesting things, to take away from this is that while the recovery is going on, it's fairly fragile. And in fact, it might be even slowing a little bit from what we can see in our data through late August.
We're looking here at revitalized industries, year-over-year hiring, public administration, wellness and fitness up, real estate up, I guess no surprise there, healthcare higher. So there are some industries that are getting more close or even above normal.
That's right. There are pockets where we are doing well, where we're seeing hiring. And like you said, with ultra low rates, with the inventory rebuild that we're currently in our economy, that's also supporting transport and logistics sector. Healthcare is a no-brainer. People delayed a lot of, regular healthcare they wanted or elective healthcare, and now they're finally starting to get back into that. Finance has been holding up as well, despite what we're seeing today. And then finally, I think the fun fact is wellness and fitness, which is kind of off the charts, basically, and probably reflects a lot of home gym building that people are doing right now.
Yeah, I would think so, because a lot of gyms have not obviously been open across the country. How does the U.S., in terms of hiring, compare with other countries that have been struck by COVID?
Yeah, well, everybody's going through their own, experience, and we are definitely in the U.S. lagging a little bit the rest of Europe and Asia. And that may be because elsewhere the reopenings have happened and been sustained, and in our case, it feels a little bit more like there's a rolling blackout experience of shutdowns and reopenings happening in different places across the U.S. I think we're also a little bit more hamstrung in that in many cases schools haven't reopened, and that is a headwind for working parents. And then last but not least, there's a little bit more uncertainty here in the U.S. than, say, in France or elsewhere in Asia around what the benefits are that people can expect. So I think people are kind of waiting to see whether or not there's another drop of stimulus coming.
I think you began by saying that some of the hiring momentum had abated a bit recently. Do you expect to see a continuance of that abatement, and how concerned should we be about it?
Look, well, I think, tomorrow we're likely to probably see continued improvement, albeit much slower than what we've seen in the past couple of months. And then looking further ahead, so far as I can tell in the, spotlight that I'm looking out at, it looks like things have slowed dramatically. There hasn't really been a lot of improvement since mid-August in the U.S., generally speaking. Like I said, there's always pockets of growth. There are even cities that are doing better and getting back close to normal. But largely, I think until we address some of the headwinds we have around whether or not consumers feel confident about spending, whether or not businesses can look forward and plan on investing and rehiring, we're sort of like fighting with one arm tied behind our back.
What cities are doing best?
Best are sort of what we call like the secondary and tertiary cities that have maybe less urban density. They have maybe more affordable housing stock. Austin, Denver, Atlanta, doing well, really seeing the strongest hiring trends in the last couple of months, but also closest, those three cities, Austin, Denver, and Atlanta, closest to getting back to levels of hiring that we saw this time last year.
All right, thanks very much. We appreciate it. Karen Kimbrough, thank you. Kelly.
The NASDAQ is down 5% right now as we approach the final hour of trading. We will get you set up for what kind of action we might see. We are testing fresh lows as we speak. The Dow down 909 points. We'll be right back.
When the world gets complicated, a lot goes through your mind. How long will this last? Am I prepared for this? Are we prepared for this? With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. With access to tax-smart investment strategies designed to help you keep more of what you've earned. So you'll know you're doing what you can for your family and your future. That's the clarity you get with Fidelity Wealth Management.
At CDW, we get there's no time for downtime. That's why CDW experts partner with APC by Schneider Electric to keep you up and running with a full range of edge computing solutions, including the new lithium-ion Smart Ups UPS with 2 times the battery life and cloud-enabled remote monitoring, so you can deploy data center-like resiliency with the performance and certainty you expect and the ongoing support you need. For IT infrastructure and uptime, you need APC by Schneider Electric and IT orchestration by CDW. People who get it.
Knightsville K5, you are clear for landing.
Roger. Roger that. Nightscope K5 reporting for duty.
To learn more and schedule a demo, please visit us at www.nightscope.com.
Adventure is calling. You may know it as the open road, a weekend getaway, or just getting away from it all. You've heard the call. Felt the urge to conquer the off-road, the craving of new trails to blaze, the desire to just keep driving. We know because we've gotten the call too. We look forward to seeing you out there. The Land Rover Call to Adventure sales event is going on now. Land Rover, above and beyond.
Well, we haven't had a day like this one since really the middle of June for the Dow, for the S&P, and the NASDAQ, just after hitting record highs for the NASDAQ yesterday above 12,000. It is off more, as Kelly, you pointed out just moments ago, more than 5%. This is really a case where the first shall be last. The technology companies, the chip companies like NVIDIA, the Teslas, the Apples, all of those are leading the way lower.
And let's look at the intraday action here, because that's why this final hour could be interesting. A lot of the traders, Art Cash and I mentioned, watching to see if we would go through the lows from earlier in the day. And for a while, Tyler, we were holding them, but now we've kind of retested those lows, so to speak, and poked beneath them. That's what could make it a little bit more volatile as everybody scrambles to reposition. By the way, not everything is lower today. I mean, the reopening stocks are holding up relatively well. If you specifically focus on the cruise lines, some of the airlines, retail, Macy's still the best performer in the S&P. It's not all coming up roses, though. Interest rates are lower. It's just a wacky session time.
Yeah, it is. It's very interesting to see retail up there. Coty, the beauty company, Ralph Lauren up there in the green earlier today. It's been an interesting hour, and the next one promises to be even more so.
Yes, indeed. Thanks for watching Power Lunch, everybody, and Closing Bell starts right now. Thank you, Tyler and Kelly. A massive sell-off when it had seemed that stocks could only go up. The winning streak is over. The Dow is now down 900 points. We are looking at session lows as we head into the close. Welcome, everyone, to Closing Bell. I'm Sarah Eisen here with Wilfred Frost. Goodbye, 12,000. NASDAQ's down more than 500 points, almost 5%. The S&P lower by 3%. Let's look at what's driving the action. Big tech is at the center of the storm right now. Apple down 5%. Shares of FANG stocks are all lower. Tesla's down 8%. The so-called fear index, the VIX, trading above 30 for the first time since July as volatility comes back to this market. And the only stocks that are doing well right now, some of the reopening trades and some of the big laggards for the year, like cruises and airlines and some retailers still in the green. Energy stocks also outperforming. So is this the start of a serious correction or a buy the dip opportunity? We're diving right into that debate. Wilfred, 59 minutes left of trade.
59 minutes of this roller coaster session. Lots of guests as well. Ahead on today's show, the market pulls back. We'll speak with 3 CEOs who've got insight into the state of the consumer, their spending, and the recovery in America. The CEO of Campbell's Soup will join us on the back of his company's earnings results. That stock down 7% right now. Plus, we'll get 2 reads on the beaten down travel sector when we speak with the CEOs of Booking Holdings and Hyatt Hotels. And as Facebook shares tumble, we'll speak with Nick Clegg, the company's head of global affairs and communications, about its new policies surrounding the election. Looking forward to that one. But let's get straight to our top story of the day, the market sell-off. Mike Santoli's got more on today's major market pullback. Mike.
Yeah, well, really a big flush of the hot money, the highest momentum trades, but also taking the whole market down. I wanted to start with a 2-year look at the S&P 500. The reason for that is you got several times here where the index nosed above to a new all-time high. And then, as I pointed out last week, it often just has to kind of come back around and maybe retest and check to see if that break to a new all-time high was okay. Obviously, this one was major. That was a one-off, obviously a major shock. But if we did have to go back and see if that high breakout was okay, you're talking about a couple percent down in the S&P. It's nothing major, but when you look at it this way, you see that it's very common to have it kind of in this rolling fashion as opposed to just blasting off to stay once we get to record highs. Look at the NASDAQ along with kind of a couple of trend indicators of the NASDAQ. This is its 21-day average. I've pointed this out numerous times, right? We kind of bounced off it a few times in the spring when we've had little pullbacks. We went way up, stretched to the top of that sort of path that it's been traveling on for a while. And now here we are about halfway back down to that line. It would be, again, another 3-4% perhaps in the NASDAQ to pull back. In the context, if it's just going to be another one of these little tests, little basic retracements of this move higher, that's all it would be. It obviously remains to be seen. The big liabilities of this market for a long time have been ebullient sentiment and stretched technicals. I don't think today took care of all of that, but it probably goes a long way toward beginning that process, if nothing else. And then just in terms of the sector mix, here's NASDAQ 100 against the banks. And people keep talking about maybe it's going to be a rotation. It isn't necessarily a rotation, but it's just this has to come off the boil. And what's going to happen to these? Are they going to take up some of the slack or also come under pressure? And you see it's really just flattened out in terms of the banks. This is basically the greatest gap we've had in this whole run in the last year or so. There it was pretty close as well. And so this could just be this mean reversion move. The banks holding up relatively well, but mostly because it's the laggards that are doing well, guys. And one reason, you pointed out the cruise lines and some of the structurally challenged retailers doing well today. If you're a long short fund, you're selling your longs, you're buying back your shorts. So it's to some degree, it's kind of where's the market crowding and where's the market been neglecting. Those are two ends of the seesaw today.
Yeah, exactly. We've all been making calls on the sell-off, Mike. No specific catalyst cited in terms of the why or the trigger. Jobless claims continue to move in the right direction. Still, obviously, very elevated in terms of the number of layoffs, but going lower, below that 1 million mark. So is it positioning? Yeah. Is it the frothiness? Is it the president tweeting out about Dow 29,000 last night?
All of it works together, to be honest with you. I do think it's really about the way the market got stretched in this buying crescendo in the last couple of weeks or so, created some vulnerabilities. We talked about the influence of a lot of this fevered options activity, creating all these kind of offsetting hedges, and it basically created a more volatile tape even as we went to new highs. That's unusual, and a lot of that, I think, is being bled away. In terms of the president's tweets, kind of boasting about the Dow, there have been some studies on this, and when there are clusters of President Trump tweets about the market and taking, kind of pointing it admiringly at it, that does often coincide with the start of pullbacks. One tweet out of the blue, not sure that really has statistical relevance.
Mike, thanks so much for that. 55 minutes left of the session. We're right near session lows. The Dow you saw there down 3.2%. The NASDAQ's down 5.5%. Now, shares of Facebook also moving low today. They're down 5.6%. The social media giant announced new election policies as it looks to tackle misinformation on its platform, including banning new political ads in the week leading up to the election and flagging premature victory posts. Joining us now in a first on CNBC interview, Sir Nick Clegg, Facebook's Vice President of Global Affairs and Communications. Sir Nick, very good afternoon to you. Thanks so much for joining us.
It's all good to be on your show.
I wonder what you would say today to the critics that have looked at this fresh announcement and said that it perhaps doesn't achieve a great deal, that provided an ad is still uploaded at least 7 days before the election, then it will still be seen for that final week of the campaign regardless.
Well, I think the proof will be in the eating of the pudding. I'm sure people will immediately pronounce on these announcements and say they either go too far or they don't go far enough. But I hope people will now, judge us by the actions and the way we enforce these policies. They're pretty unprecedented, and they're unprecedented because we're living in unprecedented times. This election is like no other, at a time like no other, and the range of measures we've set out today, from limiting the number of messages you can forward on Messenger to labeling posts from candidates where they prematurely declare victory, or removing content which says that you'll get COVID if you vote in a particular way. And adding much more prominent and sort of aggressive labels, if I could put it like that, on posts that seek to delegitimize the whole election. These are big changes. On the ads that you talked about, the reason why we're doing this in the last week is that in the last week there isn't just time for the back and forth. One candidate says one thing, and the other candidate can reply, and you get the scrutiny that you want in open democracy. The reason we're putting these guardrails in for the last week is because if someone runs an ad at the last minute, which is either very misleading, very polarizing, and so on, their opponents and the media, you and the media, don't have time to really scrutinize and answer back. And that's why we've we've confined these guardrails, important though they are, to the last week of the campaign.
Though, as Wilfred said, it's pretty easy to find some loopholes here. And the fact that you're not doing widespread fact-checking on political ads does raise the question about whether this is just a PR stunt.
No, it's not a PR stunt. It's real. It means that no one can run new political ads for the last crucial 7 days in a campaign. That is not a PR stunt. That is a very real constraint on what political ads can be run and what political ads you will see on your news feed. Look, almost no one, I don't think any major Silicon Valley company fact checks what politicians say about each other, because what politicians say about themselves about each other is always full of exaggeration, caricature, hand-picked selective facts and so on. And the idea that a private company sitting in Silicon Valley should be the sort of sole arbiter of when caricature and exaggeration becomes something which is simply not true is something that no one has tried, because it's almost impossible, I suspect, to do it. What we are, however, ensuring is a huge level of transparency. All these ads go into an ads library, which is far more transparent than political ads that are run on television or radio or in the printed press, where you can see who's paid for a political ad, who's targeted, when they're running it, all the different variants of the political ads. So we believe that mixture of extreme transparency with this hard limit that new ads cannot be produced for a week up till election day, hopefully will mean that the ads do what they're supposed to, which is allow politicians to communicate to voters, get the voters to vote in the first place, but avoid an ad being run at the very last minute in a way that sort of hijacks the final stages of the campaign.
I think the bigger issue here, what I struggle with, and I think a lot of people do question, is that this isn't necessarily an ad problem. The misinformation tackling that you guys have been trying to do, it still seems pretty widespread, whether it's factual misinformation about the coronavirus and health and vaccines, whether it's white supremacy pages, whether it's militia pages with calls to arms. These are still posts by your users that are flagged many times too late and that still get passed around to millions, if not billions, of people. And it just feels like your policies are very piecemeal and very reactionary to this whole issue of misinformation.
Well, I don't think they're quite as piecemeal or as sort of small scale as you seem to imply. I mean, we've taken, since we announced a couple of weeks ago the measures we're taking against QAnon and other sort of militia groups, we've taken thousands of pages down. We've removed around 200, or I think over 200 white supremacist groups over the last period of time. We have removed or labeled millions of items of content related to coronavirus, as well as, by the way, directing over 2 billion people around the world to authoritative information on coronavirus. Something, by the way, we're mimicking through a voter information center, which you'll see on Instagram and Facebook pretty well every day at the top of your feed, providing people with reliable information. But of course, I accept to you, on a platform where I think on an average day you have over 115 billion messages, yes, I totally accept that sometimes we don't react fast enough on an individual piece of content. We're getting better and better using machine learning and AI systems to do so. But I think to say that it's piecemeal or not ambitious, I think would be an unfair characterization of what Facebook is doing right now.
So, Nick, I wanted to pivot, if I may, to more broadly the impact that Facebook has on polarization in society. On the 24th of September last year, you gave a speech to the Atlantic Festival in D.C., and in it you said, while newspapers and TV journalists, quote, analyze, ridicule, rebut, and amplify the statements made by politicians, end quote, quote, at Facebook, our role is to make sure there's a level playing field, not to be a political participant ourselves. I get, obviously, that you personally are no longer a political participant, but aren't Facebook's algorithms that push more Republican content to people that support Republicans and like that footage, and more Democrat contents to people that like Democrat footage, precisely that? Aren't they showing that Facebook is a participant, that it does amplify views?
Well, the evidence is actually a lot more ambivalent than that. So, there's plenty of evidence that in countries where there's been an explosive growth in the internet and social media, polarization has actually gone down or remained stable. There doesn't appear to be a causal link if you look at the use of social media around the world between the use of social media and polarization. And also, I accept this might sound counterintuitive to some people, but actually it makes some sense. If you consider that the vast majority of content that you get on your social media feed is content that you are either interested in or, crucially, that you share with family and friends. Who you are friends with on social media is the biggest signal that is used to determine how, I don't know, the pictures of your siblings' daughter's birthday is the thing that you first see on your feed. And generally what we find is that people's friends have a fairly mixed view, for instance, fairly mixed political views, in many ways more mixed and more diverse ideologically on your newsfeed than the same readers of the same, often what can be quite partisan newspaper. So I totally accept that there needs to be more research, and we announced at the beginning of this week that we are working with independent researchers across the United States for the first time ever, and it's an unprecedented research project so that they will have access to Facebook data to really try and establish this time round in 2020 what the effect of social media is on voter behavior. But the research and the evidence, such as it is, doesn't suggest that there is an automatic link between the use of social media and polarization.
Well, maybe it doesn't suggest it automatically. You cited that some countries that are just growing into their internet use, it might not show that. But I mean, clearly America is very developed in that sense. Are you saying that you accept that if it were the case that your algorithms did in any way push partisan political content onto people who have shown a fondness of that political content in the past, that would be wrong? Are you accepting that?
I think we're accepting that we want to try and make sure that people, of course, see stuff that they're interested in, that they engaged with, that they find rewarding and enjoyable, and we eliminate on a huge scale. I mean, we remove millions of fake accounts a day. We remove or label or deprecate on people's feed any post that contravenes our so-called community standards. That are the rules against everything from incitement to violence to intellectual property fraud. So of course we constantly try and get that balance right, and where we get it wrong, we constantly update.
But so yes, with all due respect, I get shown endless videos of Arsenal players scoring goals because I always watch them. You're saying where we acknowledge that we might be getting it wrong, we immediately address it. I don't think you've addressed ever the fact that people get shown lots and lots of videos and contents of stuff they've shown a tendency to watch. And when we're approaching an election, that tends to be a lot of political content. And you've made a speech to say you don't take a position and that that's the right action. Surely you must acknowledge that that's not what's going on at the moment on Facebook.
Well, firstly, I get a lot of videos on Fulham goals for perhaps the same.
There aren't many Fulham goals, are there?
Just being promoted to the Premier League, but I draw a distinction between making sure that people see things that clearly, in your case, you want to. You're an Arsenal fan, I take it, so that therefore you're engaged with that content, so you get more of it. I think we're quite open about the fact that your news feed is clearly seeking to try and make sure that there is content, whether it's about your friends' holiday or your family celebrations, or whether it's Arsenal goals, are prominent enough in your news feed that you get to see them. Because the algorithm, in a sense, is trying to just deal with a very simple problem, but quite complex to solve, which is this: that there is an infinite amount of things that you could do as you scroll down, you could look at as you scroll down your news feed, but there's only so much time, a few minutes at a time sometimes, that you're actually looking at your news feed. So what is, of course, ranked higher is tremendously important. And of course, the friends you have and what you've engaged with in the past, we're quite open about that, is a reasonable signal. I think that's quite different to saying that we as a company do not believe it is our role as a private company to take a political stance in the political debates that happen on our platform, just as they do in any other communication medium.
My final question to Nick, and we all know that there are not clear rules and regulations for you to operate in, and that in the vacuum you have to operate. It's an impossible job to please everyone. And we also accept that, as you just said, the company does not want to take a specific political position and believe that you're not doing that. That said, from a PR perspective, given the role and title you have, are you the right person to be heading up the department that makes the decisions when we're going into an election you described at the top of this interview like no other? When you tweeted in July 2018, he, referring to Donald Trump, dislikes everything I believe in and believes in everyone I dislike.
Well, look, I was the leader of a major political party called the Liberal Democrats. So I can hardly bury my own political views that I held over 20 years in public life. But I am perfectly capable of, otherwise I wouldn't be doing this job and I wouldn't have volunteered to do it, to be able to distinguish my own political views from that of what Facebook corporately does. And I don't inflict my political views, no individual does. We try and build systems which are coherent, which are objective. I agree with you, by the way, very strongly that in the long run, many of these issues shouldn't actually be decided upon by companies like Facebook or indeed by people like me in Facebook at all. In the end, issues about the relationship between social media and elections, for instance, this fraught issue about how political ads should and shouldn't be run, when they should and shouldn't be run, it would be far more preferable if those were rules that were established by lawmakers in legislatures around the world, democratically accountable to their own voters. And I do believe that in 10 years or over the next 5 or 10 years, we will see new rules of the road established by governments. And that's only right and proper. It's only right and proper that what is a relatively young industry, Facebook's only been around for 15 years or so, that over time, like almost any new technology, that it takes a bit of time for the rule makers, if I can put it, to catch up. And I believe that's exactly what's going to happen over the coming years.
My final question also is a PR-related question, Nick. Do you feel that Facebook has gone far enough, because a lot of people don't, in terms of recognizing some of the damaging effect it's had on society with regard to spreading hate and misinformation and all these issues we've been talking about? Do you feel like the response has really been robust enough? The Stop Hate for Profit movement, where loads of corporations that we cover every day pulled their political ad spending, and the response, public responses were that you expect them to come right back.
No, I don't think that's fair. I think the response has been a lot more than that. I mean, look, I can only point you to objective organizations. I mean, if you look at the recent report issued by the European Commission, they were very clear, having compared the way that we deal with hate speech, Facebook deals with hate speech, compared to other platforms, Twitter and YouTube and so on, that we are in the lead in terms of identifying material. Certainly we now, and we publish every 3 months quite openly, how we're improving on going after hate speech before anyone reports it to us. We have transformed our ability to do so. Of course, there's always more to do. But if I look at what Facebook was doing back in 2016 at the last election, didn't have fact checkers. We didn't have the same sort of community standards enforced in the way that they are now. We were not removing hate speech on the scale that we were. We were not removing millions of fake accounts on the scale that we are now. In 2016, we didn't take down one what we call coordinated interference network, the sort of Russian-style networks. We've taken down 100 over the last 2 years. So do I think people will say that it's not enough? Of course, people always, and it's right that Facebook should be put under pressure. But is Facebook today in 2020 completely different to what it was in 2016? Yes, I think any fair person would say that it is.
Nick Clegg, thank you for joining us. We appreciate your time.
Thank you.
And taking our questions, Nick Clegg of Facebook. Still ahead, we are looking at a pretty major sell-off here in this final hour of trade, going into the final half hour, and we've got the Dow down at session lows down 980 points right now, an almost 1,000-point decline for the Dow. After the break, even big earnings beats couldn't save Campbell's Soup from plunging today. We will talk to the CEO about those results and consumer trends he's seeing. You're watching Closing Bell here on CNBC.
This piece is talking to me.
Yeah? So what do you see?
I see an unbelievable opportunity. I see best-in-class platforms in education. I see award-winning service and a trade desk full of experts available to answer your toughest questions. And I see it with 0 commissions on online trades.
I like what you're seeing.
It's beautiful, isn't it?
Yeah.
TD Ameritrade now offers 0 commissions on online trades.
Your house is your future. Protect it from unexpected expenses. Leaf Filter prevents damage to your home and keeps loved ones safe. Because at Leaf Filter, your safety is our priority. You're at home and see things that need work, but gutter cleaning is dangerous. With Leaf Filter, you don't have to climb a ladder to clean your gutters. Protect your home and your future. Call us at 833-LEAF-FILTER or visit getleaffilter.com for a free estimate.
Hi, Mr. Wonderful here. I believe that startup investing is key to building wealth, but it's hard for everyday people to find access to these deals. Well, I've got good news. On Start Engine, you can discover hundreds of startups raising capital and begin building your portfolio today. For as little as $100, you can own a piece of the next great business. It's your turn to become a shark. Join me at startengine.com.
The nation's jobs picture. Did the resurgence of the virus catch up with the resurgent job market? Or did business reopenings put more Americans back to work? August numbers tomorrow on Squawk Box. And now watch Squawk Box anytime on demand.
This is a keepsake frame. This is actually a photo from my wedding. Keepsake is incredibly simple. You just choose a photo that you love. You can preview it in over 100 frames. And in a couple of days, you're going to receive your photo in a beautiful handmade frame.
10 years ago, I had an undiagnosed heart condition, and erectile dysfunction was actually the first sign that something was wrong.
Luckily, I'm a doctor, an expert in sexual health, and Zach's dad.
Not everyone has a doctor in the house, and some health conditions can be really tough to talk about. We started Roman to change that.
Now you can go online and chat with a physician.
And if treatment is right for you, we'll ship genuine medication right to your door. If you're experiencing ED, hair loss, cold sores, or other issues, let's take care of it.
This is what real food looks like. Fresh, real meat and veggies. The food dogs were built to eat. The Farmer's Dog is changing the way we feed our pets. Visit tryfarmersdog.com to see your dog's personalized meal plan.
Welcome back. The S&P 500 is plunging right now, along with the broader markets, down more than 4%. We haven't seen a move like this in a while. We're looking at tech leading the charge lower. The NASDAQ is down sharply. The Dow now down 1,000 points, a little over 1,000 points, 30 minutes left into the close. Technology leading the selling, but it is getting broad-based. A lot of the winners we had seen in the market, the stay-at-home stocks, the software stocks, the technology stocks like Apple and Tesla, all getting crushed today in this sell-off. Shares of Campbell Soup are also taking a dive along with the rest of the market. This despite an earnings beat and strong sales growth in the fourth quarter. Campbell Soup CEO Mark Klaus joins us now for an exclusive interview. And Mark, your stock is down 8%. I get that the broader market is selling off, but the message you projected today to the street was pretty positive in terms of the underlying sales growth. Where's the disconnect?
Well, I think, in all fairness to investors right now, it's a difficult moment to try to project. And, as we came out today, we did provide some nearer-in guidance, but our longer-term guidance was more general in nature. And so I think, that kind of leaves investors only with the short-term to judge. And I think what really is going to be the tail of the tape of this moment for companies is not just the here and now, but really how we come through the pandemic on the other side. And so our focus really has been around that, taking advantage of a tough moment to make the most of it by investing in marketing and really trying to solidify relationship with the millions of new households that have come into our franchises. I think this is one of those windows where even in times where we may be a bit constrained on supply, we want to make sure we're doing everything we can to strengthen those relationships. And I think you pair that with the work that we'd already done to simplify the portfolio. We've reduced debt. We're now at a level that's 12 months ahead of our plan. We've got an organization that I couldn't be more proud of how they've executed, starting with our frontline teams all the way through in navigating this difficult moment. And I think what we're going to see is a situation where we come through this in a very advantaged position. I think companies that right now are only focused on incremental sales, that aren't focused on building strategy, I think, those are the ones that are going to be in a bit of a disadvantage.
I'm curious what you're seeing right now from the consumer, because we've seen that bump in unemployment benefits and a lot of the stimulus money wear off. Has there been an effect on grocery trends and buying of your products versus what we saw a few months ago?
Yeah, I mean, I think certainly as we've worked through these cycles of the pandemic, we've seen some, I'd say, some positive trends. For example, on things like cooking, where initially, we saw a surge in that behavior almost out of necessity. Now, 6 months later, consumers have built it as a real muscle, and so their confidence and their commitment to that behavior is one of the reasons why we expect to see that continue on. And where in the beginning it might have been very simple recipes, now consumers are able to build in their own creativity, match more of their personal favorites. And I think that's a trend that we'll see continuing. At the same time, I do think there is some normalization in categories, more so on our snacking side than perhaps what we're seeing on our meals and beverage side. I think as we navigate the back to school time period, as we head into a high entertaining season with initially football in the fall and then into the holidays, I think we need to see how that's going to play out. I think on the one hand, you're going to still have this ongoing stay-at-home behavior of kind of grazing and snacking on a more regular basis. But will we see as much of the entertaining and the party volume is one of the things that we're watching very closely. And of course, back to school depends a little bit about where you are in the country, whether your kids are in school learning in person or whether they're doing it virtually, signals very different levels of demand and different items. And what we're trying to do is really adjust our approach so that we're able to meet the needs of the consumers in a more surgical way or more specific to where they may be or what cycle in this pandemic they're in.
And I know you've been trying to resupply the goldfish ahead of back to school and amid a bit of a supply crunch there. Mark, I guess what I was getting at, though, and it relates to the broader market and the environment we're in, is the financial health of the consumer right now. And how you plan for an environment where we don't know if we're going to get another stimulus or a delayed stimulus and what that will do for Americans' pocketbooks with the double-digit unemployment rate right now, and at what point that hurts Campbell's.
Yeah. Well, I think, we've said all along that of the macro trends that we expect to see shaping the future, and again, this goes well beyond just the pandemic moment we're in, has been this orientation around value. And I think for us as a company, we feel, and historically speaking, we're pretty well positioned to meet those needs. And if you pair that with some of the behaviors I was talking before about cooking and the ability to feed your family at a relatively lower price by cooking simple meals and utilizing products versus potentially eating out, or as you're making trade-offs, being able to do it with products like broth and condensed soup that are fairly economical, but also able to meet the needs of your family. I do think what we're seeing in market right now is not a major step down, but an initial, what I'd call defensive economic behavior. So we may be buying the same amount of products, but people are doing it in more frequent, smaller shopping trips. So I think people are thinking more specifically about each of the trips. What do I really need now versus what we were seeing a couple months ago where we were really loading up pantries. And so I think what we've got to make sure is that our presence, our frequency of promotion and marketing is at a higher rate to make sure that we're meeting consumers when they're going in to purchase instead of just maybe setting up that one big time purchase. So that's usually an early indicator, but I do agree. I think value is going to be quite important as we navigate through this period and probably well into the future.
Mark, love to have you back on, talk a little bit more about consumer trends. We've got a major sell-off, though, on our hands here in this final half hour of trade. Thank you for joining us. Mark Klaus, the CEO of Campbell's Soup. Worst drop. Thank you. Worst drop for stocks since June. The high-flying chip sector getting wrecked in today's sell-off. Josh Lipton has a look at some of the movers there. Josh, what do you see?
So, Sarah, remember, semis just rocketed off their March lows, surging about 80%, but not in today's trade. Check out that sector. It is deep in the red, on track here for its worst day since June. Two analysts did tell me at least some of the sell-off here they think could be due to Ciena. It's a company that builds optical components, reported and missed guidance. Is Ciena an outlier, they're asking, or the start of a broader trend? So what are the potential concerns chip investors do need to watch for in the months ahead? Well, one chip analyst told me valuation is certainly among them. Many names are priced, as he puts it, to perfection at this point. And the election, meaning how does that impact U.S.-China dynamics in the months ahead? Guys, back to you.
Josh, thanks so much for that. Still ahead, some of Wall Street's most loved tech names are seeing the biggest declines in today's session. We'll speak with an analyst who has a bold call on where those stocks should head next as we head to break. A check on bonds, which are seeing big moves as well, not perhaps as pronounced as the equity markets. The 10-year yield down to 0.62%, but the big moves in equities. NASDAQ comp down 5.6%. We're back in a couple minutes.
The Bond Report is brought to you by PIMCO, a global leader in active fixed income.
Everybody wants to become a better leader. The new book, How to Lead, Wisdom from the World's Greatest CEOs, Founders, and Game Changers by David M. Rubenstein, shows you how. The essential leadership playbook, How to Lead, is available now wherever books are sold.
I like Liberty Mutual. They get that no two people are alike. And customize your car insurance so you only pay for what you need. What do you think?
I don't see it. Only pay for what you need.
Liberty, 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 liberty.
When the world gets complicated, a lot goes through your mind. With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. That's the clarity you get with Fidelity Wealth Management.
This is such an amazing event. The tradition and the history behind the tournament.
ANA Inspiration is
like the Masters for the ladies tour.
The ANA Inspiration, next Thursday at noon on Golf.
Good morning, everybody. How you doing?
Here's a hint about how to make working from home less stressful and more comfortable. Make the switch to X-Chair. No matter where you put the amazing X-Chair, it instantly becomes the most comfortable place in any space. Infinite side-float recline and dynamic variable lumbar support make the X-Chair a customer favorite at home and work. Don't forget, the X-Chair lets you customize for the same measure of amazing comfort no matter what your size. And every model is in stock, ready to ship the next day, so you can join the thousands of others who have discovered the joy of working in comfort. Once someone sits in an X-Chair and feels the amazing DVL support, it's almost impossible to get them out of it. But don't worry, you don't have to share, because there's an X-Chair for everyone. And you can get $100 off any model on our website. Your new normal? Incredibly comfortable. Call or click to order today and receive a 30-day risk-free trial and $100 off.
Let's get back to the broader market with losses accelerating here into the close. Charles Schwab, Chief Investment Strategist Lizanne Saunders joins us on the news line with us down over 5% on the NASDAQ. Lizanne, clearly it's the recent outperformers in the tech side that are selling off the most, but a very clear broad sell-off. Does that suggest this idea of when tech stocks do pull back, it'll lead to a rotation isn't accurate, and that if things start selling off, everything gets dragged down?
Well, it can be a little bit of both. You can see a rotation in the market. You're certainly seeing that today with a huge spread between, 6.5% drop in tech and energy, which is the best performing sector. It's still down 1%, but that's a significant gap. So I think you can have a combination of a pullback, and by virtue of the power of the size of the big names, if they have big sell-offs, they're going to drag the overall index down, given that the top 5 by market cap stocks in the S&P basically make up their own quartile. But it can be in conjunction with a rotation into other more classically cyclical areas. The rub there is I think the economic data will have to stay for the most part on a positive trajectory to justify the rotation into those more classical cyclical. So that's the potential risk if this rotation continues.
I think what makes it scarier on a day like today, Lizanne, is that the the slides come so fast and so abruptly. I mean, obviously the market can't go up every single day forever, and we were in a very long streak of record close after record close after record close, so perhaps we were due, but to get 4 or 5% moves can be a scary thing to look at your portfolio. So what do you tell your clients when they call you and say, what's happening? Should I get out? Is that
scary,
it?
But that's the nature of a move like this. When you have such narrowness in the market and such dominance by a small group of names, it's hard to pinpoint the precise time at which we'll see some sort of reversion in whatever form that takes. But as you get more stretched, the likelihood that it happens more swiftly in a condensed period of time increases. And I think there's been an appropriate focus on the risk associated with such a small percentage of companies driving. And then when you add in, not across the spectrum of cohorts in the market, but certainly a tremendous amount of speculative frenzied activity seen in certain pockets of the market, in some of the split stocks, in those high momentum stocks, in just a very small subset in the options market. I think that also adds to the risk that if you get a catalyst, or the catalyst is just that the market starts to rotate or sell off, it can pick up speed pretty quickly.
Lizanne, are you telling your clients to buy this dip, or do you think in the short term it's got a few more percent or more to slip?
You know, my bailiwick is not sort of the short-term, very short-term trading. You know, we've been telling investors to maybe be more mindful of more frequent rebalancing, take advantage of moves in both directions, to maybe rebalance based on portfolio moves as opposed to having rebalancing be calendar driven. I'm not sure that just today's weakness is sufficient enough to ease some of those excesses and tell the short-term folks this is the kind of dip you want to buy. You know, I don't have a clearer crystal ball than anybody else, but certainly the excesses suggest something more than just a single-day compression in the high flyers may be necessary to kind of right the ship.
Lizanne, thanks for joining us. We are down 5.3% on the NASDAQ, 4% nearly on the S&P 500. Travel stocks holding up slightly better compared to the broader market today. Shares of online travel company Booking Holdings on a tear since the March lows, up 68% from that point. For more on whether this rally in the stock is being reflected in consumer travel demand, let's bring in Booking Holdings CEO Glenn Fogel. Glenn, thanks for joining us. I mean, recent release, 91% fall in bookings for Q2. I guess, year over year, perhaps that shouldn't be a surprise. So it's hard to see how that could have been much worse. But are you seeing any green shoots since then from that?
Well, we talked in our earnings call that we did see some continued improvement throughout the second quarter. So that was good. Of course, now we've seen a little bit of a plateauing around the world as you see either a resurgence of the virus in different areas, and countries are saying, hey, we're not so sure we want to have so many people traveling or not, and just people getting a little more concerned. When you see those rates go up in terms of infections, you see people stop wanting to travel as much. So obviously what we need is a vaccine that would cure our problems.
But we've seen numbers go down, Glenn, just in the last few weeks or so since the peak. Have you seen any pickup of activity? Is it that correlated to what's happening, or is it really just going to take something major like a vaccine to bring back confidence?
Well, I think you really will need a vaccine that makes people feel safe to travel, to get us back to where we were in 2019. And we've been constant in saying that it's not going to happen overnight. Even after we get that vaccine, it's going to get time. It's time to get that out and distributed. And we say that the recovery for us and for travel in general, it's not in quarters, it's in years. No matter what we do in terms of a vaccine, it's going to take time.
I wanted to ask you about the various categories within travel. It's not all equal, right? Airlines, are they getting hit worse than hotels? And if so, what type of hotels? Because we're seeing some leisure demand come back and not business demand. So where are the relative winners and losers here in this space?
Well, no doubt the airlines certainly took it hardest. And one of the things that you see is that people are still willing to travel domestically and close to home. So if you can drive somewhere, you can go to a hotel that's not so far from you. You can still have a great vacation. But a lot of people say, I'm not comfortable getting onto an airplane. But of course, it differs throughout the world. So China, for example, in July, their domestic air business was down only a little bit less than 30% down, Whereas in the U.S., for that same month of July, year over year, well, we were down almost 70%, or a little bit more than 70%, I believe. So that shows how different it can be depending on how that country is doing in terms of the virus.
Thank you for joining us, Glenn Fogel. We appreciate the update. Booking Holdings CEO. Up next, uninterrupted coverage of these final minutes of this wild trading day when we take you inside the market zone. S&P right now is down 3.8%. The Nasdaq's down 5.25%. The Dow is down 900 points. This is the worst day for stocks since June. We're marching into the close next.
We're Carvana, the company who invented car vending machines and buying a car 100% online. Now we've created a brand new way for you to sell your car. Whether it's a year old or a few years old, we want to buy your car. So go to Carvana and enter your license plate, answer a few questions, and our techno wizardry calculates your car's value and gives you a real offer in seconds. When you're ready, we'll come to you, pay you on the spot, and pick up your car. That's it. So ditch the old way of selling your car and say hello to the new way at Carvana.
The nation's black workforce, striving for success and equality. Ideas to bridge the gap. Expert insight from corporate leaders and entrepreneurs. Charting the path forward. Race and opportunity in America. Tuesday, 7 Eastern, CNBC.
This is cellulose acetate, a plant-based material that's not only extremely durable, but also quite flexible, making it ideal for Warby Parker glasses, which, by the way, start at $95, including prescription lenses. Try 5 pairs for free at warbyparker.com. Oh yeah, about those prescription lenses. Warby Parker glasses come standard with custom-cut polycarbonate lenses that have been treated with scratch-resistant and anti-reflective coatings. Nice. Try 5 pairs for free at warbyparker.com.
Today, baldness can be optional.
With Hims, I have my hair back and I feel awesome.
With Hims, I've got my confidence back.
Hims made it so easy and I love the results.
Get a 90-day money-back guarantee at forhims.com.
Roxy loves Farmer's Dog. It smells good, comes in these convenient little packs. It's made my life so much simpler. This dog is my heart. I want her to have a long and healthy life.
Visit betterforthem.com.
Right now, the worst place to be is stuck in between. Accelerate your investments or pull back. Change the plan or stay the course. That's why Northern Trust is here. With specialized expertise, a history of success through every economic climate, and proven strategies rooted in data and analytics, giving you more control, clarity, and confidence. For now and whatever's next, Northern Trust Wealth Management.
You should be mad they gave this guy a promotion. You should be mad at forced camaraderie. And you should be mad at tech that makes things worse. But you're not mad, because you have E-Trade, whose tech makes life easier by automatically adding technical patterns on charts and helping you understand what they mean. Don't get mad. Get E-Trade's simplified technical analysis.
The Market Zone is sponsored by E-Trade. Trade commission free today with no account minimums.
We've got just about 15 minutes left in the trading day. We are now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli here, as always, to break down these crucial moments of the trading day. And today we've got Hightower chief investment strategist Stephanie Link here as well. We've got to kick it off with the broader market and this big sell-off. Stocks plunging into the close. We're off the worst levels of the session, but we're still on track for the worst day since June 11th. The Dow down more than 1,000 points. Just a few minutes ago, it's now down about 879 points. The sell-off is led by technology. All the winners lately, Salesforce, Microsoft, Apple, those are the biggest drags on the Dow today. And Mike, the Nasdaq is now looking at its worst day since March, getting hit particularly hard. No catalyst. Is this the kind of corrective move from a record high that feels healthy? How should we look at it?
It could develop certainly into something healthy, but I think mostly it's also a measure of how persistent and steep the angle of ascent was, right? So the NASDAQ 100 made a new high 13 straight days. We're now down 5% on that NASDAQ composite, and we're only back to where we traded last Tuesday. Okay, so that just sort of tells you, yeah, sure, this is a sharp move in a short period of time, but it didn't take you back very far in terms of going back into the past. And so it's not clear to me that a one-day gut check necessarily flushes away a lot of the buildup of excess. Now, it's just kind of a flush of hot money out of the market, initially anyway. But the problem is when a rally goes for a long period of time and it's strong and people are amazed by it, it's going up on no news, right? We're down on no news today. It really wasn't up on much news. What it means is the last people in, the incremental dollars are coming from people who simply don't want to miss that move. And so it's only because it keeps going up that they're in. When it stops going up, they don't want to be in. And so that's the initial phase of this process. It absolutely can just be a healthy cleansing thing, but doesn't mean that one day does it.
Mike, is the VIX up more or less than we'd expect? And what other signals are we looking at today that give us any indication of whether this is just the start of something bigger to come?
It's at a higher level than we would expect, and it has been very twitchy to the upside. So 35 is relatively elevated, but what was interesting about it is it's coming from the mid-20s, even though the index, the S&P, was at an all-time high. That's been unusual. We've talked about election hedging. It's been persistent. We've talked about this incredibly kind of strong stampede of speculation in short-term upside bets in the options market that did also feed into higher volatility readings out there. A lot of that is getting unwound today. And so that's kind of an accelerant to the move both on the upside and the downside.
So, Stephanie, how do you look at a move like today? Do you consider it a speed bump on the way up, and all the reasons you liked stocks yesterday are still the same today? Or are you prepared for something perhaps longer, more damaging on some of the headwinds that we've discussed that are still out there, very much alive in the economy, in the markets, and in corporate America?
Well, I think today, seeing a profit taking and seeing some selling today in tech and in growth is very healthy because we were on a huge ride, right? I mean, it has been an amazing run since the March lows. I look at some of these technology stocks, Apple, Nvidia, Amazon, up 100 to 200% since the March lows. Zoom, up 267% since the March lows. Tesla, well, you know about that one. That one I just scratched my head. But the point of it is that it's very healthy to see a pullback. I think the other part of what's happening today, though, Sarah, is we had another day where we had better than expected economic data. You know I have been talking about this forever, that we've seen a recovery off the lows in housing, auto, some parts of consumer, definitely manufacturing. Today we got better productivity, better unit labor costs, better ISM, and even initial claims, still terrible, but we're going in the right direction on a 4-week moving average. Then you add in the ISM report, the prices index is at now a 2-year high. Does that indicate inflation? I don't think so. I don't think we have to worry about that right now. But when you get better economic growth and you get a little bit more inflation, that tends to be a good recipe for cyclicals and value stocks. And so I think that's part of it, of what you're seeing today. And I think at the same time, these, again, tech got way over their skis. I think you wait for a pullback. Somebody asked me today, are you buying any tech today? No, not yet. They're not down enough yet. But I am involved in the cyclicals, and they are helping today offset the weakness in tech.
They're not down enough yet. Let's see what Dan Ives from Wedbush thinks, tech analyst there. Dan, is this a buying opportunity for some of your favored names? I know you're a big long-term bull on Apple. Is a, 8% decline a big buying opportunity?
Yeah, I mean, I view it, look, my view is FANG and tech names go another 20, 25% higher over the next 6 to 9 months. And, our call really since March has been, it's not going to be a straight line. We're going to have speed bumps along the way, like today, healthy pullbacks, as Stephanie's talking about. But to me in tech, if I look at the secular fundamental drivers, continue to be bullish, green light to own tech. And I can tell you today, institutional investors, 2-to-1 ratio, investors looking to buy the dips and what names to do work on rather than, hitting the sort of exit on this sort of sell-off. So to me, continues to sort of be a golden age to buy tech and a re-rating, and we're sort of, to us, the bullish thesis remains unchanged.
Isn't it kind of a crowded trade, Dan? Doesn't it bother you when every analyst like you is rushing to raise their price targets and everyone is saying buy and it goes up every single day to these crazy valuations, or maybe not, but we've certainly heard that before, and we haven't seen valuations like this on some of these stocks. Does any of that side of it bother you versus the fundamental case that you've laid out?
Yeah, in terms of the overcrowding trade, I mean, there's definitely obviously clear momentum, especially when you look more narrow in tech. But to me, the stronger getting stronger in terms of the secular growth drivers. In 20 years plus covering tech, cloud, 5G, cybersecurity, and what I think overall some of the most transformational trends, even the EV. When I look at Tesla, but I view this as opportunities in terms of just a re-rating in tech, which I still view in the 6th, 7th inning. Not the 9th inning of playing out. And then that's sort of our call as we go into year end, and we continue to think FANG and tech stocks going to 20, 25% higher.
Are you not concerned, Dan, when you see the huge rallies we saw in both Tesla and Apple following their stock splits, and that there was some sort of unsustainable and non-fundamental based rallies in those stock prices?
Yeah, and I think our way to view that is it's forest for the trees. When I look at Apple, the reason we own it is not for what happens next 24 hours in terms of encouraging investors, why to play the 5G super cycle. Because I think this is a once-in-a-decade opportunity for Apple. That's why, to me, you own it for the next year or two, and these are just healthy sort of speed bumps as we get there, in terms of 150 and our bull case 175. In terms of Tesla, obviously a lot of sort of momentum, especially on the retail side, but institutional, there continues to be massive demand. I look into battery day and what's happening in the EV market, especially in China. Tesla continues to be one biased upside in terms of that bull case $700, although it's going to be risky and turbulent to get there. But I think on the other side of the dark valley, tech continues to be the way to play this market, even though it's a bit of a white knuckles today.
By the way, as we're looking at the shares of Tesla, 405 was an important level on the stock. That was the low from today and from yesterday. It just broke below that. So potentially a key level, according to Matt Maley, who's a technical analyst at Miller Tabak. Maybe 400 would be a bigger support level, he says, because it's a round number. But clearly 405 was a big one, Mike. It shows that there is some momentum coming out of these stocks like Tesla and Apple and Zoom, which we saw yesterday a little bit early and then saw it today as well. What is the valuation case right now for a name like Tesla? Everyone said it doesn't matter until it does, when it starts selling off, and then you realize a lot of it has been momentum.
Yeah, there isn't. I mean, there's not a near-term valuation case that you point to a specific level or a specific ratio that's all of a sudden the stock decline is going to halt. It's about big picture, huge market opportunity. How huge can the market get, and what role will Tesla have in it? Right now, it's really just becoming it's an unwind of what a clear overshoot in the stock. I mean, it doesn't mean that it couldn't have gone higher, but it takes even more incremental energy on the buy side to get a stock to continue to go up at that kind of an angle. I mean, it's not that surprising. Tesla's had many of these, kind of sharp peak, peaks on its chart over the years. And yes, it's come back from them. So I don't think there's anything you're pointing to here except for psychology. In the short term, it's crowd psychology. The stock was up 60% from announcing a stock split to the execution of the split on pure mob psychology.
Dan Ives, thanks so much for joining us, by the way, from Wedbush Securities. Meantime, the Justice Department's reportedly preparing to file antitrust charges against Google. Deirdre Bose has got the details of that story for us. Hi, Dee.
Hey, Wilf, and that could come in the coming weeks, according to the New York Times. This isn't entirely unexpected because there have been previous reports that the case was likely to be brought against Google this summer. So laying out the charges would be the first step. A lawsuit would then get underway with the DOJ providing evidence of Google's dominance in advertising and search. A successful suit, guys, could result in a monetary penalty or even reshape the way that the company operates. Now, the Times also reporting that Attorney General Barr overruled career lawyers who pushed for more time to build a stronger case. Google shares, as you can see, they are trading close to session lows, but guys, that has been heading lower throughout the session along with the broader tech sell-off. Back to you.
Deep, thanks so much for that. Yeah, as you said, Google's been down for most of the session, sticking around that level of down 5%. The NASDAQ composite is down 5%. It's off the session lows, but only just slightly, and with S&P's down 3.5%. Going back to the broader market, Stephanie Link, in terms of whether we're due a rotation, whether those cyclicals can pick up some of this slack, I totally get your argument that we've had better data, but then why has the long end of the yield curve moved down so markedly over the course of the last week? And does that mean within the cyclicals that in fact banks aren't the place to be, because even if the economy's picking up, the yield curve isn't?
Well, I think
the bond market is very heavily influenced with the Fed, right? So I think that's going to keep the lid overall on rates. So, yeah, do you want to be in financials in that environment? You definitely want a steep yield curve. There's no doubt about it. I think over time, people, they don't believe in the recovery in the economy just yet. And I think over time, you will start to see believers. And as that happens, I think you will see a steeper yield curve. We actually did get a steeper yield curve for three weeks prior to this week. So I say that in terms of financials, I own them. I own special situation stories. But in the cyclicals, I am more overweight industrials and in discretionary because I do think industrials, there's huge operating leverage. These companies have done such a masterful job in controlling costs and restructuring, in increasing productivity. So their margins have stayed elevated. If you just get a little bit of top line demand, you get huge operating leverage for next year. So that's where I'm really making my bet. And discretionary, I said we have the haves and the have-nots. Costco again today or last night with their comp number for August was just huge. Target and Walmart and Home Depot and Lowe's, Stanley Black & Decker in there as well. So I own a fair amount of discretionary, but special situations, and I do barbell it with a few reopenings like a Wynn Resort.
We're down 810 points on the Dow. We were down 1,000 about 20 minutes ago, so off the lows, but still a pretty brutal sell-off. Worst day for stocks since June, both for the Dow and the S&P. For the NASDAQ, it's back since March. NASDAQ down almost 5%. 2 minutes left, Mike. What are you seeing in the internals?
Weak, but not as bad as you might think. And so that points to at least a little bit of strength on the laggard stocks. So you see it's about not quite 3-to-1 declining to advancing volume on the New York Stock Exchange. Of course, the NASDAQ is a good deal worse. It's more like 5-to-1. But this is not as much of a washout below the surface, much like the rally, which was kind of narrow and concentrated in some of the cult momentum kind of glamour names. The pullback is also most concentrated in that area. Take a look, too, at some of the sector moves we have as well. Taking a look at, that's right, high yield. So we're seeing a little bit of stress in credit. It's not really a perfect depiction of what's going on in credit spreads, but you have seen high yield ETFs soften up against what treasuries are doing, which is rallying. Something to watch, but it's really not bad on a week-to-date basis. So it's not like it's broad financial stress evident right here. And the volatility indexes, here's both of them, both for the S&P VIX as well as the VXN, the NASDAQ version of it. That's a pretty good little turn higher, and it sort of puts the market on alert that maybe this is not just a one-day thing. It also shows, again, that buying panic in options filtering through into these measures as well.
Mike, thanks so much for that. We've got, 40 seconds left of the session. We are down 4.9% on the NASDAQ composite. At the low of the session, it was down 5.3, 5.4%. The S&P is down 3.5%. The Dow is down 793 points, or 2.7%. It was down over 1,000 points briefly at the low. All 11 sectors are in the red as we speak. Tech, the worst, as we've been saying, down 5.7. Energy, the best, down only 0.7%. Seeing a slightly soft gold price as well, slightly soft dollar, slightly soft oil price. But the action today very much in the equity market more than anywhere else. The NASDAQ composite closing down nearly 600 points, or nearly 5%. The S&P 500 down 3.5%, and the Dow down just shy of 3%.
And now lower on the week. 4 stocks could be set to break that 5-week win streak. Welcome back, everyone, to Closing Bell. If you're just joining us, I'm Sarah Eisen here with Wilfred Frost and Mike Santoli, CNBC senior markets commentator. A major sell-off today on Wall Street. Let's see where things ended up. The Dow closing down 810 points, down 2.8%. It was the winners that got sold off the hardest and dragged the Dow lower. We're talking about Apple, Microsoft, CRM, which is Salesforce, Home Depot. Those were all the losers today. The S&P 500 down 3.5%. Worst day for stocks since back in early June. Keep in mind, we were coming off of a record high, but it was a sharp, nasty pullback. All 11 sectors ended lower, led down by technology. No surprise, the NASDAQ got hit the hardest. It's been the biggest winner. It closed the day down almost 5%, 4.96%, down almost 600 points there on the NASDAQ. A lot of those high flyers, all the FANG names, the software names, the chip stocks that had been leading this market got hammered today. The Russell 2000 index of small caps down 3%. It had been lagging all year long and actually fared better, which was a theme we saw. There were actually some winners today that held up better, like airlines and cruises and energy stocks that hadn't been doing well all year long. We're going to talk a lot about this market. We're going to get reaction to the tech wreck when we are joined by famed investor Roger McNamee. Find out whether he thinks today's sell-off is a buying opportunity for what has been the red-hot sector of 2020 so far. First off, let's talk about what just happened. Stephanie Link is still here from Hightower. Our own Jim Cramer, Mad Money host, Squawk on the Street host, is joining the closing bell right now. Jim, we dragged you back from vacation. There's no such thing as a vacation when we get a market day like today. What are your thoughts on what happened and what investors should be doing?
Well, first, how are you guys doing? Doing a great job this last hour. Really put it in great perspective for me. Of course, I was saucing, but because when I'm away, we always have a crash. I would tell you this. I think that there's a lot of bad money in the market. Money that only knows that stocks go up. A lot of millionaires created. I'm not kidding. Millionaires created, not index people. And I think we are so far away. I mean, I got to tell you, we are so far away that a level that the institutions would like it, that you really have to wonder, Sarah and Will, whether there's any level here that people would get excited about the companies that are selling, not at times earnings, but times sales. In the meantime, what are they like? Well, you know, they're going into the open America trade. I mean, are you kidding? Does America seem open to you? Is it time to take a cruise? So I don't know. I'm very skeptical about today's action, other than the fact that there are a lot of people who made a lot of money and they've never sold, and they're being sold by margin. They're being sold by brokerage houses because all they know is that stocks go higher. The legion of people who know that stocks only go higher is the largest I've ever seen it does.
Jim, if you're sourcing today, it means you must have finished your NFL draft. So look forward to seeing the results of that as well at some point. In terms of your point there that retail investors have been buying recently, are you worried now that we've had a meaningful turn down that there's just going to be an air pocket below, that this is the start of what could be a much bigger pullback than we'd typically be used to after a decent market run?
Yeah, I am. I am, because when you see stocks that are down 10%, that means there are people who are frantically still trying to get rid of these stocks at the bell. When you see things like American Express doing very well, and Royal Caribbean, Norwegian, these are like the last vestige of the people who really are newbies. They like to go to these stocks. I know Stephanie will probably say American Express is good. I think American Express and travel are not the places to be right now. What really does concern me is that we had some blow-ups. I know that they're not big companies, PagerDuty. I know Ciena's not that big. I know Zora's not that big. But these are all business to business. These are all these enterprise companies that would be like a Cisco. And you don't want those to start going down. There's way too much in the economy that's been hot that is connected to those very small companies that no one's ever heard of, but they're bad. And they're bad to the point where there'll be analysts who say, you know what, maybe it's time for me to say, ring the register. I think there'll be analysts tomorrow who finally say, you know what, September's a bad month. We're up really huge. Why don't you take some profits? And when that happens, the people who don't have any capital are in this market, the Robin Hoodites, the newbies, I don't know if they even know what margin is. I mean, to me, they think that margin is the margin of how a football team beats another football team. And I think football's coming back, and that betting money is going to leave the stock market and going to go to the NFL. Crazy.
So the advice then to long-term investors, Jim, is to what? Stick with those companies that you like, Apple, Salesforce, Microsoft, the ones that got hit really hard today?
No, I think that they should stop being greedy.
Profits.
They should stop being greedy. I mean, I was talking to a couple of people who've been in it. They're not suits, but people have been at it even longer than I have. And I've been trading since 42 years. And all of them felt the same way, which is that, well, you know what? We stopped taking profits. Why? Because we couldn't take it. We felt so stupid. We felt bad. When you get that attitude with the reference that I just mentioned to margin, what that means is there's a day 2, day 3. We're going to a long day, long weekend. Like I said, September's a terrible month. I didn't like what went up today. I listened to your Campbell Soup interview, and it was really good. But what it said is, please sell my stock. I don't think you should be in my stock. Not very reassured. So what I say is that the beginning of this sell-off was with Tesla. It's with supply. There's about $6 billion worth of IPOs coming. There's a lot of direct IPO listings that are coming, and there's a lot of insider selling for the first time. So I'm uncomfortable. I mean, I've never seen so much money made so easily in my life. I mean, there was my friend Dave Portnoy had a picture yesterday in Twitter, and it had 8 guys, new millionaires. I mean, I swear. I mean, these were guys who probably would have lost money every weekend betting against the spread, and suddenly they're millionaires. I mean, these millionaires are being created so quickly that they're going to be taken away so quickly. I like them. It's not too late for them to take profits. I think they're terrific, but they hate the word profit. They hate it when it comes to what companies do, and they hate it when it comes to their accounts.
Mike Santoli, I mean, we haven't even had, despite today's headline-grabbing declines, a big pullback yet relative to the increase. What would still be even just a understandable, relatively small gut check?
Well, I mean, yeah, we're back to levels we were early last week, which is kind of both the good and the bad news, because it's not really skimmed away a lot of that maybe excess and over-aggression that was in the market right now. I mean, what would be normal? I mean, just in terms of very minimal type pullback for the Nasdaq, I think would be, you know, below 11,000, and then try to figure things out. That's not down from here very much. And then, you know, the S&P, I said a lot of times you get to a new high and it's a matter of, okay, let's go back and make sure that was the real thing when we broke out above it, and then that's still only a couple % down from here. So I don't know that we're necessarily talking about magical levels right here. It's much more about if the biggest liabilities of this market that we've been talking about are, you know, over-aggressive sentiment and technical conditions that are way, way, way stretched. Today went some distance toward taking that, you know, taking care of those, but really not the full way.
Yeah, Stephanie, there were warning signs all over the place, and we had talked a lot about them on this show. The fact that the bears basically exited the market. Some measures of investor sentiment were at levels we didn't see since, you know, the dot-com craze. You saw technical indicators like relative strength going into overbought territory. All of this was writing on the wall. So what's the prudent thing to do given that backdrop?
Well, I mean, just to put it into perspective, the Russell 1000 growth is up 25% year to date. The XLK is up 30% year to date, even with the pullback today. The Russell 1000 value is down 11% year to date. I worry more about these high flyer tech stocks. There's a lot that they can do in terms of downside because you can't really value them. We have talked endlessly about total addressable markets, and I truly believe in them. In Internet of Things and in cloud and retail e-commerce and wearables, all that's good. But the valuations of the stocks themselves were more than reflecting these total addressable markets at one point. So I do worry about some tech. The cyclicals, on the other hand, they're still down. They're down like 20, 30%. I mean, financials are still down 18% on the year. Energy, which I really am not involved in, but it's down 41% on the year. So I think it's a stock picker's market. You pick your stocks. You have a barbell. I'm not ready to buy on tech, like Jim just said. I think there's a ways to go on tech, especially the high flyers. But I will pick eventually because, again, the growth is there. But I also want to own the economically sensitive stocks, because I do believe the economy is recovering and will recover into next year. And that will bring profits to the cyclicals higher.
Jim, how many 800-point down days are we going to need to see before we get a stimulus deal out of Washington?
Well, I think that both sides think it's good for them not to get a stimulus bill. And plus, there are also people who can argue, including 20 Senate Republicans, that things are better in the economy. I think the better in the economy, by the way, is bad, because the reason why you want all these tech stocks is because they do well when the economy's terrible. They are COVID stocks, and a COVID stock is not going to rally if the economy's getting better. I think that Speaker Pelosi and Ms. Meadow, the chief of staff, they hate each other. Okay, they hate each other. It's all right. People hate each other. I've hated a lot of people. You've hated, you know, it's the way it is down there. And they don't really care. I mean, they did care for a while, but now we're so close to the election. I think both sides think, you know what? If the economy is bad, you know, good for Biden. If the economy is bad, President Trump will blame the Democrats. So it's an unholy alliance between no one. I also think, I listened to what Stephanie said. I think that the economy is getting a little bit stronger, but it's day to day. I mean, we have more outbursts. We have more, if we don't get the vaccine, aren't we all tired of waiting for the vaccine? We don't get more testing. If we don't get this, if we don't get more of that. And I think people say, well, wait a second. Why do I want to buy DocuSign down 40? Is that the level? Is Peloton, is it the magic level 74? I mean, what the hell? These things are up so much. I have no idea where they would stop. At the same time, when I look at some of the cyclicals, when I look at some of the retailers, I can at least value them, but I don't know if their numbers are going to be better next year or not without a vaccine. So what I'm saying is Washington's a mess. Science is a mess. I still believe in science ultimately, But I think I understand that when I see Merck and Lilly do okay, that says to me the economy's slowing. When I see oil going down, that says the economy's slowing. But when I see the cruise ships going up, that just says I see stupid money buying cruise ships. I think there's a lot of stupid money. And the stupid money's made fortunes. I love them. It's fantastic. But they have to take something off the table so that they're not going to be poor again. They didn't do it in 2000. I am imploring the younger people who are watching to understand that you can't keep borrowing money and say you're a millionaire. Become a millionaire. Become a 500,000 millionaire. But I am asking you, please, to take something off the table so you don't say, you know what was I thinking? Why didn't I take something off the table? Because that's what happened in 2000. Are they better companies now? Yes. Are the balance sheets better? Yes. Are they more expensive now than then? Maybe. Arguably, some yes, some no. I just went, and Stephanie, you traded with me for a long time. You know, Stephanie, we can't have these people lose what they have.
100% agree. You're the best tactical trader I know out there, and that's what you taught me. So I agree. Look, I sold some Facebook. I sold some Amazon like 20, 30, 50 points ago. I mean, and I had made really good money. And at the same time, I just didn't feel comfortable, especially when everyone is on one side of the game. And so that is why, though, Jim, even though we can't tell for certain that the economy is going to roar back, I can't tell you that. I could just tell you incrementally things are getting a little better in certain pockets of the economy, and those stocks are not pricing in anything. They're not pricing in a recovery because they're still down so much, and they're not over-owned. In fact, they're under-owned, quite frankly. So that's why I say you want to own both. You want to find tech when it's down another 10% or so. There are going to be bargains out there at some point, but I don't want to chase right now, not down here. I mean, it's just not down enough. And at the same time, I feel comfortable with some of the names, like American Express, that you mentioned. I still like that one, and I feel good about it.
Mike, we've seen all the account opening.
You and I are too much of a mind meld, and I know people at home are saying, what are they, like, out of their minds and they agree on things? But they work together for a long time. And, yes, down 10%, a lot of tech is going to be interesting. I do think that I'm worried about the bank loans. A lot of things have been thrown at the banks, but I don't know what the upside is if it turns out that there's a lot of foreclosures and we don't get a deal. I thought that the banks would really rally on a deal between Mnuchin and Pelosi, but I don't know where Mnuchin is. And I know that the president is, well, let's just say the president's, I don't know.
The banks as well, Jim, of course, have suffered from yields pulling back over the course of the last week. Every time they seem to find a mini catalyst, it seems to evaporate about a week later. Mike Santoli, we've seen all the huge numbers for account openings for all the different online trading platforms, not just Robinhood. If some of those new entrants to the market in the last 3 months listen to what Jim Cramer is telling them right now, that they need to actually take a meaningful amount of profits, how much downside is there? How much of where we are at the moment in the markets has been pushed higher by those new entrants in the last 2 or 3 months?
I think, look, it's where all the incremental energy is coming from in the cult stocks, in the cloud stocks, in the fast-moving stuff. So I don't think that they really wield that much aggregate financial power, but they definitely are the source of the stuff that just won't take a rest on the way up. And it's interesting because, you know, there was this talk about Robinhood, as many other brokers do, selling their order flow. Why would market makers want to interact with that order flow? Because it's undisciplined and it's emotional, and it creates these movements all in one direction. And you can, you know, you can trade against it, you can model those things. And so it's a different type of energy in this market, which has for many years now been very kind of algorithmic, put it in the box, everyone's got the same quant models. So it's a new thing. I don't think it's necessarily a matter of making or breaking the market, but it definitely is certainly more of a source of potential downside, I think, in the very short term than upside.
Jim mentioned DocuSign as sort of emblematic of what was happening. It got crushed today, down almost 9%. Just reporting earnings. Deirdre Bosa has the numbers for us. Deirdre.
Hey, Sarah, DocuSign easily beating the street's expectations on the top and bottom line. 17 cents earnings per share, 8 cents was expected. Revenue of $342 million, above the $319 million expected. That's revenue growth of 45%. Now, as we've been talking about all day, DocuSign is one of these work-from-home darlings. Got hit pretty hard in the session today, but still up more than 200% year to date. Now, the stock has been bouncing all around since its earnings report. It was up as much as 7%. It was even in the red for a little bit. And guys, I just wonder if perhaps, the so-called cult of Zoom has now become the curse of Zoom. It reported on Monday more than 350% revenue growth year over year. So DocuSign's revenue growth of 45% looks pretty puny next to that. And that's one of the fears, is that are these gains sustainable for these work from home darlings? I know that Jim and you guys were just talking about. So we'll see as these shares bounce around. I should also note, though, that in terms of third quarter and full year revenue guidance also beating handily. So we'll listen on the call to see if they can perhaps live up to those sky high expectations. Back to you.
Deirdre, thank you. Stock's up 1.25% after hours, Jim. Is this a buy after what we saw today, or is it just crazy expectations still built into these stocks?
Let's put it this way. I think it is the key to this market because just like Deirdre said, if it's going to be a repeat of Zoom, an unbelievable number, and go down, then I think we're going to have some really, really difficult treading. If it can hold, you know what? I mean, look, DocuSign is a merger of stay at home and mortgages. And that's, so that's twice blessed. And that's pretty good. So let's watch that. I think that can actually tell you what can, in many ways, happen with these stocks. But, we've seen stocks, we saw Sienna, which was just a tremendous miss. And we see something, we saw a lot of stocks that I regard as being really good, like CrowdStrike. I thought CrowdStrike was fabulous, right? I mean, I said CrowdStrike, oh, well, that's going to be terrific. And yet, there's so many of these companies. It's like, and they're all selling at such amazing, such amazing levels that everyone, I presume the analysts will raise their price target DocuSign tomorrow. And we have to see. I don't want to presume that it can stay up. But the stuff that went great today, Kohl's, Nordstrom, Macy's, those are open America stocks. And DocuSign's a close America stock with low rates. So I think that DocuSign, as weird as this is actually the key to market trading. Oh, amazing.
Then we will be watching it even closer. It is kind of all over the place. It's now up less than 1%. Jim, you can get back to your saucing for a little bit.
No, I want to say one more thing. If you become a millionaire and you're under 30, you're not a millionaire unless you take some profits. Love you. I think you've done great. But if you become a millionaire, it's not so bad to be a $500,000 a year. There's my final word before I go back to salt.
Okay, Jim Cramer, thank you very much. A rare treat to get Jim from vacation. We appreciate it. And thank you, Stephanie Link, to you as well.
Thank you.
Good to see you as always. We're going to continue the market conversation now, try to help you navigate through these crazy markets. An 800-point sell-off on the Dow. Worst day for stocks since June. Worst day for the NASDAQ and the tech stocks since back in March. Allianz Chief Economic Advisor Mohamed El-Arian joins us. Mohamed, you've been saying this whole thing has been fueled by liquidity and stimulus money, particularly from the Federal Reserve. Nothing fundamentally changed on that front, did it?
No, but I think at some point, Sarah, and thank you for having me, at some point you would expect a pullback. We've had 5 months of consecutive gains. We've had the best August in decades. We've had successive records. And we've had the stock markets decouple from market after market, from the VIX, from the Treasury market, even from the high yield market. So at some point, you should have expected this. What's a really interesting question is what happens next. Does the liquidity conditioning kick in quickly? Because if it doesn't kick in quickly, the derivative markets will take the cash market down a lot more.
Where would you put money, Mohamed, to work in a sort of, whether it's into something that might be a good hedge or just something that will give you a positive, relatively safe return in the years ahead, if you decide to take profits in light of today in the equity market?
And that is the irony, Wilfred. That is the exact irony. I know people who normally would have used treasuries as hedges who have gone into not just investment-grade bond, but short-dated high-yield bond, feeling that the Fed has protected them from any sell-off. The reality is there is no obvious safe hedge in this market. So what people should be doing is a combination of treasuries, a bit of gold, and maybe a bit of really high-quality investment grade. But it is the two problems associated with this market. One is it's technically very stretched, and the other one is that it's not easy to build risk mitigation in a traditional portfolio.
What about the economic backdrop, Mohammed? It has raised questions throughout the record-setting rally about what kind of permanent damage was done, how long it would take us to get back to normal, whether the losses from small businesses was really being reflected, all of this stuff. On the way up, we questioned it, but, you know, on the way down, the question is, has the market woken up to some of this?
So here's an irony, is that despite today's sell-off, and despite the fact that this week's number have been better than expected, the disconnect remains huge. So if you were to look at the year-to-date numbers, you wouldn't be that worried. The S&P is still up 28%. The NASDAQ is still up 28%. The S&P is still up 7%. And all this in an environment in which most people now believe we are not getting a V-shaped recovery. So there's still the issue of disconnect. And that leads to the fundamental issue. And we are going to see investors' DNA in the next few days. Are they fundamentally based DNAs? Like you just heard Jim. Don't touch this market. Hey, all of you that have been in this herd-like behavior, be careful. You may lose your gains. So are you fundamentally based, or are you completely liquidity-based, relying on central bank and therefore going to buy the dip? That is the tug of war that's going to play out, and is going to show the DNA of investors. My own gut feeling is that the liquidity conditioning is still strong, and if it's not, then this market comes down by a lot more.
How much more? If the DNA is more fundamentally driven than liquidity driven, how much more do we fall?
Oh, we could have another 10% fall easily if, I want to stress, if people start thinking fundamentals. Ultimately, Wilfred, it's do you look at absolute valuation or do you look at relative valuation? In relative terms, stocks seem cheap to everything else. In absolute terms, stocks are expensive. If you're in a liquidity-based paradigm, you will be dominated by relative thinking, and that's where we've been. If you're in a fundamentally based paradigm, you ask the question, am I being paid enough? Am I being paid enough yield on high-yield bonds? And the answer is no, you're not paying it for an economy that faces not just moderation in the rate of improvement, but a rising level of bankruptcies.
There's also this other factor I wanted to bring up, Mohammed, which is, you know, we're getting very close to the election, and it's looking more and more uncertain, both the outcome of who could take the White House, what Congress is going to look like, whether we're going to actually get results with all these questions about mail-in voting and whether there's going to be disputes about them. I mean, that's a whole lot of uncertainty for a market at record highs to contend with. How do you think it's being reflected, and what would you be doing to prepare?
I don't think it has been reflected. You know, I've been looking at two things. One is the amount of uncertainty in the run-up to the election, and also what happens after the election. Will it be contested? Will it not be contested? If we have a transition, how orderly will this transition be? There's a ton of uncertainty, Sarah. Markets have shrugged that aside. And then there's been lots of changes also in the relative standing of the two candidates. And again, markets have simply said it doesn't matter, because we are in a liquidity paradigm that's dominated by central bank conditioning. If that changes, then we're going to have to price in that uncertainty. That's why I say to you, if the mindset changes from technicals to fundamentals, then this market has further to go. But it remains to be seen whether it will change. It hasn't in the past. In the past, every buy on dip opportunity has been a profitable one.
Mohammed El-Erian, thanks so much for joining us.
Thank you.
Pleasure as always. Broadcom numbers are out, and Josh Lipton has them for us. Hey, Josh.
Well, Broadcom reporting Q3 EPS here, $5.40 versus expectations of $5.24. Revenue also better than expected, $5.82 billion. Street was at $5.76 billion for the Q4 guidance. Broadcom is expecting $6.4 billion to say plus or minus about $150 million. Street was at $6.2 billion. Just looking at their big segments here, semiconductor solutions $4.21 billion, and infrastructure software at $1.6 billion. That comes in line. That's mostly enterprise software. CEO Hock Tan with a statement here as well, saying our outlook for the fourth quarter, he says, reflects a strong anticipated ramp in wireless as well as the continuing surge in demand for networking from cloud and telecom customers, more than offsetting, he says, expected softness in enterprise. Conference call kicks off at 5 p.m. Eastern. Guys, back to you.
Josh, thank you. With Broadcom shares up 1%, a little more than that after hours. Travel stocks actually held up better today than the broader market despite the sell-off. And since reporting earnings last month, Hyatt stock is up more than 20%. Joining us now is Hyatt President and CEO Mark Huplamazian. Thank you very much, Mark, for joining us. What's going on with demand right now for travelers?
Demand has been on a steady recovery since the lows in the second quarter. April was sort of mid-single-digit occupancies. They've now recovered to mid-20s to maybe low 30s, depending on where you are. They've been progressing, and as we look across the globe, they've been highest, and the recovery has been underway the longest in China, for example, where in July and heading into August, we saw occupancies that were in the 60s. We're seeing some recovery that's been relatively good. It's been driven by leisure, of course, but that's what we're seeing.
How much of your business is business travel, and how do you plan? When is that going to actually come back, and is it going to come back in full?
It will come back for sure, and the composition might look different, but for us, about 45% of our demand around the world comes from leisure travelers, and 55% from corporate travel, business travel, as well as large groups, conventions and exhibitions and the like. And if you look, most of the demand driver in this year so far in the recovery period has been from leisure demand. I would say the one exception, again, is China, where we see, as occupancy started to verge into the 60s, we saw business demand coming back. And of that total occupancy, business demand represented over 25% of that total, 25 to 30%. So business demand has come back. I think as you look more broadly across the globe, it will take some time for business demand to return. People have to be able to get back on planes, for example, and start flying across the world again. But we believe that while the composition will change, some use cases will modify based on hybrid meetings or different processes that companies are putting into place. We do think that ultimately demand does recover. There's a tremendous pent-up demand for it.
Mark, you mentioned you need people to get back on planes. Do you think that is the bigger problem for you right now than your customers fearing going into a hotel or a hotel room? Are they actually quite relaxed about the cleanliness and safety of being in the hotel? It's just that the means to get there are something they're still nervous about.
Well, I think for business travel, for sure, air travel is a key component of that. When you look at occupancies across the entire industry in the United States, they're running about 6 or 7 points lower in the top 25 markets than they are for the country. And the reason for that is because business travel is at historically low levels, and because international arrivals have basically collapsed. They're virtually at a de minimis level, not almost unmeasurable. So it will take some time, and I think it's familiarity. It's knowing someone or having someone that you do business with, having traveled and giving you a direct report, or you actually having traveled yourself. The usage rate and therefore trial rate is still low. Only a third of Americans have taken a trip that's involved an overnight stay since March. And only 38% of Americans think that they're going to travel between now and the end of the year. So we need more people to actually have the experience, because airlines have done an extraordinary job of making that experience safe. And so too as the hotel industry at large, and we have through very planful and deliberate processes and procedures that we put into place.
Mark, I don't know if you saw, I'm sure you saw Hilton Hotel Times Square set to close. That was big news today. Obviously, Manhattan is getting hit pretty hard. 200 layoffs along with that announcement. My question to you really is what the permanent damage is going to be to your industry. How many fewer hotels we're going to see in major urban spots like Manhattan, and how many of this job losses, which your industry has been hit particularly hard, are going to be permanent?
Yeah, it's a little difficult to say what proportion will be permanent. If you look today as a snapshot, about 4 in 10, 40% of the workforce in hotels is not working right now. So it's pretty significant and severe. And to your question, I think there are certain markets that will take some time, maybe a longer period of time to recover. Manhattan is living through, I think, an adjustment period to some supply demand that we experienced in New York over the last several years. And also, New York, more than any other market in the United States, suffers when we don't have international travelers coming to the U.S.
Mark, thanks so much for joining us today. Much appreciated.
My pleasure. Take care.
Let's pivot back to the broader markets. Mike Santoli's taking a look at the recent surge in call option volumes. Mike, what do you got?
Yeah, well, it's been pretty extraordinary. We've been talking about how the options market has really been the epicenter of a lot of both the chase on the upside in the market and then presumably precipitated some of today's sell-off. I want to focus you on the blue line here, which is single stock call options on individual equities, which are used to play further upside in the stock. And you see this is the average daily volume on a 10-day basis. It surged since June of this year, or since early part of this year, since about March, and it is now overtaken coming into this week the white line, which is index and ETF put options, which are used to hedge. That's almost always the greater plurality of the activity here is just hedging instruments. And so this kind of shows there was this kind of fed on itself where people just betting more and more and more on further upside. The market makers having to accommodate that, sometimes had to buy the individual stocks to offset their risk, and that spiraled higher, coiled things very tight, and I think you saw a little bit of this fever break today. And this is something that people have been pointing to as really one of the signs of this welling up of speculative intensity in the markets, and we'll see. It's not clear that one day setback of 5% or so in the NASDAQ is going to be enough to do it, but it's a very interesting dynamic in terms of where really a lot of this action was taking place lately.
Mike, would it suggest, because that big surge came in single stock options, that broader indices might be able to avoid some of the selling if it does proliferate?
Not so much, because, I mean, obviously the indexes are made up of the individual stocks. It does suggest, though, that the pricing of those options got out of whack. People were essentially, I mean, just to be glib about it, you're kind of overpaying beyond face value for a lottery ticket, right? So you already had kind of not so great odds of winning, and then you're overpaying for the privilege of not having that really high probability bet. So I think a lot of it is about, look, these losses will kind of be taken and it'll get flushed away. So I don't know that necessarily the overall indexes have to take a lot of pain, but it does show you that maybe we'll have to rebuild a little bit of this. By the way, it's not necessarily easy to kill. There was a lot of fast profits turned in this area. Maybe people will feel like this is an opportunity to restart it again, but that remains to be seen. We're in a tough part of the year for that.
Yeah. Mike, thanks. Up next, we will get famed investor Roger McNamee's take on today's tech sell-off. Find out whether he thinks Facebook's move to block new political advertising in the week before the election will do anything to quiet the social media giant's critics. That is coming up on Closing Bell.
When the world gets complicated, a lot goes through your mind. With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. That's the clarity you get with Fidelity Wealth Management.
Many U.S. tech companies are global leaders. In this constantly changing sector, it's hard to know which companies will gain, maintain, or lose industry leadership. So why choose? The Technology Sector Spider ETF offers the diversification of the entire technology sector of the S&P 500 while reducing single stock risk. The Technology Sector Spider, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully.
ServiceNow, the smarter way to workflow.
When the world gets complicated, a lot goes through your mind. With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. That's the clarity you get with Fidelity Wealth Management.
Worst day for stocks today since June. If you're looking at the tech-heavy NASDAQ, worst day since March with a 5% move lower, though every sector got caught up in the selling as far as the S&P 500's decline of 3.5%. Technology was by far the biggest decliner, but consumer discretionary, consumer communication services, and industrials not far behind, all lost more than 3% apiece. Let's get to Bob Pisani for more on what happened today, Bob, and what we're watching for in terms of clues as what goes next.
Yeah, this is about frothiness and about some air coming out of the market. And let me just show you what I mean. You have Apple was 120 2 weeks ago, split adjusted. Then it goes to 137, and then it goes back essentially to 120. In 2 weeks, you have a complete inverted V. And much of the market, the tech market looks like that. NVIDIA was $505 5 days ago. 5 days ago, it goes to 580 and then back to essentially 505. All the way up and all the way down again. Cloud stocks did the same thing. Zoom Video was $300 5 days ago. It goes to 480, and now it's 380. It closed around there. It's still up more than 400% on the year, even with that kind of move. Cybersecurity stocks all did the same thing. Zscaler was $142 5 days ago, goes to 160 and closes right back down at essentially 143. Complete up and a complete down. Again, a lot of the market looks like the e-commerce names. Chewy, the pet supply company, right? $60 5 days ago, goes to $70, and now it's back to essentially $60 or $61. A lot of the market looks like that, including the S&P 500, which, by the way, we closed 34.54, I believe. We were that 7 days ago. So the question is this a one-day event, a multi-day event? The pain trade is down because so many people are complacent and long right now. And I think if you have this go on for more than a few days, you're definitely going to drag out more Fed officials talking about them getting even more aggressive. And you're going to hear terms of a definite fiscal deal done in Congress if this goes on for more than a few days. Guys, back to you.
Definite and if, Bob, there. So there's some conflict there, but I get your point. I get your point. Bob Pisani, thanks so much. The NASDAQ closing down nearly 5% today. Let's bring in tech investor Roger McNamee from Elevation Partners. Roger, great to see you. Thanks so much for joining us. I guess we'll get to the pullback in tech stocks in a moment. Also pretty interested to speak to you about the new Facebook policy announced today. And we had Nick Clegg on earlier in the show. What do you make of those new policies? Are you overall delighted to see that they are taking action, or critical that it's too little too late?
Well, it's definitely too little too late. And the issue that we're dealing with here, I think, is very simple, which is Facebook's announcement is a recognition that they've played an outsized role in undermining our democratic processes. The problem with this is that the way Zuck framed the solution, it's not just too little too late. It's really a solution designed to appease people who are not looking closely at what the problem is. If we think about, Facebook's basically looking for absolution as opposed to solving the systemic problems that lead to this. And what worries me today is much less about political advertising on Facebook than it is about the denial of COVID, which has undermined our pandemic response. It is the organization of QAnon groups privately, the merger of those into the real world, forming militias, which are been occupying portions of Portland and Kenosha. There's so many bad things going on Facebook right now that contribute to undermining democracy, that this little thing is just essentially focused on a sideline.
Roger, I mean, that said, I guess they are in a very difficult position based on what the laws and regulations are, which is not very much. And whichever way they go, they're going to meet criticism in both directions. So when you look at the state of play where we are, coming into another election, 4 years has passed since the last one and all the problems that arose there. Who is more to blame for the fact that we haven't solved this in entirety? Facebook or lawmakers and regulators for not changing the rules that govern them?
Well, demonstrably, Facebook is responsible for the problem. If you think about how our government is currently structured, with Trump in the White House, Republicans controlling the Senate, Democrats controlling the House, that was never a scenario in which you were likely to see radical change in regulation of an industry that historically has not required any regulation. So in my mind, the issue here for Facebook is a very simple one. Do they want to be responsible for tens of thousands of deaths in the COVID pandemic because our nation's response to the pandemic is unable to get off the ground, uniquely among all developed countries? Do they also want to be responsible for the fact that militias are organizing on their platform, that QAnon is using their platform to literally, they're 3 to 5 million people, according to NBC, in QAnon and Facebook groups? And Facebook's own data says 64% of the people who join extremist groups do so because Facebook recommends that they do so. So Facebook's responsible for 2 to 3 million people joining QAnon, and QAnon has now infected these militia, and that's become an issue in the streets, and people have died. And you know, to me, the notion that Facebook needs a law to tell them to do the right thing is laughable. I mean, it makes me incredibly sad that the employees are not in open revolt, and that Zuck and Cheryl do not see what the right path is here. I mean, you have to ask, what kind of a country do you want to live in? Do you want to live in a country where militia roam free, armed, terrorizing innocent people? Do you want to live in a country where we have 1,000 people dying a day of a pandemic that every other country in the world has at least wrestled into some level of control? I mean, that strikes me as insane.
Yeah, and at the same time, you know, Facebook has held up so well in the market, Roger, just to bring it back to the market. I wonder if these actions you're talking about, which would be much more drastic than what Facebook has already offered, and the kind of response that you're looking for, which many are, which is not what they've offered, would be in direct conflict with their business and the fact that, you know, their stock is doing well, their performance is good, and they seem to benefit from the open speech that is their platform.
Sarah, I think you framed the problem perfectly, which is that shareholders have benefited enormously from Facebook not addressing the underlying problems, because it is the business model itself. It is the culture of the company. The very things that make the stock so valuable are undermining public health and undermining democracy in the country. And these things are in conflict. And essentially, this election is about whether corporations will always have the right to do whatever they want, or whether there should be some constraints, whether technology companies should be treated the way that, say, the chemical industry was treated beginning in the 60s, when we said, you know, it's no longer okay to pour your waste products into fresh water or dump it into the atmosphere. Or the pharmaceutical industry in 1906, when we said, you know what? Yes,
Sorry
sir?
to cut you off, but I'm not sure that that's what this election is about at all. I mean, these tech companies, especially Facebook, were able to thrive in the Obama-Biden years. And Trump years are just a continuation of that. It's not like anyone's talking about reining them in.
Well, actually, I think in Congress there's a lot of pressure to rein them in. There was an antitrust hearing just a few weeks ago led by David Cicilline of Rhode Island. It was relative to both antitrust and consumer protection. And there are even things going on at the federal level in antitrust. And so I think, sir, the way I would look at it is that during the Obama administration, people just generally didn't understand what the risks were of these platforms. And then their behavior wasn't the way it is today. So things have really changed. And when I say this election is about that, what I'm really saying is that President Trump has welcomed the use of these platforms to cause dissent and polarization in the country. And I think Obama in his time period would never have gone for that, and that Biden would not have gone for that either. And when Biden, if he is elected, he will be faced with a situation where the people who got him elected are the harmed parties from COVID and from militia. And so that those people will be entitled to expect him to take a more proactive role. And again, these are very important industries. Tech is super important to our economy, but there's no reason why it shouldn't operate in a way that doesn't cause harm. I mean, the pharmaceutical industry doesn't cause harm generally, neither does chemicals now. I mean, they're not perfect, but at least they have duty of care, and they do make an effort to try to be good citizens.
Roger, so much still to discuss as always on this topic, but we're out of time. Thanks so much for joining us.
Always a pleasure. Thank you very much.
Roger McNamee there. Stocks tanking in today's session. The Dow closing down more than 800 points. We'll break down what we're watching as we head into the final trading day of the week when we come back.
CNBC News Update is sponsored by Comcast Business. Bounce forward at ComcastBusiness.com.
Introducing Schwab Stock Slices. For as little as $5, now anyone can own companies in the S&P 500, even if their shares cost more. At $5 a slice, you could own 10 companies for $50 instead of paying thousands. All commission-free online. Schwab Stock Slices, an easy way to start investing or to give the gift of stock ownership. Schwab, own your tomorrow.
Hi, Mr. Wonderful here. I believe that startup investing is key to building wealth, but it's hard for everyday people to find access to these deals. Well, I've got good news. On Start Engine, you can discover hundreds of startups raising capital and begin building your portfolio today. For as little as $100, you can own a piece of the next great business. It's your turn to become a shark. Join me at startengine.com.
Business Beyond the Pandemic, a CNBC Spotlight event, September 23rd. Key insight for finance executives, weathering the storm, positioning for growth. Register now at cnbcevents.com/workspotlight.
We are KiwiCo, and we deliver hands-on STEM projects designed to inspire young innovators. Kids of all ages can explore science, engineering, art, and more. Get 30% off. Visit trykiwico.com. Must be 18 or older to log on.
Butcher Box. We deliver high-quality meat to your door. What happens next is up to you.
I'm a performing artist, so a healthy diet is one of the most important things. I also feel the same way about my dog. We got her a Farmer's Dog sent in the mail. It's all fresh. I want my dog to have a healthy and long life. Farmer's Dog helps that out.
See the benefits of fresh food at betterforthem.com.
Welcome back. Some developments on where the TikTok negotiations stand. Julia Borston's been digging into the story and joins us with some more details. Julia.
Yeah, well, I've been talking to some folks close to the situation. One source close to the situation tells me that while a deal announcement from ByteDance has been delayed by the new Chinese regulations on technology exports announced Friday, that the offers from Microsoft, Walmart, and Oracle are still on the table and are unchanged. I'm also told that while the new Chinese regulations could impact the way the TikTok algorithm is handled and sold, that one very valuable part of TikTok here in the U.S. is not at risk, and that's the wealth of data from TikTok's 100 million U.S. users. That data is already here in the U.S. and it is not subject to that Chinese regulatory approval. So if TikTok's U.S. operations had to build a new algorithm, it could train that algorithm with that mass of local data. Now, the source also tells me that the Chinese government is expected to approve the deal, and the new rules that were implemented Friday could be seen as a signal to Washington that China also wants a seat at the table for these talks here, Sarah. So it will be interesting to see how this all plays out.
All right. Absolutely, Julia, thank you. Julia Borston. A major market sell-off today on Wall Street. The Dow closing down more than 800 points. Worst day since June. And one big loser today was Signet Jewelers. That stock falling despite a big earnings beat. We're going to break down the move next.
We know business keeps moving, and however we connect, whether it's over the phone, online, or in your office, we're here to listen and provide solutions that help you run your business better. Because the decisions you make have far-reaching implications. And a relationship with a corporate bank like PNC can provide just what you need. As one of the nation's largest banks, PNC brings customized insights and a local approach to make informed choices now and in the future.
It's every municipal bond investor's dream. A bright, shining city on a hill where there won't be any financial problems. But what if there are? That's why Assured Guarantee protects your principal and interest payments. Assured Guarantee, a stronger bond.
With Skechers Max Cushioning, you get more. More cushion, more rebound. Each style includes maximum Ultra Go cushioning, Skechers air-cooled Go-Mat insoles, and rubber outsole contact points for added traction and durability. Get more with the Skechers Max Cushioning Collection.
At Sure Payroll, small business is our business. We started 20 years ago with a mission to serve America's small businesses. And that mission is even more critical in these uncertain times. Whatever your situation, help is here. And we've updated our product to support you in taking advantage of the economic relief offer from the CARES Act and the Families First Coronavirus Response Act. Sure Payroll is standing by you to get you set up with 1 month free payroll. Call 844-SURE-PAYROLL or visit surepayroll.com. Let's get through this together.
The nation's black workforce, striving for success and equality. Ideas to bridge the gap. Expert insight from corporate leaders and entrepreneurs. Charting the path forward. Race and opportunity in America. Tuesday, 7 Eastern, CNBC.
So my girl and I, we were watching a football game. And we were looking over some old vacation photos, but it was this photo right here that got me. It was the one where I was so happy. I was in the moment. We were at vacation, but a bird had landed right on my head. But it was the hair loss that got me. And just because of that, I said, I'm going to try Hims. I picked up the phone once I made the decision. It was super easy. Believe it or not, before I saw it, I could feel it. I could place my hand on the top of my head and I could feel some of the smaller, finer hairs that were coming through. This is the difference in 1 year with Hims. December 18 to December 19, this is exactly what I experienced.
Don't wait until you lose more hair. Hims offers you the chance to take control. Consult with an online doctor and find out if a scientifically proven prescription hair regrowth treatment is right for you. Get your free online visit at forhims.com right now. That's forhims.com.
Signet Jewelers under pressure, closed the day down only 4%. The jewelry company behind Zales, Kay, Jared, actually posting better numbers than expected. Sales were only down 35%, better than expected with so many of them closed during much of the quarter. Profits also came in better on big expense reduction, and same-store sales turned positive late in the quarter as stores reopened and malls reopened across the U.S. E-commerce is also helping cushion the blow of those closed stores, 72% growth there. Some questions? Obviously, visibility into the holiday season is an issue, and that is huge for the profitability of this company. The CEO, Jenna Drosos, telling me she is increasing e-commerce distribution throughput by 5 times to be ready for higher holiday e-commerce demand. So that's how they're preparing there. And some strength in the engagement business, which is up. Some insights from their proprietary customer data and insights that Drosos shared with me that I thought were interesting. 55% of pre-engagement customers decided to quarantine with their partners. Almost half said their relationship got stronger. Only 7% said it got worse. And 2/3 of pre-engagement couples said their timing for getting engaged was the same or they moved up their plans. Also, Zoom-worthy jewelry is a thing. Earrings and pendant sales were up. So some interesting consumer insights, Wilfred, into how people are at home still buying jewelry through virtual visits and e-commerce.
Signet, though, down, 3-4% there in today's trade. Up next, we're looking ahead and counting down to tomorrow's jobs report, which could be a major catalyst after today's big sell-off. And tune in for a special program on Tuesday on CNBC, Path Forward. Race and Opportunity in America. John Fort and Andrea Sorkin will take a closer look at the underrepresentation of black workers and leaders in corporate America and hear ideas and potential solutions from CEOs, from investors too, and entrepreneurs. That's Tuesday night at 7 p.m. right here on CNBC.
When the world gets complicated, a lot goes through your mind. With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. That's the clarity you get with Fidelity Wealth Management.
Who is USAA made for? It's made for this guy, a veteran who honorably served. And it's made for her. She's serving now. We made it for all branches and all ranks, whether they served one tour or made a career of it. We also made USAA for military spouses and their kids. USAA is easy to work with and can save you money on auto, home, and renter's insurance. Become a member today. Get an insurance quote at usaa.com/quote. USAA. What you're made of, we're made for.
I'm Hector. I am a delivery operations manager in San Diego, California. We've had a ton of obstacles in finding ways to be more sustainable for big companies. We were one of the first stations to pilot a fleet of zero emissions electric vehicles. The Amazon vans have a decal that says shipment zero. We're striving to deliver a package with zero emissions into the air. I feel really proud of the impact that has on the environment, but we're always striving to be better. I love being outdoors, running in nature. We have 2 daughters, and I want to do everything I can to protect the environment, to make sure they see the same beauty I've seen in nature. My goal is to lead projects that affect the world. I know that to be great requires hard work.
When the world gets complicated, a lot goes through your mind. With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. That's the clarity you get with Fidelity Wealth Management.
Booyah! Welcome to Cramerica. You can see more of me on Peacock, the new streaming service from NBC Universal. Go to News on Peacock to stream Mad Money clips and tips for free. That's a no-brainer. Learn more at peacocktv.com.
Brutal session on Wall Street for the bulls as we look ahead to tomorrow, Mike, off that 800-point close lower for the Dow, 5% slide for the NASDAQ, and it's jobs day.
Yeah.
What are the expectations? And is this the time where lousy economic data could move the market lower if the momentum is trending down?
Certainly. I think, first of all, there's nobody rooting for weaker economic data. We already have kind of maximum easy Fed. It's going to be that way for a long time. So there's no real positive way to spin a weaker than expected number, though there is so much churn going on month to month, week to week in the labor market that I don't think anybody has high conviction in what the consensus forecast really is. And so I don't know that there's anybody pinned to a very precise level, but we do want to see confirmation that things still kept getting incrementally better in August. That's been a big question on the consumer side of things.
Mike, I also just wonder overnight whether we're going to have a bit of catch down, so to speak, in international equities, particularly in Asia, given that, of course, this big sell-off in the US didn't start overnight with the futures market, and that might just set a tone, a rather negative tone, to start off tomorrow.
Yeah, presumably that would happen, although I'm not sure the U.S. in the morning is necessarily going to pick up the baton in that direction. It's a Friday before a 3-day weekend tomorrow. Keep that in mind. Also, unusual rhythms. Usually you don't get one of these real substantial one-day drops off an all-time high. Usually the market kind of rolls over a little bit more slowly and has some back and forth action. So there's some unusual intensity to the move up and then this sort of initial little air pocket we got today.
It certainly was a negative air pocket today. S&P closed down 3.5%, Dow down 3%, just shy of that. The NASDAQ was down just shy of 5%. Thanks so much for watching. We're out of time here on Closing Bell. Fast Money starts right now.
I'm Melissa Lee, and this is Fast Money. Tonight's trader lineup: Guy Adami, Karen Feinerman, Dan Nathan, and Steve Grasso. Tonight on Fast, a tech wreck rocking the markets with Apple, Microsoft, Amazon, Alphabet, and Tesla combining to lose nearly $500 billion in market cap today alone. Is this a sign of a true tech reckoning? And should this sell-off send you rushing to safe havens like gold? We'll break down the opportunities for the precious metal, plus what the VIX can tell us about just how long the pain of today's market could last. And if you've got questions about what to do after the sell-off, and why wouldn't you, we'll get you some answers in the special hour of Total Request Fast Money tonight at 6 p.m. We'll try to help you make sense of all of the action today. But we start off with all the red on Wall Street. Stocks are trading from all-time highs as the Dow goes back negative for the year, dropping over 800 points in its biggest one-day decline since June. As we said, tech stocks really leading the charge today. The sector dropping nearly 6%, snapping a 10-day winning streak, posting its biggest drop since March. So, is this only the beginning? Guy Adami, what do you think?
Hi, Mel. Remember the Carpenters? Remember, by the way, the Carpenters are one of my top 5 favorite
We've
bands
only
of
just
all time.
begun.
And they sang We've Only...
Yeah.
Look at you. See, you're in my head. Scary, actually. But I'll say this. 20, as I've said many times, 24 hours is not a day make, and we're basically back where we were a week or so ago. And I don't want to get into the VIX because we'll talk about it later, but I will say we've talked about it now for the better part of a week and a half, how despite the fact that the broader market was rallying, the VIX was trying to tell you something, and maybe today is what it was trying to tell you. The internals of the market haven't been particularly good, but again, this just gets us back to levels we saw last week. I do believe it's the beginning of something, but it could all reverse tomorrow on jobs numbers. We've seen it before, and we've come back after a long weekend to find the market up significantly. So I'm not going to make a huge deal out of this because I don't make a huge deal when it goes higher, but clearly there are things to be concerned about, Mel.
Yeah, Grasso, what'd you make of the action today?
Yeah, I think I'm going to make a huge deal out of it. I think that we are just on the precipice of a much bigger decline. I had said a couple of days ago I thought we could fade anywhere from 10 to 20%. So we got about 4 and change percent today. So obviously the quick, easy math, we have a lot more to go. I think tech going to continue to weaken. Now, the big question is, do you see value run in the face of this sell-off? Today we saw banks, airlines, and a handful of other stocks able to rally early with the cruise lines and the reopening stocks. But the truth is, if the market sells off 20%, it's taking everything down with it. So I am positioned for the tech sell-off. I'm positioned for the sell-off. But unfortunately, I'm positioned for the cyclical bounce. So that remains to be seen whether that's going to happen. But that's the way I am positioned right now. And I do think we have much further to go with the sell-off in terms of levels. And I don't know whether that happens in 2 days, 2 hours tomorrow, or 2 weeks.
You know, for many sessions now, we have been saying that this is a market that's a little bit divorced from fundamentals, if we can call it that, moving basically on this notion that there's so much liquidity out there. Karen, you made the argument that there is no alternative basically for these, elevating PEs. But here we are today. What do you think happened? And do you think that that argument of there is no alternative, that maybe there is an alternative at this point in time in this market run?
Well, I mean, what happened today is really built upon what's happened for the last few weeks, particularly the last 10 days, where the really, growthy ones just went absolutely parabolic. So I think this pullback is the beginning, not the end, but I don't think it is the end of the bull market. So, a day like today, I'm going to get, on positions like Apple and Google and or Alphabet, I'm definitely going to get hurt on that. And then I also trying to think about, all right, what do I want to own? What am I looking to buy? And I think I will get a chance because I think we're going to see more pressure. Just think about, also, I own often protection. And so S&P puts, I think about, all right, the VIX is really shut up. I know Guy mentioned it. We'll get to it more. But I'm not ready to sell VIX yet, especially going into a long weekend with a sell-off like this the day before. So I didn't do anything to trim hedges. I think there could be a lot more pain. But I'm also looking for things to buy, things that are not like I mean, DocuSign had great earnings, but the valuation's huge there. Things like a FedEx I would like to buy. I would like to buy some Lowe's. I think I might get a chance to do that cheaper. I would like to buy some more Walmart. I'd like to buy some URI. So I'm not throwing in the towel at all. I want to get into some of those more cyclical names and then some of the value names and banks. If I didn't own banks, I probably would have started buying today.
Dan,
I already own them.
Dan, do you have a shopping
list? All that
list?
having been said, I think more to go.
Dan, do you have a shopping list?
I didn't hear the... What's the question?
Do you have a shopping list?
Shopping list. Well, there is an alternative, and it's cash. And I think if you listen to Jim Cramer passionately on the closing bell in the prior hour, you know, he's kind of urging some of these people who are new to the stock market, who've only seen the stock market go up, who have fabulous gains in some stocks that they don't even know what the companies do, to take some profits. And I think that sort of sentiment may kind of really kind of permeate through this new into the end of the year. Let's just use one example, though. Let's use Apple Computer. This company literally, you know, traded up 30–40% from its last earnings just a little more than a month ago. It went up in a straight line, gaining, what, $600 billion in market cap. This is a company that has not been meaningfully growing their earnings on an organic basis in a couple of years. The stock had already rallied precipitously in 2019, in a year where its major product did not grow units. And now, obviously, the story about better margins because of the mix shift with services or whatever, but their services growth is only in the teens percentage-wise. But this company was trading at 40 times earnings yesterday at its highs. And that just doesn't make any sense. And we've seen analyst after analyst trip over themselves to come up with all this mental gymnastics of how to justify the price action. And I don't really blame them, because it's not in their best interest, working in an investment bank, to put a sell on a stock, but sometimes it makes sense to sell a stock. And that's what happened today in a whole host of names. So, you know, if you're wondering, at the start of 2019, when Apple had pre-released for the first time negative earnings in a decade, and the stock was trading at 14 times earnings, and then a year later it's trading at 30 times earnings, and then a year later it's trading at 40 times earnings, you have to start saying to yourself, what the hell's going on here? But, you know, listen, people have been paid to take that risk. I think that the dynamic might have changed in the short term, because I think we just had a bit of a blow off.
I think that's an interesting point to bring up, and we've been talking about this for some time. You know, the notion that analysts are sort of all over themselves in order to, you know, reestablish price targets to chase these markets higher, Guy. And I'm wondering, you know, in terms of the psychology of the markets, where that leaves us when we have a steep sell-off like today, and you had a string of analysts say for Apple, day after day after day, new street high price target, and then here we are.
Listen, we have wonderful analysts come on the network on our show, and they're wonderful analysts that don't come on that do amazing work that we read almost every day. With that said, my concern has been that I think for some, they're getting a price target and then backing into it instead of doing the work and then spitting out a price target, if that makes sense. And I think it might make sense to some of the folks out there. But then you have really recognizable people like Tony Dwyer, for example, who, by the way, has gotten this spot on dead right, who recently pulled his price targets, and Tony can speak to why he did that. But I think he feels like, you know, sort of a fool's game to try to put targets on a market right now that doesn't seemingly care. And I think it was Heather Bellini, and I'm sorry if it wasn't. But again, in terms of Goldman Sachs and Zoom, made the comments like, you know, we see what's going on here. We're raising our price, we're raising our rating to neutral, understanding that it really doesn't make a lot of sense. So I think you have a lot of people in our community scratching their heads. I think quickly, not that we're trying to find reasons for the sell-off today, but don't underestimate the, again, headlines of potentially the Chinese selling U.S. Treasuries. And I know the Treasury market is huge, and we're only talking about $200 billion potentially, so it's a drop in a bucket. But the message that potentially could send might have been the straw today, to Steve's earlier point.
The symbolic nature of that would be very important to the psychological aspect of this market. But I mean, just quickly, because we do want to get to the chart master on if there is technical damage to this market. Karen, I want to bring you back in, because you've been grappling with this in terms of a fundamental market versus a market driven by liquidity. And so this whole notion of analysts saying, you know what, we recognize that the stock is going higher. We do like this stock on a relative basis within our coverage universe, and so we got to back into that price target. I mean, investors have been doing a little bit of that mental gymnastics also in terms of saying, you know what, I recognize that the PE, for instance, maybe for an Apple is expensive compared to itself, but I got to be in this name. I mean, isn't that sort of a little bit of what has driven you to hold your position?
Yeah, that's exactly right. So, you know, I often talk about how I don't like a valuation that, or a new price target that's based on a new multiple. I'd much rather have a higher earnings on an old multiple. But we're in this new multiple, which is driven by super low rates or even negative rates, where you can back into a, you know, extremely high market multiple. So for me, I am long Apple. I'm still long Apple. I'm staying long Apple, partially on I don't have an alternative. My mandate, you know, is to be invested. But I feel like it got ahead of itself, but I'm going to wait it out because I think over time that I will end up making money from here in Apple. Maybe not tomorrow, probably not tomorrow. And that's okay, because also, aside from do I have another alternative, is do I sell it, take a big realized gain, pay taxes on that, and then am I able to get back in at the right time? And I have not a lot of confidence in my ability to top tick the market on the way out and bottom tick it on the way in. And if I believe in the longer term story, it's not going to always trade at fair value. It's super rich now, but I think ultimately it will be worth this value.
Yeah, important considerations. All right, let's get more on today's sell-off, the technical aspect of it. Let's bring in the chart master, Carter Worth, to break it down. So, Carter, I guess the big question here is, has there been damage to the markets? Has there been damage done to the tech sector in particular?
Well, in many ways, yes. But I mean, conceptually, we're well past what analyst price targets are, competing with one another to raise those targets, the multiple for the market. That's long ago behind us. It's a function of momentum. And we know that whenever you have a fever, it's hard to know when it might break, but you know when you see a fever. It happens in auctions for art. It happens for Ferraris. It happens in the local corner where people are trying to overpay for houses, 20% above cash. When there's a frenzy, there's a frenzy. Now, they don't ring bells at the top, but you all referred to a lot of different chimes. The fact, one, that the VIX was not confirming. The fact that both Tesla and Apple split their stock as people are pouring in more and more. The fact that we were making all-time highs in the S&P, and only 13% of the stocks in the S&P are making all-time highs. The average stock in the S&P is down 25% from its all-time highs. 50% of all stocks in the S&P have no gains for 2 years. These are all bells. In any event, let's look at some charts. So the first chart is just a one-year chart of the S&P 500, no judgments or annotations by me. Look at the second chart. Now, what we do know is if you do break out, if you will, move above a prior top, one reference point to use is the top from which you broke out. So we know that the January-February peak before the pandemic hit was 33.94 on the S&P, and the high today before this reversal, 35.88. So were we simply to drop back to that top, that's about a 5.5% sell-off, and we've come a good way already. We've done much of that. Take a look at the next chart. Now, drawdowns are normal. Since the March low, we've had three distinct givebacks. There was a 7.2% decline, which you can see there. A month or two later, a 6.4, and then an 8.3. We're due for that kind of thing. The question always is, and is the one that starts now, does that become a much bigger one? It's as good a bet as any, but the point is, as of now, it's perfectly normal. And then let's talk about tech. So here's a chart of the tech sector, the fourth of the 5 charts we're going to look at, and you can see a well-defined trend line. And the presumption is that we break trend. So the final chart, it's the same concept as the S&P. One reference point to use is the prior high from which you broke out. Now, were the tech sector to go all the way back to its January-February high, you're talking about a 20% decline. Just to sum it all up, I think it's important to say that, again, no one can know when a fever will break, but we know what a fever looks like. We know what a frenzy is as people bid more and more. It's not about valuation. It's nothing but that so-called Tina, there is no alternative. But that is not true. And Dan said it. The alternative is cash.
Carter, that's quite a bold call at this point. You're basically saying by looking at the charts, the alternative here is, in fact, cash?
Well, remember, see, it's the paradox of the investment community. It used to be that you were responsible for assets, and you a certain amount in cash, a certain amount in bonds. You might do real estate or precious metals. We're so spliced and diced now that I'm only mid-cap TMT, and that's my mandate, so I can't hold cash. And that becomes a self-fulfilling thing, a portfolio manager that's so pegged and wedged into a spot. But the concept of stewardship of capital, of course cash, is an important part of that process.
Carter, thank you. Always great to get your insights. Carter Braxton Worth of Cornerstone Macro. A number of this year's hottest stocks, as we mentioned, got slammed by the sell-off today. So we want to know, and I'm sure you want to know out there, is this an opportunity to get in, or perhaps there's more pain to come? We'll get some answers in Trade It or Fade It sell-off edition. So we kick off things with Apple, leading the Dow lower today, falling nearly 7%. And I'm sure a lot of people out there are saying, maybe this is my chance, Dan. I missed the whole run. What do you say? Trade it or fade it?
Yeah, I faded here. I mean, again, I just said that stock went up $600 billion in market cap since their earnings less than a month ago, or a little more than a month ago. You're going to have an opportunity to buy this stock probably back at that breakout level to 110 or so, and then get back in. It depends on your time horizon, but if you're thinking about playing for a quick pop, back to the prior highs, I think that comes from lower levels.
All right, next up, Tesla shares hitting the skids today, down nearly 10%. And of course, it had been down for a couple days prior to today's decline. So, Grasso, some people are wondering if they should get in here.
Yeah, Tesla, to me, when they announced they're going to do rolling dilution points, in other words, they're going to be issuing new shares, and they're going to do it on a consistent manner, that's going to be dilutive to shareholders. So this is a fade. Play the music or play the sound. There you go. So I think you're going to be able to trade this. This is going to be like what Dan just said for Apple, but it's going to be on steroids. I'd wait for much lower levels to jump back into Tesla.
All right, next up, Zoom, a big work from home winner this year, falling double digits. Trade it or fade it here, Karen?
I would fade it, which doesn't mean I would short it, but I can't look at this and say, oh, if only I could buy it at 380, that would be a good place, then now I can. It's still just, stratospheric, so fade it.
All right, last but not least, check out shares at Chipotle, down about 5%. So, Guy, what would you say here, trade it or fade it?
Yeah, the logical answer is fade it, but I'm going to stay with this one. I think the environment has set up well for CMG. I don't think anything has fundamentally changed other than the market. As Steve correctly points out, if the market sells off in a meaningful way, north of 70% of stocks are going to follow. But I happen to think CMG might be the one that doesn't. So I would stay in the traded camp, CMG.
All right. Let's move on here. DocuSign, of course, is one of the other work-from-home stocks, so to speak, that were hit really, really hard in today's session. Earnings after the bell here. So let's get straight to Deirdre Bosa, who's got all the details here. Deirdre. All right, we're having trouble with Deirdre's mic, but 45% revenue growth here for DocuSign. It looked like all the metrics were good. The stock is down by 3.2% here in the extended hours trade. It often moves in sympathy and in tandem with a name like a Zoom, which is seen as the beneficiary of all the same sorts of trends. Karen, what do you make of a name like a DocuSign here?
I mean, it's a great product. The valuation is too high. I thought the earnings looked really great, the big revenue beat. I thought the guidance was good. I mean, there was a lot to like, except for where the stock is relative to, as a valuation. So even down a little bit, I wouldn't be a buyer here.
Yeah, and initially it did look like it could bounce because we did have it trade higher in the after-hour session, Guy, initially at least, until it fell down by 3.6% now.
Yeah, what did we play the other day? FOMO or
NOMO?
I forget what the name.
Momentum or
right,
fundamental, so no momentum.
Right.
Yeah.
I should know the NOMO part because I know you know this, one of the great Dodger pitchers of all time. I know he's one of your favorite, Mel, right, if you remember. At any rate, the reason why I thought this was particularly dangerous is because stock went from 200 to 290 in a straight line, basically. Now, here we are at 235 or so. I think there's an entry level to buy it, and my sense is you buy it back where it broke out from, which is 195, and it gets there. I think you buy it with both hands because the story isn't broke. It's just a stock out ahead of itself.
All right. Coming up, chips getting checked in a big way today. We'll dive into the pain for the sector and break down what's next. And later, today's market volatility may have you running for cover, but how much longer will the pain go on? We'll search for any light at the end of the tunnel. But first, take a look at the stocks that were the biggest drags in a very big down day for the Dow. A special 2-hour edition of Fast Money is back in 2.
As business moves forward, we're all changing the way things get done. Like how we redefine collaboration, how we come up with new ways to serve our customers and deliver our products.
This one is cheddar. It's delicious. Oh, you look so healthy.
But no matter how things change, one thing never will. You can rely on the people and the network of AT&T to help keep your business connected.
The nation's jobs picture. Did the resurgence of the virus catch up with the resurgent job market? Or did business reopenings put more Americans back to work? August numbers tomorrow on Squawk Box. And now watch Squawk Box anytime on demand.
This is cellulose acetate, a plant-based material that's not only extremely durable, but also quite flexible, making it ideal for Warby Parker glasses, which, by the way, start at $95, including prescription lenses. Try 5 pairs for free at warbyparker.com. Oh yeah, about those prescription lenses. Warby Parker glasses come standard with custom-cut polycarbonate lenses that have been treated with scratch-resistant and anti-reflective coatings. Nice. Try 5 pairs for free at warbyparker.com.
Today, baldness can be optional.
With Hims, I have my hair back and I feel awesome.
With Hims, I've got my confidence back. Hims made it so easy, and I love the results.
Get a 90-day money-back guarantee at forhims.com.
With PlushCare, finding the time to take care of yourself is possible even when anxious or depressed. Introducing the new doctor's appointment online with top doctors for primary care and mental health. Plus, we take most major insurances. Download the PlushCare app today.
Welcome back to Fast Money. The semiconductor ETF, the SMH, getting crushed in today's sell-up, but there could be a lot more than meets the eye to today's smackdown. Josh Lipton's got the details behind this drop. Josh.
So, Melissa, some investors clearly deciding it was time to sell some chips. Check out that SMH. The ETF that tracks the sector finished deep in the red today. At the day's end, it had its worst day here since June 11th. Some of the hardest hit names included high flyers like NVIDIA and AMD, as well as names like Skyworks and Qorvo. Two analysts I checked in with say at least some of the sell-off could be traced to Ciena, a company that supplies optical equipment to the big carriers, guided below the street. Worst day since 2008 for that name. So was that an outlier or the start of something bigger? Even with this pressure today, though, what a run. The SMH still up about 80% since its March lows. Piper's Harsh Kumar highlights two big potential concerns that chip investors do need to think about, he says. One, valuation after such strong runs, and two, the election. How does that impact U.S.-China dynamics going forward? On that point, Bloomberg now reporting that China is planning what it calls a sweeping set of new government policies to develop its own domestic chip industry. And one final data point for chip investors to think about, Broadcom just reporting results, calling for Q4 guidance of about $6.4 billion. Street was at $6.2 billion. Melissa, back to you.
All right, Josh, thank you. Josh Lipton, of course, semiconductors at a new high just in yesterday's session. So, Grasso, maybe this sell-off in particular is not entirely a surprise given where it was coming from.
Sure, and this one wasn't one of these high flyers. It was only up 11% year to date. When you look at an AMD, which was up about 80% year to date, or NVIDIA up now after a little bit of a sell-off here, up 120% year to date. So those two, the latter two, are the sexier names in the chip space. I think you're going to have much more room to the downside on all of these names. But when I look at the value play, that's Intel. Intel you actually get a yield from. So you could see people that got run over in Intel actually dip a toe on this sell-off in these growthy names, just to do that yield hunt and that value play.
Yeah, but you got to believe that ultimately your yield is not going to be outweighed by the decline in the actual share price, guys. So I guess the question here is, you know, for chip stocks in particular, they are at the cross-section of growthy technology, but then also the ultimate cyclical play. So what do you think the forecast is for the chip sector in a market that might be hitting some speed bumps, shall we say?
Speed bumps. Yeah, no, it's in. So I'm inside your head again. So it's interesting. Karen addressed that yield point that you could get it wiped out in a day last night during the 6 o'clock special. I do pay attention to these things. So, and your question is the right question. You know, what does it mean for the? Listen, it's clear that the world has changed, and it's set up perfectly for what all these companies are doing. But you have to ask yourself, NVIDIA now is a $330 billion or so company. In my opinion, just my opinion, companies of that magnitude shouldn't move 10% in one day, and this has happened now a couple days. It's problematic. It speaks to something bigger problem with the broader market.
We're already having some problems with Guy's shot. So, Dan, I don't know if you're in his head and able to continue his thought, or if you've got your...
We just did our viewers a big solid there by pulling the mic there.
I might have hit a button or something, but,
so you guys, no, you're out, buddy. So you're talking about the SMH here, and 13% of the weight of the SMH is Taiwan Semiconductor. 23% customer is Apple. 6% or so, we would have seen an absolute bloodbath in the SMH. So it was really interesting to see some relative strength in the largest member of the SMH. That said, Mel, you made a great point. You got the growth, you got the cyclicality. I think that this is a group that obviously signaled the bottom back in March, at least as far as tech was concerned, but it might also be the one that pulls back and kind of stays back because some of those large components got very, very expensive, very, very ahead of themselves. But I'd watch Taiwan Semi. That could be a really good tell for this group in the next week or so.
All right, we got a lot more fast money coming up. Here's a little taste of what's to come over the next 90 minutes.
Looking for a bright spot in today's sea of red? We'll tell you what unlikely group was able to eke out some significant gains today. Plus, if you've got questions about how to navigate today's turbulent market, we're here to help. Tweet us at CNBC Fast Money, and we'll get you some answers. There's a lot more Fast Money coming up after this break.
Some see a grilled cheese sandwich and ask why. I see a new kitchen with a grill and ask why not.
I really need to start adding less to cart and more to savings.
Sitting on this couch so long made me want to make some changes, starting with this couch.
Yeah, I need a house with a different view. And this is the bank that will help you do it all. Because at U.S. Bank, our people are dedicated to turning your new inspiration into your next pursuit.
Your business may be transitioning to a remote workforce, but are you aware of the additional risks? Do you have staff who's now working from other states instead of where your office is located? If so, your workers' comp coverage may fall short. And be sure you're covered for cyber risks resulting from a worker's personal equipment that's used to conduct your business. Trusted Choice independent insurance agents can help. By representing multiple companies, they can offer customized coverage based on your unique needs so you can keep your business and workers safe anywhere.
This is what it's like wearing regular shoes. No all-around support. And this is what it's like in Skechers' new Arch Fit footwear. It's all the comfort and support you need.
Refill, snacks, hot towel.
It's good to have support. Try Skechers Arch Fit, podiatrist-certified arch support.
It's a familiar story. Allergies ruining your sleep and next day too. Taking Zysol at night relieves allergies while you sleep, so you wake refreshed. Plus, it works faster than Claritin and on first dose provides the same relief as Zyrtec at nearly half the size. Be wise all. Take Zysol at night.
We put everything we had into this.
Do not miss the chance to get in.
We had an opportunity. We took it.
My family is going to come in here and tackle you. Do this deal.
Shark Tank, tonight starting 7 Eastern, CNBC. Get yours.
Welcome back to Fast Money. The broader market sell-off hitting a key group involved in the hunt for the coronavirus vaccine. Biotech stocks dropping almost 4% today. It comes as drug makers race toward the finish line in the vaccine race. And of course, yesterday we got news from the New York Times that the CDC, now confirmed by many sources, that the CDC has sent out directives to various states to prepare for the distribution of a vaccine. There are also a few key dates in terms of the vaccine pipeline. October 22nd being the FDA vaccine update meeting. Meg Terrell's got the roundup of all the developments that could be moving the markets here. Meg.
Hey, Melissa, sorry for my technical issues here. One of the biggest pieces of news that we got today was from Pfizer. They are among the two companies in the lead in the efficacy trials for their vaccines. Their CEO, Albert Bourla, is saying today that they have now enrolled 23,000 participants of the planned 30,000 in their phase 3. They're going ahead of schedule. And he said that they anticipate they could have enough data by the end of October to know whether the vaccine works and to be ready for FDA approval. They say they are now putting together the application so that they could file really immediately after they have that information. There was some doubt cast upon that by Dr. Fauci and by Moncef Slaoui, the head of Operation Warp Speed today. Take a listen to what they said in two separate interviews.
If someone comes out and says, you know, I'm going to shoot for the possibility that I'll get it by October, you can't argue strongly against that. That's unlikely, not impossible. I think most of the people feel it's going to be November, December.
There is a very, very low chance that the trials that are running as we speak could read before the end of October, and therefore there could be, if all other conditions required for an emergency use authorization are met, an approval. I think it's extremely unlikely, but not impossible.
So, Mel, of course, a lot of people very curious about that date, especially given it's so close to the election on November 3rd, and given that there was that letter from the CDC this week to governors urging them to be prepared by November 1st to distribute a vaccine. What we're hearing from the folks on the government side, from Dr. Fauci and Moncef Slaoui, is it's just good to be prepared. They are not counting on a vaccine being ready that early. Pfizer, though, does seem pretty confident. Mel?
Meg, thank you. Meg Terrell. And of course, Pfizer didn't escape the sell-off today. It was down 2%. Moderna managed to eke out a small, teeny weeny gain here. But Guy, it was in the cruise lines, the airlines that did well, relatively speaking, on the notion that the economy could reopen.
Yeah, on a lousy tape. And I thought, you know, we mentioned them yesterday and thought, you know, if the news was such, those stocks should have done much better yesterday. So maybe they just took a day to catch up. So that's encouraging. Clearly, in terms of biotech, going back to Meg, I'll still say this. You know, I still think the horse that's going to cross this finish line first has yet to be even spoken about in terms of who's going to come up with the vaccine, and I believe that. And if you look at a lot of these stocks, I mean, yes, you mentioned Moderna's up on the day, but that stock's down from 95. Gilead has been a very difficult stock to own, despite the fact that it rallied over 80, back to 65. The list goes on and on. I think the IBB, if you really want to play at home and look for a level, 128 in the IBB is a level you really have to watch in terms of breaking through on the downside. It gets concerning. I think it bounces from there. I think it closed at 130 or so today.
All right, let's talk more about the airlines. In fact, take a look at them across the board, as we mentioned, bouncing back and bucking the broader market trend. United Airlines up by 1.4% on a very down tape. Our next guest, though, warns that passenger growth isn't strengthening ahead of Labor Day weekend. Let's bring in Helene Becker, senior airline analyst over at Cowen. Helene, it's always great to see you and get your thoughts on the sector. You're not any more positive than you were a couple months ago about the sector and traffic trends?
Hi, Melissa. Thanks again for having me. No, actually, I'm not. Kind of disappointed because back in July, we saw about the same number of passengers per day we're seeing now. And that was a great recovery off the bottom. The mid-April bottom was 89,000 passengers per day. We're running between 600,000 at the low end right now and 800,000 at the high end. On peak days. And I think that's really disappointing because that's where we were a month ago, and we're still down 70% year over year. Basically, we're still hopeful to get to 1 million a day by year end, but I think it's going to take that vaccine to get people convinced, among other things, to get people convinced that they need to travel again.
There are varying degrees, though, of approval for this vaccine, though, Helene. It's a sort of complicated story, right? I mean, there could be the emergency use authorization, which we're talking about in terms of the potential pre-election, late fall sort of deadline, and then there's sort of the broader use, which may come a little bit later on. So is it your anticipation, like when you think about a vaccine and the impact on the sector, is it enough for, let's say, emergency use authorization, which would not be for the general public, would be for first-line responders and for very vulnerable parts of the population, that would flip the switch, so to speak, on airlines in anticipation of the broader authorization, or do we need to see this actually distributed to the public in order to see airlines see that bump in traffic?
Okay, so I think three things about that. One, yes, in a word. What you just said is so completely accurate. I think the idea of a vaccine will be hugely positive. So that's number one. I think the idea of when it's available to the general public is sort of little letter A, or number two, in the sense that probably some people will be the first in line, but there will be many people who will say, I will wait, X months or X weeks. Then the second thing I would point out is quarantines and governments closing their borders. So we have to segment the market into international and domestic again and say, well, domestic is likely to continue to recover, but this whole idea of quarantine rules and things being open make it very difficult to figure out where to go. And then finally, international, I mean, borders are still closed. There are still huge issues, even with open borders and testing. I think a key element is testing. Obviously, that will help hugely. And I thought the United News today, I don't know if you had a chance to see it because it came out very late, but they put an interactive map on their website, which I think is huge because it enables people to go on the web, click a state, see what the rules are, and make your decision in an informed manner about whether or not you can, you should or could fly there.
Helene, it's Karen. Thanks for coming on. Let me ask you something. With some of the cost cuts that they've been making or will make if there are furloughed jobs as reported, what are the break-evens for, let's say, a Delta or a United? What capacity they need to have to get to break even, which buys them more time?
Right. So that question is somewhat difficult to answer in the sense of this. Let's just say government aid continues into March. Then break evens are relatively low, say 30% to 40%. Let's say government aid ends as expected on September 30th, and they go through with the furloughs, which we've calculated to be between furloughs and voluntary leaves to be somewhere in the neighborhood of 150,000 people. Then your break even is going to bump up to closer to 60%. And that presupposes fares stay at second quarter levels. As demand comes back, we expect fares to decline because once airlines figure out that they can stimulate demand and people will fly, they will lower fares. And also, remember, airlines always lower fares. I shouldn't say always, but a lot of times they lower fares when oil prices go down. So we're at $1.10 a gallon for jet fuel. A year ago, we were $1.80. That's a huge cost improvement, about a 40% cost savings year over year. Even if it comes up a little bit, it's still a big benefit to them that they're currently really not taking advantage of.
All right. Helene, it's always great to speak with you. Thanks so much for your time.
Thanks again. Thanks, team.
Helene Becker of Cowen. Guy Adami, it's a pretty dire picture painted here of the airline sector.
Yeah, and what we don't talk about, we bring it up from time to time, is the fact that, obviously the profitable, the high margin business is the business traveler. And you just look at the Zoom stock that we talked about for the last week and a half, 2 weeks. I hate to say it, but I'll say it. Business travel is not coming back the way it was 6 or 7 months ago, because I think people have learned, hey, guess what? We don't have to get on a plane to go cross-country to have a meeting. We can do it in the comfort of our own homes. And that is fundamentally going to change business travel, which is a real problem for the airline. So I don't know if they can return to those levels in the near future. I think one of the airlines today said it'll be 2024 before they get even close. That said, it doesn't mean the stocks can't grind higher from here. 27 in Delta has been the pivot point. We've talked about that for a while. I don't think you have to go racing into these things, but they should absolutely be on your radar screen as trading vehicles.
All right, coming up, will today's sell-off spark a rush to the safety of gold? The traders weigh in on the opportunities in the precious metal. And we're just a few hours away from the market open in Asia. We'll tell you how the trading day is shaping up on the other side of the globe. And as we head to break, take a look at some of the recent high flyers taking the biggest hits today. Much more Fast Money right after this.
Millions of people are saying yes to Allegra, including the experts. It's the #1 allergist-recommended brand for non-drowsy relief. Allegra works 2 times faster than Claritin, and while Zyrtec may cause drowsiness, Allegra won't. Say yes to Allegra.
If you've tried college but never finished, SNHU lets you transfer up to 90 credits toward your bachelor's degree.
It doesn't matter how old you are, you can do it. You can finish.
Finish your degree at snhu.edu.
We get it. Stuck at home, putting on a few pounds? Lose weight without even leaving the house with Nutrisystem for Men. Get delicious food delivered right to your door.
Breakfast, lunch, dinner, grab a snack in between.
Lose up to 13 pounds your first month. And there's even a money-back guarantee. They deliver your favorite foods made healthier. Act now. Save 50% on a month of food delivered to your door.
Go online or call 877-540-FIT4 and save 50%.
30 players, all fighting to become champion, but only one can win the ultimate prize. History will be made here at the Tour Championship, Sunday on NBC.
My reputation was trashed online. I felt completely helpless. My entire career and business were in jeopardy. I called Reputation Defender.
Take control of your online reputation. Get your free reputation report card at reputationdefender.com. Find out your online reputation today and let the experts help you repair it.
They were able to restore my good name.
Visit reputationdefender.com or call 1-877-866-8555.
Hi, I'm Yaya, founder of Truebill. These are crazy times, and keeping track of your money has never been more important. With Truebill, you can easily cancel subscriptions, lower bills, and create smart spending habits. Download Truebill today.
He never really liked his food. He wouldn't eat till like 10 o'clock at night. You know, the typical giant bag, dried little balls. That kind of led me to Farmer's Dog. Now he knows when I open the refrigerator, it's coming. It's already portioned out. He's eating whole foods. It's amazing.
Visit betterforthem.com.
Welcome back to Fast Money. As stocks plunge, gold was able to stay relatively flat. Bitcoin, meantime, which had been acting like a safe haven this summer, took a real hit. Does this signal anything about what is next for the market? And Guy, I'm curious what you think of gold's action, if it performed better or worse than you thought it would have amidst the sell-off.
You know, Tim talks about this a lot. On big sell-off days in the broader market, the equity markets, we typically have seen sell-offs in gold that last a day or two, and then it gets back on its horse. And that's what I think we saw today. Actually, I don't think the sell-off was nearly as bad as you would have thought, given what I just said historically over the last couple of years or so. Look, I'll say it again. I've said it 100 times. Gold is, in my opinion, going significantly higher from here. I mentioned the potential for the Chinese to sell treasuries. I think that's extraordinarily bullish for gold. I think the world, if you've been waiting for a setup in gold for the last 20 years, it's never looked better than it does today, given what's going on. So, you know, the day-to-day permutations notwithstanding, I think it goes higher from here, Mel.
Dan, what do you think of the notion of safe havens?
I think it makes sense. I mean, listen, I'm not a gold bug. Guy's had a great call on gold. He's been just buying it on every pullback all year long. You know, I do see higher highs. I know that, you know, a lot of people, as a diversification tactic, the idea of putting a few percent in a gold or a Bitcoin or something like that, that makes sense. But, you know, GLD had that amazing move, the ETF that tracks it, over the last few weeks, and then came back 10% really hard. I'd say I'd really want to see this thing holding 180 because you could see a bit of an unwind. It seems to be a very crowded trade, and when we get sharp sell-offs, we see correlations go up fairly dramatically. We saw it in Bitcoin. We even saw it in gold back in February and March. So I don't think you can always play the inverse sort of trade as far as gold and equities and the dollar, that sort of thing. It doesn't always work.
Yeah, and Karen, you're in Bitcoin. So What do you think of its performance as a safe haven?
Well, I mean, Dan just touched on the correlation, obviously very high. And in fact, you know, I think the last 2 days have been far worse for Bitcoin than, say, the highest flyers, maybe maybe pretty bad. But I still believe in the long term. I think the fundamentals of why I'm in it are setting up the same, just as Guy feels about gold. The fundamentals of why you're in it, the fear about, you know, Fed printing money, the fear about fiat currency, potentially inflation, all those reasons, I'm staying with Bitcoin.
All right, coming up, the so-called fear index on the rise in a big way today. But what is it signaling about where the markets might be heading? We'll break that all down. Plus, more market turbulence means it is the perfect time for another Total Request Fast Money. Our traders will answer your burning investing questions right at 6 p.m. Eastern Time. So stick around, and much more Fast Money straight ahead.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
America's biopharmaceutical companies have one very important thing in common: a common enemy.
We're making great progress because we're collaborating in ways that we've never done before.
In a matter of weeks, we've progressed from potential treatments
to antibodies and antivirals that have shown positive results.
To several promising vaccine candidates.
Because science
is how we get back to normal.
Now, more than ever, you need a mobile bank account that helps you earn and save more. That is Unlimited by Green Dot, with an incredible 2% interest on your savings and unlimited 2% cash back when you shop online. Open an account at greendot.com.
I tried a new laxative that's both gentle and fast.
New great tasting Dalcolac soft chews works naturally with the water in your body in as little as 30 minutes. Puts you comfortably in control. New Dalcolac soft chews.
When we founded Tommy John, Tom was obsessed with how to make underwear truly comfortable.
So we reimagined comfort through fabric, fit, and function.
We use soft, breathable, lightweight fabric with stay-put waistbands that never dig and stretch where you need it.
You could slingshot this thing. Look at the stretch on this baby.
Just try one. You won't go back.
Go to TommyJohn.com right now. Use the promo code on the screen to get 20% off your first order, and we'll ship it to your door for free. Plus, we offer a best pair guarantee. Tommy John, no adjustment needed.
CNBC Make It is now on Peacock.
Look what I've accomplished for myself.
Every dollar I spend, I think of how I can make to cover it.
My default mode is saving.
The CNBC Make It channel, streaming free on Peacock.
Welcome back to Fast Money. Today's sell-off is rattling cages across the entire market. The Dow dropped nearly 800 points, but it was a high-flying tech trade that took the biggest tumble. Check out the Qs getting crushed to the tune of 5%. So if you're in this trade and you're worried that today's pullback might just be the beginning of more volatility, you're not alone. In fact, the options market is signaling the possibility of turbulent times ahead in the tech trade. Mike Coe has the action. This is sort of a trade school, the more you know, and an options action rolled up into one, Mike, because we've been flagging the rising VIX along with the rising markets for days and wondering what that might be signaling. Was today the reckoning, so to speak?
I think it certainly was a part of that reckoning. As you point out, last week we saw 2 consecutive days where the S&P was higher and the VIX was higher. That's an unusual circumstance. Happened less than 1.5% of all trading days going back to 1990. That's basically when the VIX data first started. And what we have also seen is that basically the bid for calls in a lot of these high-flying stocks has also been going up ahead of what we saw today. That's unusual. Usually what you see is volatility drops as markets sort of steadily march higher. But sometimes when you're going to see a blow-off top, actually the opposite happens. Why is that? Because investors are still reaching for the momentum propelled by the Fed, but are concerned about valuations. And that's when you start seeing a bid for those calls. And that's why we've also seen record call options volumes relative to puts lately. And as we take a look at the VIX right now, so obviously we saw a big spike in it. This is also unusual, less than 1% of days in the past have we seen VIX moves of this magnitude. Usually you see considerable volatility in the days that immediately follow it, but it may surprise people to know that other than 2008, generally speaking, 30 days later, the market has actually done okay. It has sort of recovered. So I think we're dealing with that damage right now, but I'm not surprised to see a lot of people trying to use options here because you are trying to stick with the momentum trade, but you're concerned about valuations. Makes sense.
So basically, the elevated volume of calls, you're interpreting that as people replacing stock positions and being in the options instead.
Yeah, absolutely. I mean, look, if you own stock and you buy downside puts, essentially you're trying to create some asymmetry in your returns. Buying calls is essentially trying to accomplish the same thing, maintaining a long exposure but risking less money to do it. And people are paying up for the privilege. And we can see that basically in call volumes and in the price of calls relative to puts, and then also the overall level of options prices, which are significantly elevated. But I will say, when you see big VIX spikes like this, sometimes you get 3 days or so of bad volatility, but 30 days later, you might find the market higher. Right now, we're also pricing in significant volatility around the election.
Right. Mike, thank you. Professor Coe to the rescue here. For more options action, be sure to tune into the full show tomorrow, 5:30 p.m. Eastern Time. Coming up, stocks plunging to end the trading day here in the U.S. We're heading across the Pacific to see what the day has in store for Asia's biggest markets. Much more Fast Money ahead.
Options Action is sponsored by Thinkorswim by TD Ameritrade.
Well, things are different these days, but we're figuring it out. We're doing school online now, learning a lot. Come in. Finding cool stuff to watch. Dad's got some new workout buddies. And I still get to spend time with you.
Okay, now we're gonna put the sugar.
Guys, if you wake up feeling fat, bad back, heartburn, tired, then it's time to get healthy and lose weight with Nutrisystem for Men.
I'm healthier, I'm stronger.
Lose up to 13 pounds and 7 inches overall in your first month. Money back guaranteed. Order now and we'll deliver Nutrisystem for Men.
Not only did I lose 60 pounds, I don't snore.
Save 50% on a month of meals delivered to your door.
Go online or call 888-916-FIT6 to save 50% plus get probiotic shakes free.
Redefining the future of business, a CNBC Summit, October 6th. Insight and ideas from the most influential voices disrupting the next decade of work. Register now at cnbcevents.com/work.
So my girl and I, we were watching a football game, and we were looking over some old vacation photos, but it was this photo right here that got me. It was the one where I was so happy. I was in the moment. We were at vacation, but a bird had landed right on my head. But it was the hair loss that got me. And just because of that, I said, I'm going to try Hims. I mean, I picked up the phone once I made the decision. It was super easy. Believe it or not, before I saw it, I could feel it. I could place my hand on the top of my head and I could feel some of the smaller, finer hairs that were coming through. This is the difference in 1 year with Hims. December 18 to December 19, this is exactly what I experienced.
Don't wait until you lose more hair. Hims offers you the chance to take control. Consult with an online doctor and find out if a scientifically proven prescription hair regrowth treatment is right for you. Get a 90-day money-back guarantee at forhims.com.
Big interview coming your way tomorrow. Vice President Mike Pence is first on CNBC to talk the jobs number, the state of stimulus, and a lot more. That's on Squawk on the Street tomorrow morning, 9:30 a.m. Eastern Time. We are counting down to the open in Asia. Will Caloris is in Sydney with more on how the markets are setting up there. Will.
Well, Melissa, we are expecting a bit of a drop-off when it does come to most of the Asian markets following on from that Wall Street lead. The Nikkei futures right now showing around about 365 points knocked off the top. It is worth remembering, though, that the Nikkei was sitting at 30-year highs because of a lot of the government stimulus. That's in dollar terms. As far as Australia is concerned, right now the SPI futures are showing around about a 1.9% drop at the open as well. This is pre the reset, however, but I suppose one of the byproducts for the Australian market is the fact that the Australian dollar got absolutely creamed on the back of that US dollar strength as the markets went down. So that came off by 1%, so it should buttress some of the commodity plays, even though some of our big iron ore miners in the ADRs lost around about 3% in the US trade. But I suppose the biggest gauge, or the first gauge that you are likely to see, is the New Zealand markets. They open in around about 5 minutes' time, so that should set the tone for the rest of what we are expecting to see on the Asian markets, Melissa.
All right, Will, thanks. Will Calores in Sydney, Australia for us. Steve Grasso, we've had trouble with your shop. We got you on the phone. Tomorrow, first thing in the morning, what will you look at?
So, you know, it's always that little bit of who's chasing who. So obviously we're going to see the weakness in the Asian markets coming off of our markets. And then when we get in, the play is going to be, you want to see the American market, the U.S. markets, continue to sell off and be weak prior to the opening. You don't want to see them try to recover based on a bounce before the New York Open. You'd rather see them open weak, stay weak for maybe a couple of hours of the day, and then try to rally. The problem, Melissa, is that we're going into a holiday weekend. So a lot of this stuff can be exacerbated or muted depending on how you look at it, but I would look for more weakness.
All right, let's get to the final trades. And Grasso, while we have you on the phone, kick it off.
So FedEx came out with a statement saying they're hiring 27% more seasonal workers than they did last year. That's extremely bullish for the cyclicals. WRK, WestRock, containers and packaging. That's where I'm at.
All right, Dan Nathan.
Yeah, AT&T, it's been a big laggard over the last few months here. There's a catalyst of them possibly selling their DirecTV, 7% dividend yield. This one's okay, in and around $30 here.
Karen Feinerman.
Yeah, so I'm always long, but I always own some puts. And so I look at the VIX move in a day like today, and I think, is this the day to sell them? Not quite yet. I want to own them certainly for tomorrow, maybe into the weekend, and probably look to sell them on Tuesday. So if you own S&P puts, wait, don't sell them yet.
Guy.
Well, services traded okay today. Halliburton basically unchanged. Schlumberger higher. SLB, Mel.
That does it for this hour. Don't go anywhere. Special bonus hour. Total Request Fast starts right after this.
So you're a small business, or a big one. You were thriving. But then, time to think, plan, pivot. How do you bounce back? You don't. You bounce forward with serious and reliable internet, powered by the largest gig speed network in America. But is it secure? Sure, it's secure. And even if the power goes down, your connection doesn't.
So how do I do this?
You don't do this. We do this together. Bounce forward with Comcast Business.
Adventure is calling. You may know it as the open road, a weekend getaway, or just getting away from it all. You've heard the call. Felt the urge to conquer the off-road, the craving of new trails to blaze, the desire to just keep driving. We know because we've gotten the call too. We look forward to seeing you out there. The Land Rover Call to Adventure sales event is going on now. Land Rover, above and beyond.
What did it take for me to beat lymphoma? It took an incorrect diagnosis, a failed stem cell transplant, and one call to MD Anderson Cancer Center to renew my hope. It took the brilliant minds of my oncologists and a groundbreaking clinical trial to defeat my cancer and trailblaze a path to help thousands more.
What will we do in the pursuit of making cancer history? Whatever it takes.
It's a familiar story. Allergies ruining your sleep and next day too. Taking Zysol at night relieves allergies while you sleep, so you wake refreshed. Plus, it works faster than Claritin and on first dose provides the same relief as Zyrtec at nearly half the size. Be wise all. Take Zysol at night.
Where the nation is on the move, Main Street's new view of the market.
It is an IPO palooza.
Where COVID hotspots are improving on the path forward. Stay connected, stay informed. Watch or listen live on the CNBC app.
This one chart says it all. On an astonishing day, the Dow down over 800 points as tech stocks, the market leader since the rebound began back in late March, snapped a 10-day winning streak hard. Welcome to a very special